Leading to a power outage, the airport closed all day. Also keeping an eye on Dassault Aviation, the CEO saying that France may order about 30 extra Rafale jets. And UBS, a big scoop from us here, UBS looking at moving its HQ out of Switzerland in response to the capital buffer rules. All of that to watch at the Open, Guy.
Okay, let's talk about this Open. The Friday Open is almost upon us. It is time for the opening trade. Let's show you some numbers, give you an idea of what is happening. We are expecting some negativity early on in the session, but there's lots to get through throughout the rest of the day. We're going to fold in what is happening with the aviation sector first thing into Europe. But there's a few other corporate stories we're going to be watching as well. We were talking to Salzgitter a little bit earlier on. But the expectation is that Europe is going to open soft, and we're already seeing indications of that. We're not down by much. We are up, as I say, on the week for the stock 600 by around 1.2%. So there's a little bit of a cushion maybe for Europe going into the weekend. We are down by 0.4% on the stock 600. Unsurprisingly, and I'm sure this banner will appear on the bottom of the screen for you in just a moment, Lizzie, we are seeing IAG, the parent of British Airways, opening a little softer first thing this morning.
Down 2.2% as things stand. You're also looking at weakness for Lufthansa. That's down more than 1%. Air France, KLM down 0.5%. EasyJet down 1.1%. So misery for the airline names this morning. I was looking for maybe some weakness in terms of the European insurance names, given the travel insurance impact of this as well. Direct Line shares down 0.3%. Swiss Re down 0.7%, but just red across that sector this morning. But as you say, it's red across the European equity picture this morning. We've got the CAC down 0.5%, still waiting for the DAX. And though if we look at the sectoral picture as things stand, travel and leisure, as you would expect, absolutely bottom of the basket, down 1.3%. 18 out of 20 sectors in negative territory this morning. Only telecoms and utilities, Guy, eking out gains this morning.
Let's give you a sense of the breadth and what is happening here. So down, 481 stocks are down in the stock 600. Lizzie Burton pulls the face. Only 84 at this point are tracking high. I've got 33 unchanged at the moment, but the balance definitely very negative right now. As I say, 480 stocks out of 600 are currently tracking lower. In terms of where the damage is being done from a points point of view, it is ASML, Novo Nordisk, Schneider, Siemens, Nestle, Danske Bank and LVMH. Some big names, but a fairly big and eclectic mix there in terms of the sectors that they operate from. HSBC is tracking a little bit higher. In terms of the airlines, let's show you some names in terms of the airline story this morning, just to give you an idea of what is happening with the travel story first thing. Unsurprisingly, we are seeing some pressure here given what is happening at Heathrow. This won't just be a Heathrow story today. This will affect airlines across Europe. And while you can see that IAG is the big loser, down by 3.1%, other airlines in Europe are certainly seeing significant weakness as well, Lizzie.
Indeed. Well, let's speak to Anne Doe now, portfolio manager at Julius Baer, who, of course, specialises in equities. So it's great to have you at the start of trade. I mean, this Heathrow closure, I think, just really speaks to all the struggles that the UK is facing at this time when we really, really need some investment. We've got the Chancellor's spring statement coming next week. Can the UK invest its way out of this?
Good morning. Thank you for having me, Lizzie and Guy. Look, it's not just a local problem. Like, I think the growth concern and potential for slowdown, that's a global question at the moment, not least in Europe, but also in the US. So the global concerns around growth, that question around can growth continue, that's been a headwind for markets recently.
Well, of course, it's been a huge headwind in the US until a decent week so far for the S&P. But, yeah. I mean, yeah, I'm not going to speak Greek here, to Guy's pleasure. What's the read-through from that US misery when it comes to European stocks?
But I think that goes some way to explain the European outperformance year to date. There's been strong outperformance in Europe. In portfolios, we have been running an European overweight, but that includes a more defensive element of Europe, like Swiss stocks. You know, that the Swiss market is very big in pharmaceuticals and consumer staples. That's maybe different from, I guess, your typical European stock. We've been thinking about just that position going in, including some quality growth names that we're also happy to hold over the long term. When you think about whether that rally can continue, relative valuation is not that cheap anymore, right? The European relative valuation versus the rest of the world, that's back to levels we've seen before Russia-Ukraine. So the opportunity set is not that cheap anymore. And secondly, our team crunched the numbers and look at what happens when the US slow down, what happens when the S&P 500 is in a downtrend.
Yeah.
Actually, the rest of the world tend to underperform, tend to suffer as well. So we're in an unusual situation when the US is in decline and yet the rest of the world is rallying.
Lizzie doesn't let me talk about the beta, but that's effectively what you're talking about.
Effectively.
Okay, so it sounds to me like you're feeling fairly defensive at the moment. What do I do? What does a defensive portfolio look like?
You know, there's a level of uncertainty out there, not least when it comes to policy uncertainty. Just the level of change in policy making drives cost of concern. So we are relatively defensive. We're not rushing to buy the dip. In terms of portfolios, we still have a high level of cash. We're holding a gold position. We're overweight duration. So government bonds have actually provided a decent level of protection for multi-asset portfolios this year.
Yeah. If you don't get a recession, does credit help? Because if defaults don't pick up, you can sit and clip a coupon for a long time here, assuming that you don't get a deep recession, that growth slowdown that you're talking about doesn't become significant. Are there ways of generating income that look reasonably defensive, and is credit one of the ways you would look at, or do you worry about pricing being as tight as it is?
I would say we're more on this latter,
right.
So we're more worried than. So in terms of high yield, it's like credit component, where do we fall in that credit rating? So we're underweight high yield because we're still concerned about that potential for spreads blowout. It's not happening yet because the economy is not in a recession. The economy is simply slowing down in the US from a very high rate of growth to simply a slower rate of growth.
But in terms of how you would rank, like in terms of the defensiveness, how do you think about equity versus credit versus the bond market? You talked about gold. Like how are you kind of rethinking the relative risk in these various asset pots that people will have in their portfolios?
So within the various opportunity sets, we're neutral in equities. We remain diversified regionally. So we have a bit of Europe, and we're also adding China to portfolios starting February. So we're maintaining regional diversification to build in that defensiveness in terms of relative valuations, creating that spread of opportunities within the equities. In fixed income, we like duration. We have a small overweight in duration in London. In credit, we're underweight high yield, neutral on investment grade, and overweight emerging market debt. So that's where we are in terms of the opportunity set.
That's interesting. So how do you weight Europe and China then?
So those were, I guess, the talking points coming into this year, right? Those, in terms of the starting point coming into this year, both markets were at very steep discount. Both markets have rallied. I think the story for China, it really came down to a few things. First thing is around DeepSeek, and DeepSeek really showed us that Chinese companies have remained really competitive. And secondly, policymakers have started to sound more market-friendly. They talk about raising the fiscal deficit. They're meeting with private market leaders. They're showing a more friendly face. So that Chinese story look attractive to us.
For the last, I can't remember how long it is, years and years and years and years, you basically wanted to be massively overweight the US. The exceptional trade was on.
Yeah.
That's how you outperformed. If you really wanted to outperform, you were in US tech.
Yeah.
Is that over?
It comes down to a question of time horizon. In terms of the short term, it's true that the US has a few questions around policy uncertainty. But I do think it comes down to timing, because all of the negative side of policy making, like tariffs, like fiscal budget cuts, that has been front-loaded to this year. Whereas the more positive side, let's not forget that the administration is also talking about tax cuts, talking about a more pro-growth stance in the U.S. That's probably coming later. So for the U.S., I think there's a timing issue here where in the short term there could be noise. But over the long term, that's still where the productivity story is. That's still where the technology innovation is happening. And let's not forget that the market is energy independent. The market has a strong labor market. So in the long term, we still like the US, but over the short term, there's probably still some questions.
Okay.
Anne, can I ask you about another kind of defensiveness?
Yeah.
You've got this huge change, a paradigm shift in Europe. the era of rearmament, right? These commitments to spend more on defence. Do you think more and more that that is going to be European companies who benefit from that, as the relationship between Europe and the US turns more sour, and maybe it seems like that spending shouldn't be going to US companies? Is it possible that we're actually underestimating the benefits to European defence companies?
Yeah, that European fiscal impulse should benefit more than just European companies. If you take a step back, that fiscal impulse, yes, we know that Germany has the fiscal headroom, but it's not the same for all European countries, it's not the same for the entire region. So I think it's still an open question whether we get that synchronized, that union of growth, union of spending in terms of that fiscal impulse. I think that's still an open question.
Yeah, Europe is made up of very different economic outlooks at the moment. Be interesting to see if we can really kind of form that into one cohesive thought. Anne, nice to see you. Thanks for stopping by to join us this Friday morning. Anne Doe, Portfolio Manager at Julius Baer. Let's look at the Core 6 in Europe, give you an idea of what is happening here. It has been a bumpy week, let's put it that way, and we are watching very carefully what is happening in terms of the market moves. But as you can see this morning, starting to unwind some of the gains that Europe has generated. Big names, LVMH, Novo Nordisk, ASML, they're all big names there, aren't they? And they're all under a little bit of pressure. And that takes us to some of the pressure that maybe is going to come out of the United States a little bit later on. Did you see what Nike had to say last night? Did you see what FedEx had to say right now? Let's dig in to some of the pre-market movers stateside with Valerie.
Guy, let's start off there with FedEx. They came out with a profit warning. They reduced their guidance for the full year ahead, and it's actually now the third quarter in a row that they have done so. They cited some weakness in their higher margin business-to-business volumes. The CEO said that there is a uncertain outlook on demand moving forward. Commenting again around the heightened uncertainty for the U.S. economy. Moving on to Nike, those shares also moving lower. The CEO is struggling with his turnaround plan, this glut of inventories. He also noted that margins are due to come under pressure in the first quarter. He noted specifically tariffs on China and Mexico causing some margin pressure for Nike. Those shares are down 4.3% in the pre-market. Lastly, Micron, some good news here, gave an upbeat sales forecast, mostly due by a boost to AI demand. Their high bandwidth memory chips saw some decent sales for the first quarter. Those are the ones used in data centers, Guy. They also said they're on track for record revenue for the year. That's Micron Technology, up around 1% so far this morning.
Thanks for the update, Valerie. Thank you very much indeed. Coming up, we're going to continue our coverage of what is happening at Heathrow. The London Fire Brigade, within the last couple of minutes, says that it has brought the fire at the electrical substation under control. This is the electrical substation that has caused such chaos, though, closing Europe's busiest airport. You're looking at a live shot coming from West London. We will bring you the latest updates from Heathrow in a few minutes' time. This is Bloomberg.
Listen carefully. Can you hear the rhythm in the markets? Not just in the syncopations triggered by inflation, but in the preludes leading to global elections, in the dissonance that moves the Nikkei, and the rising course conducted by AI. There's music in the markets, and if you want to learn to listen for it, we'll show you how.
Get your fixed income fix. Watch Bloomberg Real Yield around the world right here on Bloomberg. Context changes everything. Bloomberg has the Fed decision under surveillance with the fastest coverage and exclusive analysis, including Powell's press conference. Nobody covers the Fed like Bloomberg. Welcome to the world of decentralized finance.
Massive outperformance from Bitcoin.
Bloomberg is covering all things crypto, the people,
the tectonic shift emanating from Washington.
All we're looking for is clear rules and an ability to build in the United States.
Crypto shouldn't be partisan.
the transactions,
Really a record-breaking moment.
Crypto VC is back.
and the technology.
It's really the beginning of a global on-chain economy.
And if America doesn't embrace it, we're going to be left behind.
Bloomberg Crypto, only on Bloomberg.
U.S. tech is influencing global markets.
Technology is driving business across Europe.
Companies in Asia are betting on tech.
Jumpstart your trading day on Bloomberg Open Interest.
2 hours of single stock stories that are driving the opening bell action. We'll take you to Wall Street, Main Street, the C-suite, and beyond.
These are companies that are growing their market.
The great companies in the U.S. are the companies hitting the cutting edge. That's a different story.
Get the inside track on what's buzzing in markets.
With the players who are shaping the narrative.
If you have bad earnings reports, you're going to get punished.
They're not buying what the industry is selling. Join us on Bloomberg Open Interest every trading day, only on Bloomberg.
Friday morning, good morning, welcome back. European equities are softer. We're up on the week, but we're down on the day. We are seeing a negative picture emerging as well over in the United States. I'm just looking at kind of what we're looking at there. Looks like it's going to be a slow start to the session stateside as well. Plus, we've got witching that we need to work our way through in the options market. So we're actually setting up for what could be a fairly busy day from a market perspective, I would argue. In terms of what else is going on elsewhere, obviously the biggest story that we're watching so carefully this morning is what is happening at Heathrow. Airline stocks, unsurprisingly, under pressure. IAG, the owner of British Airways, is the most affected. Heathrow Airport has been shut down. It has been shut down all day. It will be shut down all day. There's been a fire that's caused a power outage. The fire brigade is now saying that that is under control. I want to go to Alex Morgan. He is at Heathrow and joins us now with the latest. Alex, so we understand the fire is under control. What does that mean in terms of what happens next?
Well, Guy, that's a good question, and we're getting that update in the last few minutes from the London Fire Brigade. They saying they dispatched around 10 fire engines, 70 firefighters to this major blaze at a substation in Hayes. That's just nearby the airport. Obviously, it took off a lot of local homes, took them off the grid as well. They're saying that fire is now under control. The investigation begins, as in how did this happen? How could it take Europe's busiest airport offline for an entire day? An unprecedented closure. There's no sign that the fire being under control is going to have any change to bring it forward the time which Heathrow will open. It is set to be closed all the way through today. That's going to have a massive impact through the weekend, of course, because Heathrow typically has around 1,400 flights a day. There are around 200,000 passengers coming through here. That's now obviously going to be delayed, not just today, but obviously tomorrow and the day after, because those aircraft, around 120 that were in the air at the time of the closure, they've got to be repositioned. The other flights have to be repositioned. We're going to see days of disruption. Bearing in mind, just a few hours of air traffic control delays can often lead to days of disruption. So, Guy, while the fire might be under control, there's no sign that's going to ease up in terms of the opening time at Heathrow today.
Alex, thanks for the update. You'll continue to keep us updated. Thank you very much indeed for that. Alex Morgan joining us from Heathrow in West London.
What did you say, Guy? The airline shares are down this morning. IAG absolutely feeling most of the pain, down 3.2%, but the same for the likes of Lufthansa and Air France. The other stock that is in the red this morning for another day is UBS, after a Bloomberg scoop that UBS is examining the potential relocation of its headquarters if Switzerland does stick to this demand that the lender should hold an extra $25 billion of capital. And we can get more on this now with Nicholas Comfort, our European finance and regulation reporter based out of Frankfurt. Thank you, Nick. I mean, why is UBS threatening this move? Is it just a threat? Is it just a lobbying device? Or is there a realistic alternative HQ for the bank?
So first off, I mean, the reason they're threatening this is clearly the capital requirement that would come on top. So the Swiss have been notorious for always having what they refer to as a Swiss finish, i.e. sort of they're a little bit sort of a stronger requirement than in other jurisdictions. But this 25 billion, if implemented as described, would really go a lot further than what other big banks face. And so I think from the UBS side, it's probably pure mathematics. They're just saying sort of like, we cannot compete if this is our cost of capital, if this is how expensive then the knock-on effect would be for our loans, for our services. And so that's the threat they're making. I think the word lobbying is very appropriate here. I mean, we're in the kind of the hot stretch of these rules being hammered out. So in May, we're expecting this to be put to the Swiss Parliament. And so clearly, like, UBS wants to get across its perspective here and be saying sort of that it's detrimental, and to sway the politicians, if even they haven't been able to sway the regulators. Just on Monday, we had an interview with FINMA, the Swiss regulator, and they're really sticking to their guns, only offering a kind of well, they see it as a concession. The UBS side do not see it as a concession in terms of phasing in, slowly, gradually applying the rules rather than one big bang at the beginning. But that doesn't go far enough for UBS.
What would this mean for A, Switzerland, and B, any other jurisdiction that would be prepared to take UBS? UBS is huge. Presumably other regions, other jurisdictions would have some caution when it comes to such a move.
Very good point. So, I mean, depending on how it would be structured, if this was to happen, then, I mean, the question on Swiss politicians' minds would be, is there still going to be credit flowing from our biggest bank to our companies, to our consumers? Now, it's an attractive market. I would doubt that if this was to happen, that there would be any kind of wholesale departure from the lending market in Switzerland. But yeah, the flip side is much more interesting. What about the other jurisdictions that UBS would be looking to move to? Clearly, there's three big options. You've got the US, you've got Asia, and you've got Europe. Now, the US has become a lot more private industry friendly under the current administration, so that might be attractive. Also, a little bit of turmoil there as well. Asia is a big focus for UBS in terms of the wealth management business, so there's an attractive angle there too. But again, the regulators, having this whopping great bank move into your backyard, I mean, clearly they would give UBS a hard time as well. And I'd say the onboarding procedure would be very, very strenuous. And so it would not be smooth sailing to move to another jurisdiction either, Guy.
So, Nick, how do you see this playing out? We had the CEO, Sergio Motti, telling us previously that they're going to make the case for a change to these rules until the very last minute. How much flex is there in these rules from the regulator? Where does this end? How long does it go on for?
I think my personal view would be there will be some kind of a compromise in the end because each party has something to gain here as well. I mean, let's not forget that the S in UBS used to stand for Switzerland. Union Bank of Switzerland was one of their predecessor companies. So much of their identity and their brand and what they can offer to clients is kind of linked to the stability of Switzerland and discretion of the Swiss bankers. And so for wealth management, UBS's core business, Switzerland is a major asset. And so, I mean, that clearly has to be pushing the UBS side towards a compromise there too. The regulators, maybe they're talking tough on this at the moment. Like I said, the FINMA interview we had, they were not open to compromising too much. But maybe the politicians at the end will be the ones who kind of pull us into an area which is something which both the regulator and UBS can live with.
Okay, Bloomberg's Nicholas Comfort in Frankfurt. We thank you for the scoop as we look at those shares in the red again for UBS this morning. I want to turn to another stock that's struggling in the pre-market, and that is Nike. Those shares down 4.4% as things stand. And this is because Nike's turnaround efforts are hitting snags as the company tries to clear out old inventory while feeling the effects of the growing trade war. Which company isn't feeling that? We can get more now with Andrea Felsted from Bloomberg Opinion, who I know has got some pretty strong opinions about Nike traders. But Andrea, first of all, just tell us, what does this set of earnings tell us about Nike's turnaround, how it's going with the new CEO?
It tells us it's going to be slow. I'm not sure if it's hit a snag, but it's definitely going to be slow. I mean, they told us that Q4 sales will be down by a mid-teen percentage. The gross margin could be down by as much as 5 percentage points. You know, it's clearing out this inventory. Interesting, it said it thought the Air Force One had now stabilised, but it still had too many Nike Jordans and too many Nike Dunks. So it's got to really get rid of these overexposed franchises, these sneakers that everybody had and suddenly they've gone out of fashion before it can really bring in its new products.
So it's reorganising around sports, basically.
That's right,
So football, basketball, etc., etc.
Exactly.
It's focusing much more on sort of the athleticism of the product rather than the fashion of the product. We're already starting to see the effects of that. What kind of products are we seeing coming out? What are they giving us in terms of the idea about where ultimately the brand will be?
They're giving us some, you know, more running trainers. They're trying to connect with retailers. They're trying to reconnect with athletes, particularly running, where they've come under pressure. But these things will take time. There are some coming out at the moment. More will come out. In the meantime, you've got Adidas taking a very different approach. It's much more focused. It's much more focused on fashion, and it's using its brand desirability to then move back into performance. And it's also picked out running as another growth area. So it's going to be a lot of competition.
Do you know what they need?
What?
Rishi Sunak. They need him to wear a pair of those kill shots. He was the famous ambassador.
So you bring up kill shots. So Andrea wrote a piece yesterday. Everybody's asking the question, what's the next Samba? Andrea Felstead apparently has the kill shot, the Nike kill shot. Yeah, this is a tennis trainer.
Yes, I'll tell you how this came about. I've become absolutely obsessed with people's feet and looking at what trainers they're wearing. And I just noticed in real life and on social media that there's a few more retro Nikes popping up. So I thought, well, I'll have a dig around. Is this showing up anywhere? And it did show up that on social media, the kill shot seems to be doing particularly well. And they were both very strong, the Samba and the kill shot, about the same time. But whereas the Samba's sort of decelerating, that's quite clear. Yeah. The kill shot's continuing to build. Now, there's often a bit of a lag between when things show up on social media and when they show up, you know, in sales, etc. But there's a few of these retro models that are starting to work. But, you know, Adidas isn't going down without the fight. So the new one that everyone's talking about is the Taekwondo. And these are very, very low on the ankle. They've almost got no soles, like a barefoot sneaker. And Adidas are putting a lot of focus on that. That's already being tipped as the sneaker of the year.
But how much
so Nike's got competition.
Can it be, yeah, but how much of a focus can it be on sports if you're going to collaborate with Kim Kardashian and Skims?
Exactly. Now, they're saying that is performance, body sculpting, but these brands, my view is these brands are fashion brands. Okay, you can have performance, you can have athletes, they are fashion brands. And, you know, when you go to Zara, you don't just have one thing that's big. They're already working on what's coming next, what's coming next, what's coming up. And Adidas really seems, Bjorn Golden really seems to get this. He seems to have a pipeline of products. And I think Elliot Hill's catching on, so let's see if he can do it.
Got my eye on a pair of Miu Miu trainers, Andrea. Maybe this weekend.
The fondable trends.
Okay. This conversation needs to stop right now. I don't know what you're talking about. Anyway, we're going to back to the markets in a moment. Rob Arnott's going to join us. This is Bloomberg.
What is the issue between the type of information that's being collected by investors and the marking issue that you're describing?
What mark-to-market assets do is it forces honesty into the situation. We're talking right after the DeepSeek model surprised everybody in its efficiency. It took hundreds of billions off of market caps because it legitimately raised concerns that maybe the future of AI was different. I guarantee you that if you look at other portfolios that aren't marked, they didn't move. If private assets are going to eat the world, as they say, with the equity market halving in the number of names, you come to a world that is increasingly an echo chamber. Imagine you have a firm that has some public assets and some private assets. If you see your public assets in AI going down by 20%, you're going to be thinking very, very deeply about what your private assets are worth differently than someone who just has the latter.
From our studios in New York and San Francisco, our expert hosts have the data and analysis from the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action. Live every weekday, only on Bloomberg Television. Context changes everything. It's the world's second largest economy with a growing influence in global affairs. Bloomberg The China Show brings you the unmatched expertise you need to keep track of breaking news, in-depth market analysis, and the most influential newsmakers in and around China.
We need to do more to engage the market more.
We're risk on. I think we caught a little sweet spot.
Massive savings right now.
It's already a different game.
Bloomberg The China Show. Weekdays around the world, right here on Bloomberg. Context changes everything. Bloomberg Surveillance covers the latest in global markets and the political events that influence your world. Join Jonathan Farrow, Lisa Abramowitz, and Anne-Marie Hordern. Only on Bloomberg. Context changes everything.
Minutes into the equity session here in Europe this Friday morning. It's negative. It's actually in certain markets quite negative. So as you can see, you are looking at some markets that are down. Let's call it circa 1%, 3/4 of 1% to 1%. That's the picture in Europe. There's a story in Turkey that's probably worth drawing attention to. I just wonder if there's a connection here. Turkish stocks are getting hit pretty hard again. You've got fresh halts once again in that market. You did see a ripple effect Wednesday into European assets as a result of that. So Turkish banks are down, let's call it circa 9-10% at the moment in terms of the performance we're seeing there. I draw your attention to it because it's one of those things that just at the margin may have some kind of an effect. Just give you an idea of what is happening there. You can see some of the numbers on the screen for you. The central bank is trying to step into the market as well to have an effect on what is happening with the lira. In terms of what that means for US futures, I'm not sure there's a big read across at the moment. I think there's a bigger reaction this morning in terms of Nike and FedEx in terms of what we're seeing in the numbers out of the United States today. You've also got a big options expiry coming up. That's going to be a factor in terms of the session a little bit later on as well. At the moment, the S&P over the last 4 days, Monday, Tuesday, Wednesday, Thursday, up by around 0.4%. So the margin in terms of producing another negative week is small. We could see one. So there's not much erosion required to generate another negative week. So that's kind of the setup into this Friday morning. Perfect person to talk to, Rob Arnott's, founder and chair of Research Affiliates, sitting around the table with us this morning in London. For how long, we don't know yet. We'll see over the next few hours. Nice to see you.
Good to see you.
What do you make of the world right now? We're in a position where it does seem as if US exceptionalism is coming to a close, and I'm wondering what you think the implications of that are.
Well, one of the things that I think gets overlooked, how many of the people in the corridors of power around Europe and elsewhere in the world have read Art of War? That is Donald Trump's Bible. And anyone who's dealing with him who hasn't read Art of War is making a terrible mistake to not do his or her homework.
Subdue the enemy without fighting.
Yes.
You can quote from it, which is slightly alarming.
Yes. Very good, Lizzie.
Guy.
Yeah. We'll probably throw a bit of Machiavellian as well, just to kind of get a bit of the prince into the story as well. We're not sure we go quite that far.
So the EU puts a 50% tariff on U.S. whiskey, and Trump says, fine, and 200% on European wine and spirits.
Yeah.
But so are you saying he doesn't mean it?
Oh, no. I'm saying that if he gets the EU to back off, then he's won the skirmish without having to fire a shot.
There's a long-term effect, though, of the instability that he's creating for the U.S. economy.
I think it's crazy that Wall Street economists spend a lot of time trying to model what tariffs will do to the GDP, to unemployment, to inflation, when they change day to day. The one thing you can have confidence in is that we're going to see more volatility. And more volatility you can model. More volatility usually means somewhat of a retreat to safety. And a desire to have a margin of safety in your portfolio, which usually means value beats growth.
Yeah, we're going to come on to the value and growth in just a minute. We've got a wait-and-see economy. I think this is what Torsten Slog at Apollo talks about. Everybody's sitting on their hands and nobody's doing anything. To a certain extent, that is true in the markets, but it certainly appears to be, judging by the data, true in the economy.
Yes.
You get a recession in the States. What do you think broadly happens to U.S. stocks from here? We're already down. Do you think there is further to fall?
I think the market can be selective on the way down. One of the things that's fascinating, a lesson of the dot-com bubble, is it burst almost exactly 25 years ago. The first 2 years after the bubble began to burst, from March of 2000 to March of 2002, the S&P was down 27%. NASDAQ was down 50 on its way to being down 80. And so what about Russell 1000 value? It was down 4. What about Russell 2000? It was up 3. What about Russell 2000 value? It was up 53. Meaning that if you had the foresight to pivot from frothy NASDAQ companies into deeply out of favor small cap value, you were 3 times as rich in 2 years as the person who stayed the course with NASDAQ.
Sounds like he's suggesting maybe we should buy value stocks. Rob suggesting value stocks?
It's possible that I think they're a good deal.
Let me ask you guys' favourite question here, though. So can Europe kind of decouple from the misery stateside? How much of an effect do you see reading through into European stocks? Can it power its own?
European stocks are cheap. They're priced to offer pretty good forward-looking returns. We were known as the inventors of fundamental index. Fundamental index in Europe has a dividend yield of 4.5%. In emerging markets, 5.2%. You can buy half the world's GDP with a dividend yield of 5.2% and participate in the growth of emerging markets economies. That's pretty cool. You can get 4.5% in Europe if you use fundamental weighting as opposed to cap weighting. Even cap weighting has a pretty respectable yield. So I look on a lot of these markets as having that margin of safety. If there is a bear market in U.S. tech, it doesn't necessarily have to be a take no prisoners bear market. Bear markets fall into 2 camps: the bursting of a bubble, the dot-com bear market, and a financial crisis. Financial crisis bear markets take no prisoners. I don't see that as being terribly likely in this environment. Now, roll the clock forward. If countries continue to recklessly spend and build up debt, there will be another financial crisis. Just don't know when.
But you think this is more of a fundamental bread and butter economic rollover that is what we're looking at here, despite the fact that it's got a sort of tariff impetus that is feeling pro-cyclical.
Yeah. And the tariffs... It's interesting. Malay has proposed that the U.S. and Argentina, little Argentina, do a reciprocal zero tariff deal on everything. Now, wouldn't it be interesting if Trump says, I'm doing trade war with allies in Europe and allies north of the border in Canada because we're not getting enough respect there, and we're going to do a zero tariff deal with little Argentina. Well, that would be an interesting statement. I don't think the tariffs for him are the end goal. I think getting equal treatment is ultimately his end goal. Yes, he likes tariffs, but the tariffs are used as a blunt instrument, a cudgel, to get his way.
What about Little Britain, which seemingly might escape these tariffs for now? I was looking back, in 2021, Rob, you wrote that UK value stocks may be the trade of the decade. And
yes, I did.
Do you still agree with that?
I still believe that. Trade of a decade is not necessarily something that happens instantly, but UK is relatively cheap. It's been dismissed by the markets as a country going into decline. But I know lots of people here who are smart, entrepreneurial, energetic, and this is a country that can flourish. But it's stubbed its toe a little bit, shall we say.
There's a chancellor, I think, that would like to meet you and talk about those things. Can I take you back to the States? Small caps. Why should small caps outperform if we see an economic rollover? It seems slightly counterintuitive.
It might seem counterintuitive, but what's cheap has that margin of safety. And the spread in valuation between growth and value, as is well known, is very nearly the widest in history. The spread in valuation, less well known, between small cap and large cap is very near the largest in history. So small cap value is particularly, extraordinarily cheap relative to large cap growth.
But what we're seeing at the moment so far this year is that small cap is underperforming.
Of course.
Massively.
That's short term. I'm a long-term focused person. I look ahead 5 to 10 years. And on a 5 to 10 year basis, I see very little likelihood that small cap value can possibly underperform large cap growth. The valuation spreads are too wide. One of the things that's interesting is when people look at performance, they don't disaggregate how much of the performance is due to the underlying businesses struggling and how much of it is due to the assets getting cheaper relative to their fundamentals. I call it revaluation alpha. And revaluation alpha can affect big markets, U.S. versus Europe. It can affect categories of stocks, large growth versus small value. The underperformance of small value relative to large growth over the last 2 years has been remarkable, but almost 100% of it is due to small value getting cheaper relative to its fundamentals, and large growth getting more expensive relative to its fundamentals. That's that revaluation alpha is something that when you see it, you're tempted to say, get me out of here, this is bad. But if you look at the relative valuations, you say, oh, the entire drawdown is due to getting cheaper, and that can reverse.
You're going to get in trouble with Lizzie Burden. She doesn't like the use of Greeks.
I do not like the use of Greeks, unfortunately. I've banned Guy from speaking Greek on this programme. Shall I attempt a bit? Where you've got next, where you have, bet on these deleted stocks, it's particularly niche, right?
Yes.
I think I've read you find these reject stocks outperform by 5% annually. How persistent do you think that alpha is going to be in this ETF format then? I mean, how scalable is this if you're looking at it in a public ETF format rather than in a private portfolio?
The recovery and performance of stocks that have been kicked out of indexes is something that I would describe as reliably unreliable. If you go back historically over the last 30 years, stocks that are kicked out of indexes tend to beat those indexes in the aftermath of being kicked out only roughly half of the time. About half of the individual years the deletions win. But when they underperform by an average of 5%. When they outperform by an average of 18%. That's what I mean by unreliably reliable. What you find is that when they snap back, the snapback can be prodigious. So I like that you describe it as a niche idea, because it is a niche idea. Dave Nadig, when he learned of the idea, said, oh, it's a completion strategy. It completes investments in the S&P or the Russell Index, because you're picking up what they just tossed out. The difference with deletions, the stocks are by definition small cap. And by definition, value, because they got kicked out because they plunged. Now, small cap value has a long history of outperforming large cap growth, but very unreliably. And the difference between these small cap value stocks and the broad swath of small cap value stocks is that they've once been successful. They know how they got there. I wrote the paper Nixed, The Upside of Getting Dumped. Most of us, I'm sure not you ever, have been dumped once or twice in our lives. And you can wallow in self-pity for life, or you can say, I want to learn some lessons, I want to make better choices, and I want to be a better person. A company that's kicked out can do the same thing. It can say, I know how to succeed, let me regain my mojo. And some of them do.
We like to have contrarians on the show.
Absolutely. Rob, great to see you. I hope your journey home goes well. You're flying back Sunday, yeah?
Flying back Sunday. I'm hoping that the fire doesn't have ripple effects through to Sunday.
We'll hopefully get Heathrow sorted out by then, as you say.
Thoughts and prayers with you, Rob. Rob Arnott, founder and chairman of Research Affiliates, with us around the table. We thank you. Coming up, we're going to have the latest on the day-long closure of Europe's busiest airport, Heathrow. And our weekly doc looks at how BP learned to love oil again. Following the environmental catastrophe, corporate missteps and plain bad luck, BP has been lagging behind its peers. Now it's scrambling to re-embrace fossil fuels, all while an activist investor circles. But is it too little too late? You can watch the full documentary on the Bloomberg terminal.
The cost of living crisis, scorching heat wave,
natural disasters. How much worse could it get? It's really no surprise the term schadenfreude gets thrown around when an oil company is seen to be suffering.
They want their profit at all costs, at the expense of our people and our lives.
And right now, BP is really suffering.
They lost a lot of money, and they lost the faith of a lot of investors.
And 15 years ago, it lost a catastrophic amount of oil. And a litany of boardroom disasters since then haven't made things any easier. And it's attracted something unprecedented.
Bloomberg has learned that activist investor Elliott Management has built a significant stake in British oil major BP.
Even a couple of decades ago, the idea of an American investor taking a stake and forcing the company to rehaul its entire strategy would be pretty much unthinkable.
Yet that's where BP finds itself, amid a fractious realm of competitive disadvantages and a geopolitical outlook fraught with uncertainty.
What about quantum computing? People talk about that. Is that something that I should be looking at investing in?
I've made a lot of mistakes, betting on these new technologies like AR, VR turns out to be not so big, 3D printing turns out to be not so big. My estimate is $100 trillion was invested in today's dollar in the PC, CPU-based infrastructure. All this is going to get ripped out to put $100 trillion or more in now a GPU-based infrastructure. In that sort of quantum of numbers, I feel that the quantum computing is going to be very small.
You always are worried about, I presume, geopolitical events. So are there some geopolitical events you're worried about right now?
Yes. I don't know why, but for some reason, I love thinking about black swans. And at the office, everybody thinks I'm weird because I'm always thinking about what can go wrong. But underpinning the AI is the chips. And the chips, despite the CHIP Act, which I think was a good idea for the US, I still think like 80% or so of the capex of TSM is in Taiwan. And so at the leading edge, a lot of capacity is in one very small area. Forget that it's just in China, it's in a very small area. I think that's very risky.
Always on the heartbeat of the tech sector.
Spread across global markets.
The real-time data aspect is going to be important.
We're going to bring you expert analysis on that. Sure.
Don't miss Bloomberg's interview with the
Bringing you up-to-the-minute
geopolitical news whenever and wherever it happens. I'm David Gura in Rio de Janeiro, Brazil, and this is Bloomberg.
Airline stocks are under a little bit of pressure, understandably, given what is happening at Heathrow. IAG is the centre of attention. It is down, as you can see, by 3.6%. It operates basically half the flights in and out of Heathrow on a daily basis, as a result of which the outage that we're seeing at Europe's busiest airport is going to affect it the most. Let's get the latest on what we can expect throughout the rest of the day and the weekend. Alex Morgan is at Heathrow for us. Alex, we understand the fire is out, but it's likely the closure is going to last all day.
Yeah, Guy, the fire is out. The London Fire Brigade saying now the investigation begins. This was a fire at a power substation, which meant the airport obviously lost its power, local homes as well. It's taken the airport offline until at least midnight tonight. Now, speaking to some of our colleagues on the Bloomberg Global Aviation team, sort of looking at the words used for this, they're saying unprecedented. This is a full-day closure for what, last year was the world's 4th busiest airport. It's Europe's busiest airport. These are really busy times. So we're looking now at sort of, 3 parts. The first is, of course, the 120 aircraft which were in the air heading to Heathrow, which had to turn around when the closure happened. Next, you've got today, around 1,300 flights we think are going to be disrupted, as according to data from the flight tracking site Flight Radar. Then you've got tomorrow, the next day, and the day after. Heathrow is not yet able to say when power will be reliably restored. Airlines will be thinking about where to position their planes, their people, and their passengers. So we're looking at days of disruption well into next week. But for today, Guy, it's clear. The fire might be out. The closure is at least until midnight. People are being urged by their airlines, by Heathrow itself, not to travel here today under any circumstances.
Yeah, you'd normally see a few aircraft taking off or landing behind Alex. The airspace is very much empty at the moment.
Yeah,
Alex Morgan
silent.
outside Heathrow Airport. It's amazing, isn't it? That's not normally something you would experience standing where you are right now. Let's talk about the long-term implications of what Alex has set up for us. Hundreds of thousands of flights, passengers. Everything is in chaos this morning. We don't know what the long-term implications of all of this are going to be, but certainly, as Alex said, it's likely to last a few days. He was mentioning the global aviation team we have here at Bloomberg. The person that leads that is Benedict Camel, and he joins us now. Benny, let's talk about what happens next and the ripple effect that spreads out from the closure of Europe's biggest airport. What does history tell us about how long it will take to get everything back online, everything back to normal?
Well, we just heard from Alex that this is probably a matter of not just today, but really into the weekend and probably into next week. We've been hearing from the likes of Emirates, from Etihad. We haven't heard from the US carriers yet. But it's the Middle East carriers that were in the air, that were disrupted, that had to land elsewhere. That's really going to put a spanner in the works for them. Etihad, for instance, had a big plane that had to land in Frankfurt. They've had diversions to places like Birmingham, like Manchester, Gatwick. If you managed to get into Gatwick Airport, you were lucky. But there are some that are really farther afield, and that's going to cause major disruptions. This is a massive airport with more than 200,000 travelers. And this is going to really cause these ripple effects. The other sort of, should we say, political ripple effect will be, how could this even happen? How can an airport as sophisticated and as sort of important as this be knocked out by a fire? Yes, a big fire, but still, they should have had redundancy systems. This comes at a time where the airport is positioning itself for expansion. It says we're ready for business, we're ready to do more. So this is not a good look for Heathrow, and that's certainly one of these other ripple effects and the questions that will be asked.
Exactly. How could 5 terminals at Europe's busiest airport be closed by one electrical substation failing because of this fire, Benny? I wonder whether the other airports are going to be rubbing their hands at this point and thinking of the opportunities that could be presented if that political argument is made that maybe Heathrow's third runway isn't a goer.
Yeah, I mean, the airport world is fiercely competitive. Heathrow is still, you know, the big gorilla in the room, as it were, in Europe, but you have Frankfurt, you have Paris, you have Amsterdam, and then farther afield, you have Dubai, you have Istanbul. All of these airports are clamoring for a piece of the action. Heathrow is still where it's at when it comes to transatlantic travel, but this is an airport that's had real issues over the last couple of years. Remember when Terminal 5 opened up, that was a really creaky process. They've had issues with their new scanners. They're probably not going to get their new scanners in on time. So this is an airport. Yes, it's big. Yes, it's sort of a main part of the infrastructure. But at the same time, a lot of things don't go right with this airport. And when they do go wrong, they go horribly wrong. So that will be very closely looked at. It's not the look that Heathrow was hoping for or that the UK was hoping for. They want to be open for business. They want to be forward-looking. And when you have this kind of an incident, it obviously sort of knocks on general consumer sort of confidence.
Benny, looking forward to the coverage from you and the rest of the team throughout the day. Been watching it very carefully already this morning. Bloomberg's Benedict Camel. Let's talk about what is happening in the markets. It's been a turbulent week for so many things.
Was turbulent a Freudian slip there, Guy?
Maybe.
Speaking
There's
of
not
airlines.
much turbulence happening this morning in terms of the aviation sector. At all.
It's a nosedive for European equities this morning. The Stoxx 600 down 0.7%, and red across the screen when it comes to the European equity indices. Val Teitel is back round the table. Val, risk on the back foot this morning.
Yeah, it seems like, look, the market has now turned its attention to the next big risk event on the horizon, which is the tariffs on April 2nd. And I think what we're seeing here is just some chips being taken off the table, some profit being taken. We saw that in Asia overnight, those China tech shares, a lot of which that have outperformed recently. Those were the big ones to have some declines. And look, you know, European stocks have outperformed this quarter. We're headed into quarter end. Maybe this is just a bit of rebalancing combined with some profit taking as we want to take some chips off the table, maybe, you know, capture some of those winners before April 2nd when anything could happen.
Sounds like Scott Bessent. Healthy.
Let's talk about witches. What's going to happen later today? So options expiry is usually a fairly major event. This one feels slightly bigger than normal.
Yeah, $4.5 trillion worth of options expiring today. These seem to just get bigger and bigger every quarter as these options markets just have gotten way more liquid recently. So when it comes to triple witching, that's options on ETFs, on indices, on single stocks, all expiring sometimes this afternoon. And look, we could be in for a bumpy session. Let's hope the S&P 500 ends the day in the green, because then it means it will snap 4 weeks of losses for the U.S. equity market.
Okay. In terms of what we're doing at the weekend, I think everybody's weekend plans have just been thrown into chaos. And you do wonder what the effect of all of this is going to be. I'm sure all kinds of people are turning out for all kinds of events that aren't now going to happen in the same way that they would have done as a result of what is happening at Heathrow. But the weekend is almost upon us. We've got a bit of rowing that we're going to be talking about later. There's a festival light in Zagreb. There are tulips in the Netherlands and free skiing that we should be watching out for this weekend as well. I hear there's some basketball that we need to be paying attention to too. But Valerie's plans have been thrown into chaos.
Yes, maybe some travel disruption on the horizon for some members of my family. But Lizzie, are you going to be watching the rowing this weekend? I heard you have had a rowing career in the past.
I can't believe someone's told you this. I know that I'm very tall, which you may not be able to appreciate on the TV, but I was a cox because I like to bark at tall men, and I now have a career doing it.
Now I understand. Now I definitely understand. But it does seem as if, the weekend may be changing in terms of its complexion as a result of what is happening at Heathrow. Anyway, you can find the weekend edition on Bloomberg. It's great new coverage that we are bringing you. Interviews, ideas, stories that are exploring all kinds of fascinating places and things to think about. Culture, life, markets, all meeting in one place. Anyway, that is it. We'll continue to update you on what is happening at Heathrow. The brief is up next. This is Bloomberg.
the edge at the end of the market day.
Big tech earnings kick off later this afternoon.
Gilead is coming out right now.
We have Take-Two numbers.
Back to the markets, right? Our bread and butter.
NVIDIA is one of the best stories in the tech space.
That actually matters a whole lot more.
It might shock some of your viewers.
You're watching The Close.
Get ahead of tomorrow's trading with The Close. Weekdays on Bloomberg. Context changes everything. It's a multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. ETF IQ, only on Bloomberg.
Good morning, good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade.
This is Bloomberg Technology.
This is the Asia trade.
This is Wall Street Week. Welcome to Balance of Power.
This is Bloomberg Television.
Listen carefully. Can you hear the rhythm in the markets? Not just in the syncopations triggered by inflation, but in the preludes leading to global elections, in the dissonance that moves the Nikkei, and the rising course conducted by AI. There's music in the markets, and if you want to learn to listen for it, we'll show you how.
From the world of politics to the world of business, Joe Matthew and Kaylee Lines deliver news, insight, and analysis live 2 times a day, every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg.
From our global headquarters in New York, I'm Ronnie Quinn. Danny Berger is on assignment. Welcome to Bloomberg Brief. Let's set your agenda. Travel chaos. London's Heathrow Airport shuts down after a nearby fire knocked out power. Thousands of passengers stranded. Critical mineral expansion. President Trump invokes emergency powers to boost production in the United States and reduce reliance on foreign imports. Europe's defence push falters. Leaders fail to agree on delivering €5 billion to secure ammunition for Ukraine. We speak to the Lithuanian president on how to drive the process forward. So let's take a look at where we stand markets-wise. Futures have turned negative now. Remember, the S&P finished down about 0.2% yesterday, bringing its year-to-date loss back to 7.8%, peak to trough from February 19th. If we turn things around, we could see the first weekly gain in 4 weeks, but as of right now, that does not look like it's going to happen. Nasdaq 100 futures down 0.4%. The Nasdaq 100 was down 0.3% yesterday. That peak to trough loss still 11.25%. Russell 2000 futures also down 0.75%. Don't forget, we're looking at significantly higher trading volume likely today thanks to triple witching, $4.5 trillion of options expiring. That may have an impact later in the afternoon. As for bonds, we are seeing those declines hold for yields, with the 10-year still at 422.52 and the 2-year at 394.38 after the Fed meeting on Wednesday sent those yields down about 10 basis points. We're also keeping an eye on Nike. It's dropping after the sportswear retailer's turnaround effort faces new hurdles as the company attempts to clear out old inventory during the growing trade war. Shares there down more than 5% pre-market. Shares of FedEx, meanwhile, also down almost 7% now as it lowers its full-year guidance for the 3rd consecutive quarter due to what it calls inflation and uncertain demand for shipments. And Micron also falling despite a strong sales forecast for the current quarter, bolstered by demand for AI products. Its chips for phones and PCs have been weaker, but it's been showing signs of recovery. Don't forget, there are 4.5 hours to go to market open, so this could all turn around. And coming up this hour, Callum Pickering of Peel Hunt and the CFO of Mercado Libre. Well, one of the world's busiest airports closed by a fire right now. Heathrow Airport in London is expected to be shut all day after a power outage nearby caused an electrical fire, affecting hundreds of thousands of travellers. Bloomberg's Alex Morgan joins us from Heathrow. So, Alex, set the scene. This substation wasn't actually at the airport, but it was close by and has shut down everything?
Yeah, I mean, it's quite extraordinary, isn't it, really? Here at Heathrow, at peak times, on average, 40 aircraft are taking off an hour. You can see now, Not a thing, not a peep. The skies are completely clear. The airport is silent. This is unprecedented. The airport has seen the disruption today to around 1,300 flights. Now, this is because of a fire at a power substation that caused an outage at Heathrow. While that fire is now under control, the airport's saying there's no time frame for when the power will be reliably restored. So there is a closure until at least midnight UK tonight. Now, of course, this had an impact for the aircraft already in the air on the way to Heathrow, around 120 flights, particularly affecting Middle Eastern carriers on the way in overnight. But now, of course, this is a major transatlantic route, of course. So now the US carriers are going to be thinking about what they're going to do with their flights. It's going to have a knock-on throughout today, and then, of course, across the weekend, as the airlines have got their aircraft and their people in the wrong places. We are looking at days of disruption. But Heathrow, I can tell you, definitely closed until midnight UK tonight. That's what we're hearing from the airport this morning.
And what is happening with the rest of the transportation infrastructure? Passengers have been diverted to other countries, in fact, France, Ireland among them. How are they getting to their destinations?
I mean, this is the question, really, and it's a huge logistical challenge. When I used that word unprecedented earlier, I didn't use it lightly. I was talking to some of our colleagues on Bloomberg Global Aviation, sort of saying a shutdown of a major airport, according to our data, the 4th busiest in the world last year. You know, asking them, what's the word you would use? They would say unprecedented. It is extraordinary for the airport to be taken offline for the whole day. Now, we're seeing some flights diverted into other airports. There's Gatwick Airport here in London. That's taking in some flights. We know some carriers have also diverted to airports in Europe. But the question, as you're saying there, is what next? What for all those people and plans that are coming up in the coming days? At the moment, I think it's fair to say the airlines are trying to answer those questions. Some people are praising the communications they're getting. Other people are frustrated on social media about not knowing what is happening. But this really is unprecedented disruption. People are encouraged to check with the airline they're traveling with, and if they're in the UK, to absolutely not come to Heathrow today.
Pretty phenomenal to see a place that sees 200,000 people going through it brought to its knees. Alex Morgan reporting there from Heathrow Airport. Thank you. Central bankers feeling stranded these days too. The BOE, BOJ and Federal Reserve all expressing uncertainty about their economies due to tariffs. It's all having an impact on their policy making, of course. Joining us now is Callum Pickering, Chief Economist at Peel Hunt. Callum, we're arguably seeing more movement in gilts and in European bond yields today after all of the decisions this week. Talk to us about the interpretation the bond market is making following the 3 major central banks and their decisions this week.
Well, I mean, as market analysts, we always like to say a central bank's hawkish, are they dovish? I think for most central banks at the moment, they're decidedly neutral, which is simply to say, we really don't know what happens next. And on the one hand, you say, well, if tariffs really knock confidence and we see weakness in consumer and producer demand, it's possible that we see some one-off effects of tariffs, but then actually a period of disinflation. So as a central banker, I'd actually be inclined to lean towards the weakness and ease. However, we've just gone through a very bitter period of inflation where essentially an external supply shock, in 2022, of course, it was gas, produced not just a one-off effect, which central banks initially had anticipated. Remember, this transitory word is now reappearing, but actually this persistent effect. So I actually think they just have to hold pat and just wait to see what the effects are.
Yeah, we're seeing quite an amount of movement in gilts. Money markets in Britain pricing in about 60 basis points of cuts by year-end. That's up from 51, but back down again today, it would seem. So is there a little bit of uncertainty in the bond market as well?
Without question. And if I think about my own calls for the Fed and the Bank of England this year, I roughly agree with money markets. I think we'll probably get 50 basis points from the Bank of England. I think they'll probably cut in May, and I think they'll cut in August. From the Fed, I think we'll get 2 cuts, probably in Q2 and Q3. But that's really the average of, with some fairly extreme potential outliers either side. And also, I think I would just keep in mind here that if we get to 4% in the UK and the US, that's still considered tight monetary policy. We're just removing some of the tightness if we stop at 4. I mean, the UK is a slow growth economy. If we get normal inflation and normal growth, probably a neutral rate is closer to maybe 3.25, 3.5. At the Fed, it might be a little bit higher. And so even markets, as they anticipate a little bit of cutting, they're still signaling that actually monetary policy needs to be tight.
The US is looking at stagflation, staring it straight in the face, it would seem, even according to the Federal Reserve chair. What is the situation if it comes to that? If we do see slowing growth and employment ticking higher, but then there's this persistent inflation, which may see a transitory bump from any tariff policy, but there is still other inflation there as well in the system.
Well, I think we need to be a little bit careful. Stagflation is, for me, something that is very serious and often overused. We mustn't exaggerate. A period of slow economic growth in the US, remember, we've just had a period of above trend economic growth for over 2 years. 3% growth is not the sustainable rate in the US, probably closer to, say, 1.8, 1.9 according to the Fed. So if we were to just undershoot just a normal business cycle slowdown to, say, 1.5%, 2% for a while with a bit of inflation, and if the so-called Doge creates a bit of unemployment, I don't think that's stagflation. Stagflation is rising unemployment, no growth, and rising inflation that leaves central banks in a bind. I don't think we're there yet. It's a risk, but it's certainly not a base case.
Callum, the push to unhook from deficit locks in Europe, does it create a two-tier Europe once again, and how long before that happens?
That's a really good question. I mean, I think we should just focus principally on the positives for now. I mean, Germany is an economy with essentially two problems. One, this deindustrialization that we've seen since 2018. We've had about a 20% fall in overall industrial output. That's because of gas prices, it's because of competition from China, it's because of a gradual loss of competition against all global producers. Germany also relies much too much on global trade. It's an economy that's designed for a period that no longer exists. That is when trade liberalization is vogue and we're able to get the supply that we need and get the energy we need and sell to who we want. And so it's necessary for Germany to rebalance towards domestic consumption. So I actually think for the next few years, what we're going to see is just better growth out of Germany. And with any luck, actually, this additional demand for the big economy in the Eurozone should prime the pump for a little bit more activity in some of those weaker economies. I think France is going to benefit. Italy might even benefit too. But 2-3 years down the line, we may run into some problems.
All right, well, let's get through 2025 first. Callum, thank you so much for joining us. That is Callum Pickering of Peel Hunt. Now, two other top stories trending on the terminal this morning. Sources say UBS is examining the potential relocation of its headquarters if Switzerland requires the bank to hold an extra $25 billion worth of capital. The bank is stepping up lobbying efforts as the proposal begins its passage through the Swiss Parliament, with a draft due to go before lawmakers in May. The Turkish lira is experiencing its largest weekly drop in nearly 2 years. The currency's decline began after the detention of the Istanbul mayor and was followed by a shock interest rate hike by the central bank. The interest rate hike aims to contain outflows from lira deposits and prevent a weaker lira from stoking inflation. And Elon Musk held an all-hands meeting with Tesla employees. He tried to reassure them that they should hang on to their stock despite what he called rocky moments and negative news. Musk addressed the company's challenges, including vandalism and political backlash. Meanwhile, shares in Tesla have plunged more than 40% so far this year, giving up gains from the stock surge that followed President Trump's inauguration. Coming up, European leaders failed to agree to a package to support Ukraine. We speak to the Lithuanian president about those efforts next. This is Bloomberg.
Jumpstart your trading day on Bloomberg Open Interest.
2 hours of single stock stories that are driving the opening bell action. We'll take you to Wall Street, Main Street, the C-suite, and beyond.
These are companies that are growing their market.
The great companies in the U.S. are the companies hitting the cutting edge. That's a different story.
Get the inside track on what's buzzing in markets.
With the players who are shaping the narrative.
If you have bad earnings reports, you're going to get punished.
They're not buying what the industry is selling. Join us on Bloomberg Open Interest. Every trading day, only on Bloomberg.
Key investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Onen, only on Bloomberg.
Bringing you
up-to-the-minute geopolitical news whenever and wherever it happens. I'm Stephen Engel at the Forbidden City in Beijing, and this is Bloomberg.
Welcome to the world of decentralized finance.
Massive outperformance from Bitcoin.
Bloomberg is covering all things crypto, the people.
The tectonic shift emanating from Washington.
All we're looking for is clear rules and an ability to build in the United States.
Crypto shouldn't be partisan.
The transactions.
Really a record-breaking moment.
Crypto VC is back.
And the technology.
It's really the beginning of a global on-chain economy.
And if America doesn't embrace it, we're going to be left behind.
Bloomberg Crypto, only on Bloomberg.
This is Bloomberg Brief. I'm Bonnie Quinn in New York. Europe's defence push for Ukraine has faltered. France and Italy have held up efforts to deliver €5 billion to secure ammunition for Ukraine this year. Ukraine's president says his country urgently needs weapons now. Let's go to Bloomberg's Oliver Cook in Brussels, who has an interview for us on all of this. Ollie.
That's right, Vonnie. Thank you so much. We've just sort of wrapped up that leaders meeting late last night, and we're here to be speaking with the Lithuanian President, Gitanas Nausėda. Thank you so much for joining us after these important talks that we've had here in Brussels over the last 24 hours. I'd like to begin, if we might, just on your reaction to what we saw earlier in this week in the conversation between President Trump and President Putin. Do you feel that this is sort of sincere and real progress towards a ceasefire? How do you interpret what we got from the two presidents?
I have no doubts that President Donald Trump is really has very frank intention to achieve the peace, to achieve the ceasefire. The same I should say about the President of Ukraine, Volodymyr Zelensky. But when it comes to Russia, I don't see this frank intention to achieve the consensus or to proceed with the negotiations. And so far, Russia is imitating the negotiations, talking about possible peace and about possible ceasefire, but they are not even ready to keep the ceasefire as promised, not to attack, not to strike the critical infrastructure of Ukraine. After the Putin promise to President Trump that he will stop the activities against the critical infrastructure, actually they were continuing these operations. It is the information provided by Ukraine, and of course it shows that the willingness of Russian Federation to get the result is very limited.
And in terms of, this is something that I'm sure took a lot of space in the conversations you had yesterday, how Europe basically gets a seat at the table. Are you concerned that basically the bilateral discussions between Trump and Putin effectively formalize Europe being sidelined? How does Europe get its seat at the table? What can it offer in these negotiations?
Europe can play a very important role, not by discussing, but by taking the decisions. And we are taking decisions. We have very clear position on strengthening the pressure on Russia. We were talking about the sanctions, 17 package of sanctions for Russia. We are talking about further and even larger military support to Ukraine. And I think those actions are most effective if we really want to proceed and to have these negotiations through strength. Because position of Europe is we have to bring Putin to the table of negotiations through strength.
And I think one of the concerns that we had from this meeting over the last 24 hours is in terms of concrete deliverables. There was, yes, the verbal support for Ukraine, but there was a failure to get to this $5 billion ammunition package. Is the sort of EU, has it reached its limit in terms of concrete short-term steps that they can deliver? And do we now need to look at that coalition of the willing spearheaded by Emmanuel Macron and Keir Starmer in order to get these deliveries to Ukraine?
I think we should wait until the meeting which will take place next week. And it's very important to have these, as you say, deliverables according to the plan led by United Kingdom and France. We are talking about possible presence, European military presence, after the ceasefire, after the peace negotiations. And my country is ready to provide the necessary support, and we are talking about very concrete numbers of our military troops, but there should be commitment of all countries participating in this coalition to provide this support. So I think the discussions will be done, but I would like to underline that Europe will play a larger role, but for that we need decisions.
And can I ask what that number is, what you're willing to commit?
We are so far in the discussions, and probably it would be too premature to mention very concrete figures. I will be ready to deliver these figures during our meetings.
And then there's also been a lot of discussion about basically the United States' willingness to defend all of its NATO allies. I understand your defense minister has recently come back from the United States. Do you have the reassurances from the U.S. administration that that is a secure proposal?
At this moment, I would say we have very positive signals that the focus of United States on eastern flank of NATO will remain strong. This is very important because, in my view, it's the best factor of deterrence. If United States will keep the presence in the eastern flank, it would deter Russia from some aggressive actions in the future. And we are ready to host even more American soldiers. We have needed infrastructure. We are ready to provide all the necessary support to them. This is a matter of political decision, and I hope very much, and I look forward that this decision will be done.
And there has been a discussion as well as expanding France's nuclear capabilities, deterrence of the nuclear umbrella. Would you be willing, would you be open, would you welcome hosting French nuclear arms within Lithuania?
Those are two separate questions. First of all, yes, umbrella itself, and deployment of nuclear equipment in the country. So far, we didn't start the discussion regarding the deployment of any nuclear weapons on the territory of Lithuania. But we are willing, and we will be willing, to discuss the possibility to use this possibility, this nuclear shield provided, or at least idea of nuclear shield for eastern flank countries, including my country. So President Macron expressed a very interesting idea. So far, we have many questions and we need answers, algorithms, how it will look like. And I think the President Macron expressed the view that probably there is a need to send experts and to discuss it at the experts level.
Great. Well, thank you so much for your time today, the President of Lithuania, Gitanas Nausėda, speaking to us just after that EU leaders meeting that's been held here in Brussels, and of course, as Ukraine's future hangs in the balance with negotiations sort of convening next week in Saudi Arabia.
An important conversation, and thanks for bringing that to us, Ollie. That is Bloomberg's Oliver Crook. This is Bloomberg.
But what about the diagnosis? If the diagnosis at the end is worries about growth rates,
yeah.
How do you get from point A to point B? Why do you worry so much about that end goal of better growth?
Because if we can't grow, you're going to have a much more inflated debt to GDP and federal deficit, and that's not good for the economy. Growth is really critical, and I think what's underappreciated is what the inputs are to get to the growth number. And so we talked a little bit about productivity. I hope that we can continue to produce at 2% indefinitely on productivity. I think that would be great. But you got to make sure you have the other levers in place, I think, to buoy that. So if you look back over the last several years, we've had 8 million immigrants come into this country in the last 4 years. And that's helped growth. And by the way, that's deflationary.
Middle East and Africa. Vibrant resources and high-yield investment opportunities abound. Join me on Horizons Middle East and Africa for the stories, newsmakers, and insight from this exciting region. Now weekdays, only on Bloomberg.
From our studios in New York and San Francisco, our expert hosts have the data and analysis from the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action. Live every weekday, only on Bloomberg Television. Context changes everything.
Time now for our front page news. First up, the FT leading with Accenture warning investors that it is already feeling the squeeze from efforts to rein in spending on federal contractors. It's one of 10 consulting firms targeted by the Trump administration in the crackdown orchestrated by Elon Musk's Doge team. The company didn't cut its full-year earnings guidance, but did admit that the new trends in the business were, quote, very recent. Next up, Bloomberg leading with President Trump invoking emergency powers to boost the ability of the U.S. to produce critical minerals. The move is a response to concerns that China controls the processing, which is used in products such as batteries and defense systems. The administration says the U.S. is import reliant on at least 15 critical minerals and that 70% of imports of rare earths come from China. And the New York Times is reporting Elon Musk would be briefed about the U.S. military's contingency planning for any potential war with China. President Trump denied the report, saying it was, quote, ridiculous and, quote, completely untrue. Defense Secretary Pete Hegseth confirmed that Musk would visit the Pentagon, but characterized the meeting as an informal discussion. A check on markets now. We are looking for futures to go green in order to have the first up week in 4, but so far that is not the case. They are lower. The 10-year yield where it was at yesterday at 4.2194.
What legacy I would love to leave is to make sure that in my village I have infrastructure. So long when I'm gone, things are still working, then I have done my job. And if some people get inspired through my work and then try to engage themselves for their community and create something that is inspiring for everyone, I will be happy.
what's the best piece of advice you would give to someone young who wants to make a difference actually in this world? In architecture or with something else?
Well, I'm not the right one to just do that.
I think you are.
Yeah, but with the pressure you have, and then you try to be the good one, the fancy guy, the intellectual one, I have no advice than to believe in yourself and really work hard. You know, when I started, no one would have imagined that I will be able to see my name connected with Aga Khan or Pritzker or sitting at Bloomberg to talk about sustainability, about future of sales. No, myself 5 years ago, if you told me that, I will say no. I will never imagine. So I will encourage everyone to believe in what you're doing and not try to run after the newest of the newest. Just be consistent. Just work on things that matters for you. Really, at the long term, it pays.
Asia is at the forefront of some of the world's biggest stories.
And we're here, where the action starts in Sydney.
And in Tokyo, get ahead as the global trading day begins.
The Asia Trade, weekdays only on Bloomberg.
Bringing you up-to-the-minute geopolitical news whenever and wherever it happens. I'm David Gura in Rio de Janeiro, Brazil, and this is Bloomberg.
From our global headquarters in New York, welcome to Bloomberg Brief. I'm Bonnie Quinn. Let's set your agenda. Travel chaos. London's Heathrow Airport shuts down after a nearby fire knocked out power. Thousands of passengers are stranded. Critical mineral expansion. President Trump invokes emergency powers to boost production in the U.S. and reduce reliance on foreign imports. Latin America e-commerce giant Mercado Libre doubles down on growth. We're going to be speaking to the CFO on how the company is disrupting the region's financial services industry. Let's first get a check on markets on Triple Witching Day, would you believe? Futures, which had been pointed a little higher, now lower, firmly in the red. S&P futures down 0.4% after the index dropped fractionally 0.2% yesterday. Nasdaq 100 futures down almost 0.5% now, and Russell 2000 futures leading the losses down 0.6%. There are, however, 4 hours to go, so we'll see if this can turn around. We are, I guess, hoping to eke out the first gain in 4 for the S&P 500. That's 4 weeks of losses if we don't indicate a gain in today's session. Yields around about where they were yesterday. Not much movement, if anything, to the downside. 421.94 on the 10-year, and we're still at 394.17 on the 2-year. So just a little bit of risk aversion in the last half hour. One of the world's busiest airports has been closed by a nearby fire. Heathrow Airport in London expected to be shut all day after a power outage at a nearby substation caused an electrical fire, and it's affecting hundreds of thousands of travellers. Bloomberg's Alex Morgan joins us now from Heathrow. Typically a very, very bustling airport. It should be open at least 3 hours now, and it's dead. Alex, what's happening?
Well, Vonnie, good morning and welcome to the world's 4th most active airport. Today, probably the quietest. This is unprecedented disruption. I mean, for Heathrow, we're looking back decades, really, to see anything like this. And in fact, analysts are saying we haven't seen it before. We're talking about disruption to hundreds of thousands of passengers, as you were saying there. But just to give you an idea, this is home to British Airways. For that airline alone, more than 600 flights affected. Virgin Atlantic as well, more than 60 flights for them. Now, those are the airlines, sort of like, for whom this is their main hub base. But of course, Heathrow is a major centre for transatlantic travel, but of course, as well to connect to the Middle East. We know that when the airport was closed because of this fire at a power substation, there were around 120 flights inbound to the airport. They had to turn around. Many diverted, some sent back, some to Europe and others to other airports in the UK. Now, the power's still off. The fire, the local authorities are saying, is under control. The situation is under control. Now the investigation begins, but it's knocked out the busiest airport in Europe. We know that's going to take place until at least midnight local time here in the UK. But then, Vonnie, the disruption, it goes on for days. You know, you've got the many Ps they're looking at. Planes. The planes are in the wrong places. The people. They're people in the wrong places. And passengers are stranded all over the globe. We're looking at days of disruption. even when they do manage to get a reliable flow of power back into the airport behind me.
It does seem odd that one substation can cause this whole airport and 200,000 passengers to be displaced and really not going anywhere. Some, as you say, in other countries trying to get to a destination. What happens next to these passengers? Will Heathrow be able to accommodate some of them even tomorrow, Sunday, Monday?
Well, I mean, yeah, this is the question. You're mentioning there, 200,000 people. That's roughly the number of passengers coming through. At peak times here at Heathrow, we're getting 40 aircraft taking off. As you can see, it's really eerily quiet. Like I say, growing up around here, you know, to see the skies completely clear, it is really off-putting. So we know that Gatwick has taken in many of the flights that were coming into Heathrow. Other airports in Europe have taken some in. But Vonnie, I mean, what we're seeing on social media, particularly if you look at travellers, many people just frustrated, wanting to know when they're going to be able to get the next flight. People arriving today, having not checked the news, getting to the airport and thinking, what am I going to do? The advice to travellers, by the way, for everybody is to check with their airlines, whether they are flying out of Heathrow or into Heathrow, or indeed just to check in general, because this will have, I feel like, a domino series of disruption. One flight missed will affect the next, will affect the next. The airlines, of course, are trying to communicate through their social channels and their websites, but people here being told, don't come to Heathrow, certainly not today, but looking into the weekend as well to check for the latest updates.
And it remains to be seen where the liability will lie. That will all come in the days and weeks to come. Alex Morgan, thank you so much. Alex reporting there from Heathrow. President Donald Trump is invoking his emergency powers to boost the ability of the United States to produce critical minerals and potentially coal. Let's go straight to Bloomberg's Kevin Whitelaw now for more details. So, Kevin, another executive order signed in the Oval Office. What consequences does this particular EO have for America's minerals output?
You know, I think it's not going to have any immediate consequences, but what it does do is show that President Donald Trump still remains very interested in trying to figure out how to boost American production of these things. And I think this is going to come as part of a broader set of efforts that are going to strip away various environmental protections and other kinds of regulation that may have made this these kinds of operations more difficult or more expensive up to now. And so I think you are looking at the potential for some projects to maybe now sort of move forward or get started, but these are all long-term projects. They all require capital, and they all require companies deciding that they're actually going to be able to get a return on investment. And so it doesn't appear this comes with any particular funding. It doesn't yet seem like there's necessarily the government hand there yet, other than clearing the way regulation-wise for things to move a lot faster. So that could make a difference on the margins, but I think beyond that, it's going to take a little while for us to see anything from them.
And we saw shares of Australia and China miners fall in today's session on this as well. Separately, Trump is denying a New York Times report that Elon Musk would be briefed by the Pentagon on any military contingency planning for any potential war with China. It's quite an extraordinary report. We do have denials, as I say. What do we know exactly about the details of the sourcing and what this report is saying?
Yeah, I do think we're still trying to sort out exactly what had been planned, and obviously the report then changed. It seems to have changed what was going to happen, but it does appear that, according to these reports, that Musk was going to get some kind of a briefing. I think the real question is just how sensitive it was, what the security clearance level of this was. But obviously, this kind of planning, the kind of contingency planning that the Pentagon does, particularly with regards to China and potential conflict, is some of the most sensitive kinds of information in the U.S. government. And so there has been real questions about what kind of security clearance process has ever really been done for Elon Musk in this. Obviously, he had some clearances related to his previous work as a contractor, but that's often a different level than some of the kinds of things you're talking about when it comes to military operational planning. I think more broadly, it continues to sort of get at this question where people don't really know what Elon Musk has access to or doesn't, what kind of accountability there is, what he's doing with that information. Remember, he's now, he runs several companies, he owns all these big businesses, and access to secret information like this actually becomes a bit of a competitive advantage from a business standpoint, and a lot of companies that he's competing against don't have that.
Kevin, just to move to a different theater, Ukraine, Russia right now, I think it's fair to say we're hitting some snags on this ceasefire on energy assets. What do we know about this deal that was agreed to, and whether anyone really believes that there is a deal in place if these energy assets continue to get hit? We're seeing that transit pipeline get hit most recently.
Well, I mean, look, I think all along you've had European leaders, you've had Ukrainian President Zelensky saying there has been no signal at all that Russia is remotely serious about this peace process. And so up to now, it does appear to be a situation where Vladimir Putin has told Trump a couple of the things he wants to hear, but enough of the caveats that make it clear nothing's actually really changing yet. So at some point, I think it's going to be up to Trump to decide whether he sees what's going on, whether he believes that Putin is indeed pursuing peace or is engaged in this process in a serious way. There have been moments where Trump has threatened Russia with more consequences if it doesn't get serious, and so at some point we may have to see what actually happens there. But on the flip side, Trump's relationship with Zelensky remains extremely fraught and increasingly transactional, as you have the president talking about, obviously not just some kind of a deal for Ukraine's mineral wealth, but even conversations now about ownership of a nuclear power plant or other things. So you are getting a sense that there's a question of Trump trying to see what kind of a stake he has in Ukraine's future.
Kevin, thank you so much, as always, for all of the context, setting us up for the day. That is Kevin of Whitelaw there in Brussels. Now to other top stories trending on the terminal this morning. Sources say UBS is examining the potential relocation of its headquarters if Switzerland requires the bank to hold an extra $25 billion worth of capital. The bank is stepping up lobbying efforts as the proposal begins its passage through the Swiss parliament, with the draft due to go before lawmakers in May. The Turkish lira is experiencing its largest weekly drop in nearly 2 years. The currency's decline began after the detention of the Istanbul mayor and was followed by a shock interest rate hike by the central bank. The interest rate increase aims to contain outflows from lira deposits and prevent a weaker lira from stoking inflation. And Elon Musk held an all-hands meeting with Tesla employees. He tried to reassure them that they should hang on to their stock despite, quote, rocky moments and negative news. Musk addressed the company's challenges, including vandalism and political backlash. Meanwhile, shares in Tesla have plunged more than 40%, giving up gains from a stock surge that followed President Trump's inauguration. Coming up, Mercado Libre's big bet on Mexico. We're going to be speaking with the CFO of the Latin America e-commerce and payments giant. That's next. This is Bloomberg.
Listen carefully. Can you hear the rhythm in the markets? Not just in the syncopations triggered by inflation, but in the preludes leading to global elections, in the dissonance that moves the Nikkei, and the rising course conducted by AI. There's music in the markets, and if you want to learn to listen for it, we'll show you how.
What about artificial intelligence? Is artificial intelligence going to enable you and others to say, we have enough information to know exactly what something is going to be worth in terms of insuring it or not?
Artificial intelligence is finding its way into our business in a variety of different factors. I think the first piece is getting much better insight into data, which allows us to make better decisions on underwriting. It's also a great opportunity to service business better in terms of like call centers and different ways of what's using robotics and other AI will be very helpful. But it is an emerging practice within the industry and one that is evolving very quickly. So it's also going to present risks that other companies, how they use it and how they use large language models and making sure the decision making is very sound. So it's complicated, but it definitely is benefiting the business today.
Morning
morning. This is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. These are the stories that set your agenda.
Taking you from the U.S. market's close to the overnight session in Asia, we'll walk you through what you need to know to kickstart Europe's trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in to Daybreak Europe, only on Bloomberg Television. Context changes everything.
This is Bloomberg Brief. I'm Vonnie Quinn in New York. Mercado Libre is doubling down on its growth in Mexico. The Latin America e-commerce and payments giant plans to invest a record $3.4 billion in the country this year. For more on their plans, I'm joined by Bloomberg's Nina Trentman, editor of CFO Briefing, our newsletter devoted to corporate finance and what leaders need to know. And so, Nina, obviously, we had results from Mercado Libre. This is a name that analysts go literally gaga for. They love this company and they continue to be surprised by some of the decisions made, but those decisions always seem to pay off.
Yeah, it's an interesting company, dubbed the Amazon of Latin America, has seen strong growth, as you pointed out, in the 19 countries in which it operates. And it's interesting to see that it has both the e-commerce arm as well as a payments arm. And so I think it's basically this virtual cycle or the loop in which they're serving both sides of the business, so to say.
Exactly. Well, let's bring in now Martin de los Santos. He is the CFO of Mercado Libre, and he joins us live from Uruguay. And Martin, thank you so much. So first of all, what are the next steps that you're going to take in order to continue with this massive growth and to surprise analysts once again?
Good morning. Thank you for having me. Pleasure being here. Yes, as you know, we operate the largest commerce and fintech platform throughout the region. As Nina mentioned, we operate in 19 different countries and we live in all of those countries. And in terms of investments, we will continue to invest in our logistic infrastructure, which is a critical competitive advantage, as well as investing in our fintech solution. As you know, Latin America is an area of large opportunities. When you look at e-commerce, penetration continues to be relatively low compared to other areas of the world with penetration of 15%. So it's like where the US was maybe 10 years ago. And in terms of fintech, it's even larger, right? When you take the example of Mexico, less than half the population in Mexico have an account, a bank account, less than 15% have a credit card. So we see a large opportunity, and we are taking advantage of that, and we are leveraging on that. Last year, we had about 100 million buyers on our e-commerce platform, 61 million monthly active users of our fintech solutions, growing at 34% year on year. So we have experienced very rapid growth. We turned 25 years last year, and we went from being a startup in a garage 25 years ago to becoming the most valuable company in Latin America. But still, when we look ahead, the opportunity continues to be very, very large for us.
Yeah, Martin, you're still growing, of course, at fast rates, similar to a startup. I'm wondering, you talked to us about your investment strategy. You're facing competition from not just Chinese e-commerce chains, but also then from Walmart. So I'm wondering, sort of, how do you know whether you're investing enough in your business?
Yeah, we face a very competitive market, both on commerce and fintech, and we compete leveraging our competitive advantages, which are, as I mentioned, the logistic infrastructure as the fintech infrastructure. And we continue to invest in increasing the penetration of fulfillment. That's an area of investment. And in Mexico, for example, we are north of 70% fulfillment penetration. That means that 70% of the products that are sold on Mercado Libre are shipped from our own warehouses. But Brazil, we're still at a little bit north of 50%. So we have plenty of more penetration to increase. So we will continue to deploy new fulfillment centers. As an example, last year, we opened 10 fulfillment centers throughout the region. And we plan to continue investing just because the user experience is much better when things are shipped from our own warehouses. We can deliver faster, we can offer more free shipping, and that results in much better conversion. And that's one of the reasons why our GMV, which is a volume transacted on Mercado Libre, has been growing very rapidly. In Q4, we grew roughly at 30% year on year, which is double the rate at which the market is growing, so we continue to gain market share.
How do you balance profits and growth? I know that you have a term for that internally that summarizes that quest that you want to do of delivering both.
This is something, Nina, that we spend a lot of time thinking about and also communicating to the market. We call it growth fit because we operate in a segment that is growing very rapidly and has very large opportunities both on commerce, on fintech, and also on advertising. So we try to balance try to strike the right balance between growth and profitability. We improved significantly our profitability over the past 5 to 6 years, and we continue to deliver very healthy margins. Having said that, the opportunities are so large that we want to make sure that we do capture those opportunities, and we do not shy away from investing behind those opportunities, even if in the short term they might put some margin pressures. So we try to communicate our long-term vision to the market, but like you said, the critical thing is to maintain this growth fit mentality that we have, which is to look for growth, for the long-term growth of the company, while at the same time making sure that we invest wisely and we maintain healthy profit margins.
Martin, a couple of individual challenges, and I wonder how you're approaching them. Brazil is set to increase interest rates, perhaps quite substantially, and Argentina is set to drastically cut spending. How do you think about those macro impacts on your business?
Yeah, over time, we have seen that the trend of people moving online and the digitalization of payments and finance is much stronger force than the actual macro situation. We face many different macro situations throughout the years in Latin America, but obviously, when macro performs well, we do better. But even if macro is a little bit challenging, we're still, grow because it's much more important what we do in our platform, improving the user experience. The 18,000 developers that we have working on our product are a lot more important than maybe 1 or 2 percentage points of interest rates increasing. But specifically in Brazil, the health of our marketplace and the fintech, our credit book, for instance, is very healthy. I mean, we haven't seen any negative trends yet, but obviously we are very cautious and observing the situation. In Argentina, it's the opposite. In Argentina, we have seen strong recovery on the second half of the year, both on fintech as well as commerce. So we are very optimistic about the macro situation in Argentina so far.
Martin, you're based here in the U.S., domiciled in Delaware and listed on the U.S. stock exchange. Wondering how you're thinking about the return of Donald Trump to the presidency. Is that impacting your business at all or not so much?
Not significantly, Lina. We are listed in the U.S., but all of our operations is in Latin America, except for we have a fulfillment facility in the U.S. where we have American merchants selling into Mexico and Latin America. So we are not necessarily affected by tariffs, for instance. We do not export anything into the U.S. So there's no direct implication in our business. And like I said, I think the most important thing is a trend of people moving online. I would play an important role as leaders on e-commerce on bringing people online. And the same thing with fintech, right? The most important thing is the digitalization of payments, the democratization of fintech products that we're doing in Latin America, a lot more than macro trends or even the measures being taken in the U.S.
Martin, I'm so curious. One analyst said that you often double down on capital allocation decisions that sparked doubts and triggered sharp sell-offs in the stock, but then ultimately paid off. Who do you model yourself after? Who is your CEO, CFO team whose strategic and capital allocation decisions you admire most?
I think it's hard to put a name. Obviously, we take inspiration of many people and many companies, right, throughout the world. We pay a lot of attention of the trends on commerce, technology in particular. I think the most important thing and the success of Mercado Libre is based on its culture. The fact that we continue to have, even after 25 years, a startup mentality. We continue to think for the long term. We're never satisfied with our own product. We keep on improving it and trying to provide a better user experience. When things don't work out in a region, we build it ourselves. The case of logistics, where 10 years ago, we relied on local carriers. And when we realized that we couldn't give the service that we desired, we built our own fulfillment infrastructure. And today, 98% of products are sent directly from our own fulfillment logistics infrastructure. So I think it's mostly, thinking the long term, being resilient, and making sure that we hire people that share the culture that we have at the company of executing with excellence and so on. So I think I would say culture makes a big difference in our company.
Well, it's certainly paying off for the stock. MELI is the ticker, and it hit an all-time high yesterday, up more than 30% year over year. Our thanks to you, Martin de los Santos of Mercado Libre, and of course, Bloomberg's Nina Trentman. And you can subscribe to Nina's CFO briefing newsletter. You should, in fact, at bloomberg.com/newsletters.
From the beating heart of global finance, economics, and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. What do you think the future is for inflation? Is this a new normal? Are markets too optimistic? How do you worry about the things that are outside your control? How does the current fighting completely stop? I'm Francine Lacqua, and this is The Pulse, every weekday only on Bloomberg.
U.S. jobs numbers are released. Bloomberg has the report under surveillance with crucial data and expert analysis at terminal speed. Nobody covers Jobs Day like Bloomberg. From the world of politics to the world of business, Joe Matthew and Kaylee Lines deliver news, insight, and analysis live 2 times a day, every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg.
Jumpstart your trading day on Bloomberg Open Interest.
2 hours of single stock stories that are driving the opening bell action.
We'll take you to Wall Street, Main Street, the C-suite, and beyond.
These are companies that are growing their market.
The great companies in the U.S. are the companies hitting the cutting edge. That's a different story.
Get the inside track on what's buzzing in markets.
With the players who are shaping the narrative.
If you have bad earnings reports, you're going to get punished.
They're not buying what the industry is selling. Join us on Bloomberg Open Interest. Every trading day, only on Bloomberg.
Bringing you up-to-the-minute tech news whenever and wherever it happens. I'm Ed Ludlow in Las Vegas, and this is Bloomberg.
Now let's take a look at what's ahead today, apart from the fact that it's Friday, of course, which is an event in itself. We have New York Fed John Williams speaking at 9 a.m. Eastern, plus cruise company Carnival reporting earnings before the opening bell. And it's Triple Witching Day. About $4.5 trillion worth of options contracts are set to expire. Let's have a quick look at some movers. Nike dropping in the pre-market as the sportswear retailer gives a subdued outlook. We have FedEx sinking as well after it cut its full-year guidance again. And Micron falling despite a strong sales forecast for the current quarter, bolstered by demand for AI products. It was up in the post-market trading after it reported yesterday. Take a quick look at where we are futures-wise. We are down still on the S&P 500, hoping perhaps for an update to counteract those 4 weeks of declines. And a quick programming note, because of daylight savings time, Bloomberg Brief will be back Monday, March 31st at 5 a.m. Eastern, 10 a.m. London time.
Davos, you were asking a question of President Trump, and he didn't quite answer the question, and he asked you a question. So the question he asked you was something like, why are you not banking certain groups? What is the answer? I don't think he gave you a chance to really answer that question, but what is the answer to that question?
Well, first off, the Bank of America has 70 million consumer customers and millions of small businesses all over the country, all over the world. And so we bank everybody. But the real question was about overregulation, frankly. And so as you look, what's happened is because the interpretations of AML, anti-money laundering, BSA, Bank Secrecy Act, KYC, know your customer's customer. You know, there's a lot of burden upon the banking system to both report suspicious activity reports and do a lot of analysis. And we have to close accounts, so we can't tell people why we did it. And often we're told by authorities to close accounts. That creates confusion. Another area comes up in this discussion is in the crypto area where the regulators said you can't bank crypto operating companies, employees of crypto companies, et cetera. We are allowed to do, we bank everybody, but the operating company, they said that's a high-risk activity. Ask us for authority, and guess what? You would have never gotten the authority. So that came up as an issue. So at the end of the day, it's about getting these regulations right.
Has the Fed decision under surveillance with the fastest coverage and exclusive analysis, including Powell's press conference. Nobody covers the Fed like Bloomberg.
We're in the midst of a pretty significant set of shocks.
The elements that normally tip bull markets into bear markets are not present. The biggest challenge, though, is how policy unfolds.
I'm not super bearish on risk assets for the next 6 to 12 months. I think it's a slowdown, not a recession.
We're going to be in this environment where it's heightened uncertainty for equity markets. We think hedging is something that investors should be very focused on.
This is a point-in-time moment, and then we're going to go back to business as usual.
This is Bloomberg Surveillance with Jonathan Farrow, Lisa Abramowitz, and Anne-Marie Hordern.
Let's get you to the weekend, and us too. Live from New York City this morning. Good morning for our audience worldwide. Bloomberg Surveillance starts right now. Coming into Friday with stocks attempting to avoid a fifth straight week of losses. Equities inching lower as the president once again makes a push for lower interest rates. He wants Chair Powell to, quote, do the right thing, just as the White House doubles down on additional tariffs.
The president has been very clear about his intention for April 2nd. It's going to be a big day for our country. The president will be highlighting the unfair trade practices, the ways in which America has been ripped off by every country around the world, quite frankly.
So the promise of more tariffs and the hits to corporate America keep coming. FedEx cutting its full-year guidance for a third consecutive quarter, plus Nike offering a long list of complaints, including geopolitical dynamics, volatile foreign exchange rates, and new tariffs. Are they real problems or just a convenient excuse?
Yes, is that fair to say? I mean, this is what we've been dealing with all throughout earnings season. We've seen companies come out and cite incredible amounts of uncertainty, drink, and then talk about how they're lowering their expectations for this year. With Nike, it's a specific story. It's a turnaround story. FedEx, you could argue, is somewhat of the same, although they did talk specifically about how some of the tariffs, some of the de minimis, some of the packages that are going between companies have come down. That's maybe a little bit more of a bellwether story.
I think what you see is these two companies, you can maybe say it's idiosyncratic if it was just these two companies, but we've had a litany of companies come out and say they are seeing the consumer under pressure. We've seen that from Kohl's, from Dick's Sporting Goods, Nike, talking about the fact that these new tariffs, implementation on them, the imports from China and Mexico, they're now having to take that on board when you look at their bottom line.
Chairman Powell had this to say earlier this week. I would tell people the economy seems to be healthy. Took note of the soft data softening, but pointed to the hard data that hasn't. And that's where we're at right now, somewhere stuck in the middle trying to figure this out.
Which is the reason why every single central bank is just saying, we're kind of on hold, we're kind of in a cloud here, we're not going to continue. I would link the two stories or the three stories, I would say, of the economy and the lack of certainty in central banks, companies coming out with forecasts that reflect that uncertainty, and the president saying the Fed should lower rates, because what it addresses to me is that all of these companies companies are citing higher inflation. We heard that from FedEx as well. Inflationary pressures that are really crimping their bottom lines, but also are causing them to pass along costs. How much is President Trump trying to get out front of some of those concerns and say, well, if rates are lower, that can offset this, and then everything's fine, and we're going to expect weakness, but we can get through. How much is it girding for what's to come?
We need to get you an update on the airlines as well, so let's talk about that too. So this morning, IAG, Lufthansa, Air France trading a little bit softer throughout the session over in Europe. The latest from Heathrow, the following: closed all day due to a power outage caused by a fire at a nearby electrical substation. This is going to cause disruption for days.
This is the biggest disruption for Heathrow in more than 20 years. I was looking at some of the statistics for how many flights. 1,400 flights and 200,000 passengers every day through Heathrow. What a nightmare. Why do they only depend on one substation for energy? I don't understand.
It is a very good question. Why do they not have other energy ports coming through into the Heathrow? This is the main hub of basically the center of the world. If you want to go through Asia, potentially you stop through Heathrow. If you want to go to the Middle East, you're stopping through Heathrow. So a disruption not just for one day is an issue, but if this is going to be days, it's going to cause a tremendous amount of havoc.
Think how long it takes to figure this out. Never mind the planes in the sky that were due to land at Heathrow. You're now going to have planes, jets, crews, all in the wrong places for days. So there's other flights that were linked to these flights that aren't going to happen. This is going to take a long time to figure out.
Think about all the connections. This is the main hub if you're flying to so many different places in Europe, in Asia, in the U.S. Think about where they get rerouted to. There was one airport that said, well, we've taken 7 flights. 7 flights? I mean, this is thousands of flights that are getting rerouted. It's going to be a mess. Let's see how quickly they can resolve it.
This came from Heathrow, a statement from the airport earlier on this morning. Over the coming days, passengers should not travel to the airport under any circumstances. We'll get the latest from Guy Johnson on the ground over at London Heathrow later on this hour. Coming up this hour, we'll catch up with Jack Caffrey of JP Morgan Asset Management, with stocks looking to snap a 4-week losing streak. Bloomberg's Alex Morgan will join us too as London's Heathrow Airport shuts down, and Nouriel Rabini of NYU calling for a North American economic union. We begin this hour with stocks lower. Jack Caffrey of JP Morgan Asset Management writing, within equities, it is interesting that no sectors are screening as either overbought or oversold. The weakness in stocks tied to consumer spending is eye-catching. Jack joins us now for more. Jack, good morning. Good to see you.
Pleasure to be here.
Let's get to the earnings. Just how bad is Q1 going to be for some of these companies?
I think we probably need to rename earnings season guidance season, because for the most part, companies do a very good job of trying to manage what they think they can deliver over the next 90 days, and then surprise, they beat it. The question, though, becomes, well, what can you do for me next quarter? What can you do for me the rest of the year? And I think that's where the whole concept of uncertainty really comes to roost. Managing a portfolio, I wind up making decisions that involve moving considerable amounts of money, but I can change my mind and reallocate that capital. If you're trying to make an investment decision around building a plant, where should I build it? And I mean, now, what country should I build it in? Can I get labor? Can I get power? What will my cost of imports be? It becomes really easy to decide, I'm going to punt and make that decision later when I get clarity. I think when we go back to the Fed statement, I think the most cited word was probably uncertainty, uncertainty, uncertainty. And so it's not really helping people try to understand how they should think, what policies they should embrace, or how policy changes affects those investment decisions.
The price of the story matters, and expectations have shifted. Clearly, when you speak to economists, they've dropped their forecast for GDP for the US economy. Do you think we have sufficiently repriced earnings expectation going into earnings season?
I think in the shorter term, we have likely brought expectations down to the point where they're going to be beatable. I think, though, the question is, we're going to be hanging again on what we're going to hear about what the world looks like 6 months from now or 9 months from now. And the average stock is actually not particularly cheap. If you look through, the index itself has gotten cheaper. If you look at the S&P on an equal weighted basis, that's trading at 18, 19 times. The average is a lot closer to the market than it's been in the past. And I think that comes back to the rise of passive. And I do think becoming more active is going to make a lot more sense as we try to figure out who has a story, who can navigate, and where you have that flexibility.
Another way of asking what John just asked was, we've been talking to people who say Wall Street has reduced their GDP forecasts pretty much across the board. Yep. We haven't seen earnings revisions that match that. Which goes to which? Do those earnings revisions have to come down to meet the GDP estimates that have also come down?
Well, I think if I go to what the Fed told us, which I thought was a really nice summary, growth is going to be slower, but inflation is going to be stickier. And so I think companies are going to have some pricing lever to still try to make use of. I do think that we came into this year expecting roughly 12% growth. I was thinking it might be a little bit lighter than that. And so to the extent we are coming down to something a little closer to a more conservative outlook, I think is going to be helpful. I would rather that realization be more drawn out rather than very compressed. When we think about a 10% decline in 14 trading days that we got through the middle of last week, that was a very, very dramatic, not quite panic in the streets, but we were trying to reprice things really quickly. It's going to be messy over the next, call it 3 weeks, effectively, because we know that we have tariff day, which will effectively set costs. And unfortunately, we're putting tariff day right before earnings and right in the middle of the corporate buyback window is shut. So to the extent anything hits the market, your only buyer is going to be institutional money rather than corporate money, taking advantage of where they think expectations might be low enough, and CEOs can say, my stock is too cheap.
All I can say is tariff day is going to have to stick.
It's called Liberation Day.
Liberation Day or tariff day or day of uncertainty resolution, maybe.
D-Day was day of days, so maybe we'll leverage that one again.
Let's not. So going forward, let's make it more simple because my mind is tired, and I think that everybody's minds are tired, and it's all a very complicated story. The bottom line is you see opportunities to buy.
Yeah.
And that, I think, is really interesting. And the areas that you do see opportunities to buy are some of the areas that people really loved coming into this year, like financials. Why?
I think financials still benefit from the prospect of deregulation. I think that is a direction we're going to get, even if we don't know fully the timing. We're trying to engineer a positively sloped yield curve, even if it's actually inverted again, at least if you look at the 3-month, 10-year yield. I do think in the shorter term, financials wind up being a really interesting call on volatility. To the extent you have trading desks, and we're trading 13, 14, 15 billion shares a day, financials are sitting in the sweet spot of collecting that little fee on commissions, on data. Not to quote Duke and Duke, but they get paid effectively, whether the client makes or loses money. I probably shouldn't quote trading places. Oh well.
Jack, you mentioned
taught me a lot about investing back in the
You mentioned deregulation. So do you need to sit back as a portfolio manager and think of the triangle we're seeing in terms of Trump policy, which is deregulation, tax cuts, and tariffs, and not look at the everyday truths when it comes to potentially what's happening in terms of frenetic behavior on tariffs?
Life would be so much easier if we were trying to deal with this uncertainty if we were at 11 or 12 times earnings rather than 20. And so the reality is, as much as we try to triangulate on whatever the most recent data point is, and recognizing policy has shifted between a post at 10 and a post at 2, which reverses some of those policies, we come back to expectations remain robust. And effectively, that's forcing people, I think, in the shorter term to react rather than respond. I'm trying to respond. I'm trying to respond to things that are cheap, that effectively try to give me some of that greater, I won't say margin of safety, but margin of buffer to having to be specifically right on direction, timing, and level. So financials wind up giving us some opportunities to do that with bank stocks trading at 60% of a market multiple, when normally they might trade somewhere closer to 75% of a market multiple. Some industrials have gone from down 25, 30% on realization that maybe some of the enthusiasm around CapEx is going to be deferred a little bit. Some healthcare names where you're thinking, all right, we have to find billions upon billions of dollars to somehow cut in order to have tax cuts. And yet then you realize once you give a voter something, taking it away makes you very unpopular. And so I think, waste, fraud, and abuse is going to be quoted a lot in terms of what you look for, but you're probably not going to find quite as much of it as you would like to find to try to cut spending by a couple $100 billion. So to the extent that stocks got cheap coming into this year, healthcare was the worst performing sector last year. This year, it's the best performing because, again, kind of insulated to some extent, we thought. And then we suddenly realized that Ireland exports us a tremendous amount, or we import from Ireland a tremendous amount of pharmaceutical products and intermediate goods. Oh, well, that's going to be an interesting thing to try to work through on Liberation Day.
Speaking of spending, let's talk about spending. This headline just crossed from Germany. It passes the upper house. They've approved a debt reform bill, a landmark spending bill passing the final parliamentary hurdle. That's what the big red headline reads on the Bloomberg terminal. And I have to say, I didn't expect ever to read that big red headline on a Bloomberg terminal, unlocking hundreds of billions of euros of spending on defense and infrastructure in Germany, of all places.
With very little dissent. That's the shocking part. This has sailed through both houses of German parliament at a time where everyone is saying, A, we need to invest more in our military, and B, it is time to break that debt ceiling that we have. What is the implication, though, for the rest of Europe? And I think a lot of people are grappling with. And what is the implication for yields globally at a time of re-leveraging in places like Germany?
T. Rowe Price saying maybe 6%.
I saw that.
Yeah, that's quite a headline.
Yeah, saying that in the next year and a half, you could get to 6% on U.S. 10-year yields, in part because of what's going on over in Germany. How much does it set a floor under how low yields can go?
The euro at the moment just a little bit softer. We're down by 0.2%, 108.33 on euro dollar. Jack, it's always good to see you, sir. Thanks for dropping by. Jack Caffrey there of JP Morgan Asset Management. Let's get you an update on stories elsewhere this morning with your Bloomberg brief. Here's Yahara Hackers. Hey, Yahara.
Hi, John. London's Heathrow Airport is closed and will remain shut all day. A major fire at a nearby electrical substation led to a major power outage at one of the world's busiest airports. Heathrow said disruptions would continue over the coming days and passengers should not travel to the airport under any circumstances. Meanwhile, here, President Trump signed an executive order to largely dismantle the Department of Education as part of efforts to overhaul the U.S. government. The order follows an effort to slash the department's workforce by nearly half. The plan faces legal and logistical hurdles, though, including potential clashes with labor unions and lawmakers. And let's get a check on Nike shares. They are down 5.5%. The sportswear maker issued a weak outlook for the current quarter as its turnaround efforts face a growing list of challenges. It's struggling to clear out old inventory and is feeling the impact of the growing trade war, with Nike producing some of its shoes and other items outside the U.S. in places like China and Mexico. That's your Bloomberg Brief. John?
Yahara, thank you. And Lewis Hamilton pole on the sprint race in Shanghai. So great news for Ferrari. It's one of those stories that I'm just going to discuss with myself. Up next on the program,
that was fun.
Doubling down on April 2nd.
The president has been very clear about his intention for April 2nd. The president will be highlighting the unfair trade practices, the ways in which America has been ripped off by every country around the world, quite frankly, and there will be big tariffs that will be going into effect.
Liberation Day, April 2nd. Dan Clifton of Strategas of Bad Company joins us next from New York City this morning. Good morning.
Influencing global markets.
Technology is driving business across Europe.
Companies in Asia are betting on tech.
Welcome to the world of decentralized finance.
Massive outperformance from Bitcoin.
Bloomberg is covering all things crypto, the people.
The tectonic shift emanating from Washington.
All we're looking for is clear rules and an ability to build in the United States.
Crypto shouldn't be partisan.
The transactions.
Really a record-breaking moment.
Crypto VC is back.
And the technology.
It's really the beginning of a global on-chain economy.
And if America doesn't embrace it, we're going to be left behind.
Bloomberg Crypto, only on Bloomberg.
Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade.
This is Bloomberg Technology.
This is the Asia Trade.
This is Wall Street Week. Welcome to Balance of Power.
This is Bloomberg Television.
Equity futures on the S&P just a little bit softer here. We're down by 0.2% and just about positive on the week so far. And on course to snap a 4-week losing streak on the S&P 500. We'll see if some of this sticks. On the Nasdaq, we're down by about 0.25%. Under surveillance this morning, doubling down on April 2nd.
The president has been very clear about his intention for April 2nd. It's going to be a big day for our country. There will be big announcements when it comes to reciprocal trade, and the president will be highlighting the unfair trade practices, the ways in which America has been ripped off by every country around the world, quite frankly, and there will be big tariffs that will be going into effect.
So here's the latest this morning. The White House doubling down on reciprocal tariffs coming April 2nd. Implications of President Trump's current levies coming to light. Data showing China's imports of U.S. cotton, cars and some energy products plummeted in the first 2 months of the year. Bloomberg's Tyler Kendall joins us now from Washington for more. Tyler, do we have additional clarity on what we might actually see in a few weeks' time?
No, April 2nd, we are still waiting to find out what those actual rates would be. Senior administration officials have floated that some rates could be higher, some rates could be lower, depending on how countries are negotiating. Scott Bessent, for example, highlighting that there could be a dirty 15, as he said, top 15% of countries that do the bulk of the trade with the U.S. We know China, of course, is one of them. And some of those statistics that you referenced there are pretty staggering. According to our Bloomberg analysis of the data, this could be a prelude to some widespread disruption in global trade. Chinese imports of cotton down about 80%, Chinese imports of vehicles down 70%, and Chinese imports of crude oil and LNG down about 40%. There's a lot at play here. We talked about April 2nd, but that week could start a little early for Beijing. You'll recall April 1st is when the U.S. is set to release its review of the trade deal struck with China under the first Trump administration, where we saw Beijing largely miss some of its top purchase obligations with the U.S. Bessent has floated that he could potentially put into place some sort of catch-up provisions there as a remedy to get those purchase agreements up, particularly when it comes to U.S. agricultural goods. John, we could get some more information about exactly where these talks stand and what both sides are willing to negotiate here, because U.S. Senator Steve Daines, a Republican from Montana, he touched down in Beijing overnight. He is set to become the first U.S. official to sit down publicly with a top Chinese diplomat of this Trump term. It is expected to be a rare opportunity for some direct talks.
Tyler Kendall down in Washington, D.C. Tyler, appreciate it, as always. To build on this conversation, Dan Clifton of Strategas, a bed company, joins us around the table. Dan, good morning.
Good morning.
What do you tell clients about what happens in 2 weeks' time?
Yeah, look, I think there's a disagreement amongst investors about what could actually happen. So we break them into buckets. There are 5 buckets: China, USMCA, reciprocal, sectorial, which is pharma, autos, semiconductors, and then you have commodities: steel, aluminum, lumber, copper. You have to put them in each of the buckets. Then what you do is you add them up and say, how many tariffs could we be facing on April 2nd? It's like $250 billion. You're talking about almost 1% of GDP. So I don't expect you're going to get all 250, but nobody's done that analysis. And so what we did was we went line by line into each country and said, where is the reciprocal nature of it? $11 billion in China. So that would be on top of the $30 billion that's already happened. Interestingly, Mexico's just $1 billion. Very small, largest trade partner. So there won't be much reciprocal. So when we hear some numbers are going to be high, some numbers are going to be low, that makes sense based on trade. India, Vietnam, they're going to have high numbers. Then you incorporate the value-added tax to it, and they're trying to find the border adjustability to it. When we did that, what we found was that Ireland has the highest rebate because of the pharmaceutical products. Germany has the second because of auto products. So you can see how the sectorial can start to merge into the actual reciprocal. This is going to be a big event. From our vantage point, what we're telling clients is, if we get a deal on USMCA and can take that off the table and then have reciprocal, you're just swapping one for the other. But if you have both, the markets could be surprised by how big these tariffs are, largely because we're talking about them in isolation. We haven't combined them, and it is a bit of a shock. Here's the one reason why I don't think we'll get a shock. They moved away from a universal tariff to reciprocal to avoid the shock. And they're hoping that by threatening this out on April 2nd, it forces a negotiation. and maybe some countries will negotiate.
But we already know they're in negotiations now with some countries. Who do you think could potentially lower their tariff barrier for the United States before April 2nd?
The UK would probably be first. The UK is about 1.1 billion. It's relatively small. It's not high on the list. The key question is whether the 7 countries that are high on the list do. That's China, unlikely. Mexico, Canada, EU, unlikely to have a deal with EU by April 2nd, and then Brazil and India.
We spoke to the former Swiss ambassador to Trump 1.0, Ed McMullen, yesterday, and he talked about it's less about the EU and more of a bilateral relationship. So say the United States with Italy, United States with Germany, United States with Switzerland. Are those conversations happening?
Absolutely. And by the way, when the president talks about saying he's going to give a rate, he's going to give a rate for each individual EU country. So this is a big change, and it goes right to that bilateral negotiation. And that's important because different countries have different imports that are leading to what they're trying to clamp down on, and that's the U.S. trade deficit. Sometimes they got to go after tariffs. Sometimes they got to go after products. If you look at Ireland, they don't have a tariff rate problem. They do have a large trade deficit because they're sending so many pharmaceuticals. So you've got to be careful. From a macro perspective, too big, you start putting recession risk in there. If it's too much on one industry, you start having supply shortages of pharmaceuticals. So you want to be very careful. But I would also caution, it's not just about trade policy. What the Fed did with its balance sheet this week was very important by slowing down QT. And on top of that, we're going to start tax negotiations in 2 weeks from now, and there's probably going to be some offsetting there.
I want to pick up on the Fed point.
Sure.
President Trump, a couple hours ago, came out on Truth Social and said egg prices are way down, groceries and gasoline are down. Also, now if the Fed would just do the right thing and lower interest rates, that would be great. If I were overanalyzing the situation, I might suspect that he's trying to get ahead of the potential shock and the potential weakness that could come with this huge bazooka on Liberation Day or Tariff Day or whatever you want to call it. Is that your take on it as well?
Yeah, the president is trying to change Biden's policies. Biden's policy was big fiscal, tight monetary. He wants to reverse that. Tight fiscal, loose monetary. That tight fiscal is spending cuts and tariffs. And then he wants the Fed to actually lower rates. Now, you've got to give space, and this is why Secretary Bessent is doing such a great job in trying to get oil prices down. You get oil prices down, you start to bring inflation down. You bring inflation down, you bring interest rates down, and you give the space for the Fed to be able to cut. I think the Fed's going to wind up having to cut 3 times this year, and they just got rid of QT. So you are seeing a more accommodative monetary policy. And my sense here is on fiscal policy, it's going to get a little bit tighter.
Just quickly, we're against the clock, 30 left. After April 2nd, are they done? Or does this just carry on?
This never ends.
This never ends.
Right? And the question is, what comes into place on April 2nd? What gets 30, 60, 90 days? If the president announces this and gives 90 days, the markets are going to cheer that. Now, you still don't have the certainty, but it shows you that there is a negotiation. And that's what the market just wants to know how much expenditure is going to be. The key issue, that once you get the rules, then companies can plan, and the companies are frozen right now, and that's what we got to get out of. And that's why I think people are excited for April 2nd.
That's what we want. We want to play the game. We just want to see the rules. Dan Clifton, it's good to see you, sir.
Thank
As
you.
always, Dan Clifton there. Of Strategas, a bad company, breaking down Liberation Day a few weeks away.
You know, and just how much is going into this and what is potentially going to transpire in growth. Can you put the genie back in the bottle, though, of some of these trade negotiations once it's out? That's my question.
Up next on the program, we'll catch up with Nouriel Roubini of NYU Stern on his call for a North American Economic Union. Stay tuned for that. Live from New York, this is Bloomberg.
Behind the bright lights and adrenaline of pro sport is an equally exciting world of negotiations and deal making.
That's what we cover each week on our podcast, The Deal.
I love the fact that you have, we say the cojones, but we can't say that in Bloomberg.
Maybe moxie.
Yeah, moxie. I'm Alex Rodriguez, former baseball player turned business executive.
And I'm Jason Kelly, a journalist at Bloomberg. Over the next couple months, we'll hear from all-stars like Billie Jean King.
Well, what should I learn? What should I do? I said, learn the business.
Jay Williams.
You're the asset, but how do you become the principal?
Paul Rabel.
We're going to be the league of digital, and that's why you're going to invest.
Adina Friedman.
I definitely am competitive.
David Rubenstein.
People don't come up to me on the street and say, let's talk about this private equity deal you did recently. Nobody does that. They say, let's talk about the team.
And so many more.
You need a clap?
No, I never. Ready? Go.
From our studios in New York and San Francisco, our expert hosts have the data and analysis from the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action. Live every weekday, only on Bloomberg Television. Context changes everything.
Equity futures this Friday morning, and good morning to you. Just a little bit softer, down 0.25% on the session. On the week through Thursday, just about positive on the week so far, following 4 consecutive weeks of losses. That was the longest weekly losing streak going back to August of last year. On the NASDAQ this morning, negative by 1/3. In the bond market, 2-year, 10-year, 30-year, just a flavour of the yield curve this morning. Yields are lower by about a basis point across the curve. On a 10-year, 422.33. On 2s, around 3.95. On our radar this morning, President Trump repeating his call for the Fed to lower interest rates. Writing on Truth Social overnight, the prices of eggs, groceries and gasoline are down. His comments coming as Fed officials weigh the impact of tariffs on the U.S. economy. I think this is the second time in 2 days we've heard these comments from the president.
Which is really interesting in light of the timing, less than 2 weeks ahead of Tariff Day. And that, I think, is what people are coalescing around. How much is this President Trump trying to get ahead of a potentially massive number that they're going to announce on April 2nd that is going to surprise people to the downside at a time when a lot of companies are warning about inflation ticking up, and that is becoming a theme. That's what a lot of people are taking away from this.
But at the same time, tariff day or not, Trump was always going to be calling on the Fed to lower interest rates. That is his worldview on he thinks interest rates are way too high. He said that not just in his first term, but he said that on the campaign trail. I would note, though, he's talking about egg prices being way down, gasoline prices being way down. So I think he's trying to shift some of the political blame to the Fed. Well, it's their fault because I got some of these essentials lower. When it comes to egg prices, though, they are not down in the grocery store, but they are down when it comes to the wholesale.
We're used to this. We've heard this so many times. We talked about this yesterday. We're almost desensitized to it at the moment. Senator Warren seems to write a letter every other week to Chairman Powell. Feels that way. I know it's not that way, but feels that way, asking for lower interest rates. It seems to be happening all the time now.
He restrained himself, though, for a couple weeks. He didn't talk about that. And he actually was talking about how the Fed's in an okay place because they're targeting the 10-year yield. For him to come out right now, tying it to inflation and other prices, how much is this intentionally trying to get ahead of something that's coming?
Let's get you the latest on Tesla as well. So Elon Musk is asking Tesla employees to hang on to their stock despite, quote, rocky moments. Shares plunging more than 40% so far this year. The Attorney General, Pam Bondi, also announcing federal charges against 3 people for alleged arson and vandalism of Tesla property.
I think we can all agree you shouldn't be vandalizing any sort of property. But when it comes to share prices, what you do with your money is absolutely yours, your prerogative. What I would say is what Elon Musk is trying to do is he's trying to get in front of this. This is what Dan Ives said. Get back to the floor, go to the Tesla headquarters, and please try to right this ship. He says if you read the news, it feels like Armageddon, which I thought was interesting. He says he can't walk past a TV without seeing a Tesla on fire. Understand if you don't want to buy our product, but you don't have to burn it down. But telling his company, please hold on to your shares.
Is this Musk actually recognizing the damaging in confidence toward his company after a 40% plunge in his stock price? I mean, is this him recognizing that he needs to be more present, or is this him playing momentary lip service at a time to try to stave off some of the liability? that ultimately will make a big difference.
Well, for Dan Ives it was. He said this is a first step for Musk to show he's going to lead Tesla through this tumultuous period. Will we see more of this? I'm not sure, because he's going to be in Washington today at the DOD.
This is a change of tone for the analyst community, and I'm thinking of Dan Ives, I'm thinking of others too, who only a number of months ago said there was a halo effect over Tesla stock because of Elon Musk's involvement with the government. That's changed very quickly in the space of a couple of months.
Because Teslas and Tesla vehicles have been used as the poster child of people's dissent and disagreement with Elon Musk. I will say it probably, I don't know if it helps or hurts to have Howard Lutnick hawking your wares on Fox News, where he urged viewers yesterday to buy shares in Musk's car maker, saying it'll never be this cheap again. It's sort of a question, again, and I think that you asked the right one, is it becoming more of a liability than it is an attribute at a time where we're not seeing full self-driving vehicles really come to the fore in the near term?
Old habits die hard. The Commerce Secretary used to make in stock pitches.
Exactly.
Right?
I can imagine him going on being like, I got this.
It's not the job anymore. Anyway, the stock is down in the free market by 0.75%. Wanted to get you the latest on this. Some real travel disruption overnight. London's Heathrow Airport facing its worst disruption in at least 2 decades after a nearby fire caused a major power outage. Authorities saying the airport will be closed all day today, with service interruptions likely to continue for days.
This is catastrophic for the thousands of people who go through Heathrow every single day. A question, and we've all been talking about this. You read this earlier, that Heathrow said in a statement, the disruption will continue over the coming days, and passengers should not travel to the airport under any circumstances. It sounds pretty dire. And it raises this question, how long is it going to take for all of these disruptions to get resolved, given what you mentioned, all of the staff, all of the pilots, all of the flight attendants who need to get into place and on the connecting flights? What a disaster. But again, why do they only have one energy source to really power the entire network in one of the busiest airports in the world?
It's one of those questions I think we all want answered, so let's try and get you an answer. Joining us now is Bloomberg's Alex Morgan. He joins us now from Heathrow Airport. Alex, welcome to the program, sir. Let's just start with, how on earth did this happen?
Well, good morning, guys. I mean, this is the 4th most active airport in the world, Europe's busiest airport, and if you look behind me, you'd be forgiven for thinking nothing's going on. Nothing is going on. The skies are completely clear. This is unprecedented. It's a full-day closure. So we've seen disruption to air traffic control. We've seen the airport shut, say, for example, during the visit of President Obama in the past. This is a full-day closure, completely unprecedented. And as you were mentioning there, it's sort of like a chain of dominoes, really, because this fire at a power station, a power substation, took the airport offline. So that's going to take the airport off for the day. But then you've got the aircraft. Then you've got the crew for those aircraft and the passengers, now all in the wrong place. It's not simply disruption throughout Friday, which of course is happening. Indeed, 120 aircraft, around that number, were already headed to Heathrow and had to turn back at the time of the closure. But it's then the knock-on for the next couple of days. Heathrow, the statement saying closed until at least midnight tonight. Now, the fire brigade here in London saying that the fire is under control. They're now looking to investigate the cause of that fire. And that, indeed, as you already mentioned, going to be questions about the power source for the airport. But so many questions, as you're saying, about when will normal service resume. I think it is fair to say we're looking at disruption well into the beginning of next week. On average, Heathrow at peak times has around 40 aircraft taking off an hour. I mean, this is a hugely busy hub for travel, of course, transatlantic, but also to the Middle East as well. You're seeing all the airlines issuing updates to their customers. British Airways, by the way, this is home to British Airways. More than 600 flights for that airline alone impacted today. This is unprecedented disruption. When is it going to finish? That's a question everybody wants to know. It's fair to say we're looking at days, not hours.
Alex, appreciate the update, sir, and the coverage throughout this morning out of London. Bloomberg's Alex Morgan. In the next hour on Bloomberg Surveillance, we'll catch up with Guy Johnson, and we'll bring you regular updates on what's happening at London Heathrow throughout this morning on Bloomberg TV. For the markets, equity futures right now just a little bit softer by 0.4%. Investors confronting an increasingly cloudy outlook for the global economy, just as President Trump pushes ahead with a fresh wave of tariffs. Nouria Rabini of NYU and Hudson Bay Capital proposing a solution, writing, quote, to resolve their current tensions, Canada, Mexico, and the United States should start drafting plans for a North American economic union. Nouria Rabini joins us now for more. Nouria, welcome to the program, sir. Thanks for making time for us. That's quite a statement. Just go through the way you're thinking about it. How on earth would this work?
Well, for now, we have only a free trade area between U.S., Canada, and Mexico, and there are already tensions involved. There's nothing, not only to do with, of course, drugs, fentanyl, and migrants, but the U.S. is also concerned about the trade imbalance between Mexico, US, and Canada. They're very large trade surpluses with the United States. So you can renegotiate the USMCA in a direction of restricting trade. And US is now probably asking Mexico and Canada to also restrict trade in automobiles. There may be 20-25% tariffs on that because there are lots of job loss in the US. Or you can do something that is more bold, forming a full economic union that would imply free trade not only in goods, but also in services, in the movement of capital, labor, data, technology, and information. That's what the European countries have done for the last few decades. And from any economic point of view, North America is an optimal trading area that goes beyond goods. Now, one step you can take along those lines before having a full economic union could be, for example, to form a custom union. What's the difference between a custom union and a free trade area? In a free trade area, there is no common external tariff against other countries. So, for example, there are lots of Chinese cars that are now entering into Mexico, while the U.S. has a 100% tariff against Chinese EV. If you form a custom union, the first step for economic union, you'll have to have the same tariff imposed on Chinese cars, whether they go to Mexico or U.S. or Canada. And in this way, you create a full market, for example, for automobiles, and you prevent the imposition of, say, 20-25% tariffs on exports for Chinese cars or parts from Mexico to the United States. So you can do a reform of the trade agreement in the direction of shrinking trade, or you can do it in a direction of expanding trade. And I argue that actually it's an economic benefit of all three countries to expand trade through first a custom union and then a full economic union.
You offer a different vision then first, before we get to the much bigger one later. Can we just talk about the much bigger one? Freedom of labor, free movement of labor between the United States and Mexico just sounds like a complete non-starter. Nouriel, do you actually think that could be a stepping stone further out down the road in the future?
Well, in the case of the European Union, you had the same problem. The countries that were much poorer in Central Eastern Europe, they joined the EU. There was a transition period of many decades until they reached a certain level of per capita income, a certain level of governance, a certain level of reform. Of course, free trade in labor between US and Canada would not be a problem, same per capita income, same culture, language, and actually there'll be probably more people going from US to Canada than the other way around because of global climate change and cheap land in Canada. With Mexico, of course, at current level of per capita income, you cannot have free trade in labor. But as I said, like in the case of Europe, you could have standard criteria that suggest that maybe after 10 or 20 years, when Mexican per capita income is much higher, there's better governance, then you free up that type of trade. So I'd say that in economic union, the part that is controversial is only probably migration of labor. It will be in the interest of the United States to have free trade in goods, in services where it has comparative advantage, in the movement of capital, portfolio and FDI, and of course data information technology, where the US has a major comparative advantage relative to Mexico and to Canada. The only controversial part, as I said, is labor movement, but you can restrict it over time.
Nouriel, do you get the sense that anyone in the current administration is sympathetic to this type of proposal at a time where it seems like people are increasingly going for economic isolation rather than reducing the walls entirely?
I will start conversation within the administration on this matter, but I would say that certainly a step towards reforming the USMCA in the direction of a custom union makes sense. Because right now, of course, the automakers, that are the producers, are very worried about the impact on their own production costs and profit margins of restricting and imposing a lot of tariffs on, say, auto trade. The unions and the workers are in favor of it. But the problem is that if you're imposing this 25% tariff on automotive trade, the cost of cars in North America is going to increase by 10-20%. That's going to hurt, first of all, consumers, but it's going to also hurt the workers. So if you care about U.S. auto workers, there are two options. One, to impose the tariffs and restricting trade in automotive, but that's going to be bad for everybody. Another one is instead having a custom union, where if you essentially have an external tariff that is common against Chinese autos, then Chinese autos that are not entering the United States today will not enter Mexico either, And therefore, the market for U.S. automakers is going to be much bigger because you have 120 million Mexicans that need auto and buy now mostly Chinese cars. So you can have a win-win solution that makes everybody better off, including the auto workers, if you go in the direction of a custom union and eventually an economic union. So you have to go forward rather than going backward. And I think that those arguments can be made in Washington, in Mexico City, and of course in Canada as well.
Nouriel, is this proposal potentially a way that the United States could have more heft when it comes to driving a wedge between Beijing?
Well, certainly one of the concerns that the United States has is not just fentanyl that is coming to the U.S. Via China, but more importantly that the Chinese have avoided tariffs by essentially exporting goods to Mexico and from Mexico to the United States as if they were Mexican goods. The Mexican production of many goods has a lot of content of parts that is Chinese. And there is also concern about the fact that the Chinese are taking over the auto market of Mexico as well, exporting cheap cars, EVs and otherwise, to Mexico. So if you care about de-risking the relationship with essentially China, whether it's in auto or other critical parts of the economy, it makes sense to have initially a custom union and then having also a full economic union where decisions about how much you trade and do investment with China from North America are done not by the U.S. side alone, and then Mexico can do whatever they want as they do right now, but everything in the context of an economic union and initially a custom union. So it makes sense for the U.S., it makes sense for North America.
Nouriel, provocative as always. It's good to catch up with you, sir. And I should say, thanks for making time for us. I know you're on a bit of a world tour, so looking forward to catching up with you when you're back in New York. Nouriel Roubini there of NYU Stern and Hudson Bay Capital. Two very different ideas. In Nouriel's mind, one informs the other. The first point, though, a customs union, I don't think that's a million miles away from where we might end up between the United States, Canada, and Mexico. There is a sense that this is just opening the negotiations back up for USMCA.
Absolutely. And also, remember what Scott Bessent recently said? He said, you can make a fortress North America. He liked what Mexico was thinking of doing in putting tariffs on Chinese imports into Mexico so they don't come into the United States. And he said it would be a nice gesture if Canada did that as well. So if you had Canada, the United States, and Mexico all having the same tariff level when it comes to China, that solves a huge problem for this administration.
That's the latest from Professor Roubini. Let's get you an update on stories elsewhere this morning with your Bloomberg brief. Here's Yahara Hacker. So, Yahara.
Hi, John. We start with FedEx. Those shares are down 8% in the pre-market after the company lowered its full-year guidance for a third straight quarter. They expect adjusted earnings for the year will be lower than analysts expected as inflation and uncertain demand for shipments squeeze their bottom line. Meanwhile, Apple is said to be undergoing a rare executive shakeup in a bid to get its AI efforts back on track. Sources telling Bloomberg that Tim Cook has lost confidence in the ability of AI head John Giannandrea to execute on product development. Vision Pro creator Mike Rockwell will now take over Siri. And UBS is considering relocating its headquarters if Switzerland sticks to its demand that the bank holds an extra $25 billion in capital. Sources telling Bloomberg that executives believe meeting this requirement would make the group uncompetitive to global rivals. That's your Bloomberg brief. John?
Hey, Yahara, thank you. More from Yahara later on in the program. Up next on the program, the critical mineral push.
Moments ago, I also signed an executive order to dramatically increase production of critical minerals and rare earths. It's a big thing in this country. We're also signing agreements in various locations to unlock rare earths and minerals and lots of other things all over the world.
We'll get you some clarity on this push in just a moment with Tim Natanas of Wolf Research. She joins us next, live from New York City. This is Bloomberg.
What makes it India's time?
It's us women who are going to transform India. I truly feel that the time for Indian women has come. They're not only breaking glass ceilings, but they are redefining, you know, whether it is in sport, whether it's in medicine, whether it's in creative arts. They are everywhere, and I have so much positive energy that comes back to me when I'm talking to Indian women. And I just think at all these little girls and boys, I don't want to discriminate, who are now in school-going age, imagine once education, sports, we empower them. What a difference they would make not only to India, but to the planet and the world. And the world needs it now than ever before.
Listen carefully. Can you hear the rhythm in the markets? Not just in the syncopations triggered by inflation, but in the preludes leading to global elections, in the dissonance that moves the Nikkei, and the rising course conducted by AI. There's music in the markets, and if you want to learn to listen for it, we'll show you how.
Bloomberg brings you breaking news 24 hours a day. Powered by more than 3,000 journalists and analysts in more than 100 bureaus across the globe. Bloomberg Television. Context changes everything. Get your fixed income fix. Watch Bloomberg Real Yield around the world right here on Bloomberg. Context changes everything.
So here's the state of play. We're down 1/3 on the S&P. We're down 0.4% on the NASDAQ. Through yesterday, the NASDAQ 100 heading towards a 5th consecutive week of losses, something we have not seen, at least since May 2022. It's been a long time. We're down about 1/3 on the S&P. Under Savannah's this morning, the critical mineral push.
Moments ago, I also signed an executive order to dramatically increase production of critical minerals and rare earths. It's a big thing in this country. We're also signing agreements in various locations to unlock rare earths and minerals and lots of other things all over the world, but in particular Ukraine, which they have tremendous value in rare earth, and we appreciate that.
So here's the latest this morning. President Trump making a push to secure critical and rare earth minerals, both at home and abroad. Trump signing an executive order to expand production in the United States while adding a minerals deal will still get done with Ukraine. Tim Natanas of Wolf Research joins us now for more. Tim, now we hear the president sometimes say rare earths and critical minerals. Can you just start there? What's the difference between the two?
I think it's just a question of what you decide to define as critical minerals. So I think in the past, there's been some discussion of critical minerals, including copper and sometimes including aluminum. So I think it really depends on the definition, who's using it in what way. I think, in terms of rare earths, yes, I think those can be considered critical minerals. This could include a wide variety of critical minerals, but I don't think I can entirely interpret what President Trump's alluding to in these clips.
When it comes to Ukraine, he says this deal can happen very soon, very shortly. What kind of minerals are we talking about that Ukraine has?
It's not my understanding that Ukraine actually has a lot of rare earths, and I don't know Ukraine's situation. I do know that the U.S. has actually ample supply in the earth of rare earths. Rare earths tend to be located in conjunction with coal deposits. So there's, of course, a lot of coal deposits and increasingly coal deposits that may or may not be viable in the future or likely. But I think it's fascinating to see that the rare earths in the U.S. could be further expanded. There's only, one large producer in North America right now, and that, there's a lot of smaller projects. So I think we could be seeing, if there's support from the administration, just a proliferation in the rare earths production in this country.
Well, he's invoking emergency powers in order to boost that domestic production. How high could you see the United States reach in terms of boosting that production of these minerals?
I think it's a question of the confidence in the industry that these are going to be sticky policies. So, it's really tricky to make an investment not knowing how long some of these policies are in place. And the reason you haven't seen these investments happen so far is that China just dominates rare earths, right? So like 90% of the world supply and production comes out of China. So you'd have to see some subsidization of domestic production to be able to encourage them to get to those levels. I don't know the deposits in the ground and if we could quite get to that level, but I think you could see just a boom in production in the near term, but they still have to develop it. You still have to mine it out of the ground and get to a point. So usually, developing mines like this would take several years. So we're probably still talking about any palatable actual solution, usually I would think later in his administration.
Timna, do you have a sense, based on what you've heard so far with the tariffs, as well as some of the deals that are happening, whether it's what might get signed with Ukraine, whether it's just discussions to explore elsewhere, do you have a sense of what the overarching strategy is for the United States and this administration to secure rare earths minerals ahead of what they expect to be an increasing tit-for-tat trade war?
Well, I mean, I just would imagine if you're the Trump administration, you see the world dominated by China and kind of an important production, right? Rare earths, of course, aren't that rare, but they do make very important magnets used for high-tech applications, robots, computers, you name it. So this is something that, of course, we're imagining that we're going to be needing, much more going forward. So I think the goal should be to encourage domestic production. I think there's a lot of other ways to do that by subsidizing them directly, by reducing the regulations to actually mine it. That's the problem on a more local level. And I think, if you look at the importance of this industry and the fact that it's so dominated by China, I can imagine why we want to encourage domestic production. I just think it likely takes time. So you probably want to avoid all the tariffs until you know that you can have a thriving domestic industry.
It takes a long time, particularly in the US. I'm thinking of Resolution Copper in Arizona. Timna, just to finish there, the 30 seconds we have left, if you wanted to play this story through equities domestically here in the United States, what are the names of the companies you do that through?
Well, there's only one domestic producer of rare earths, and that company has a big head start, but ahead of everyone else. That's MP Materials. And then I think the other way to take a longer shot is these coal companies that have the deposits that could eventually get produced. So I don't cover those names, but there's quite a few companies that have coal deposits that I'm sure we could look up.
Timna, appreciate the clarity. Thank you. I'm sure everyone's going to Google right now. Timna Tanners of Wolf Research, or go on the Bloomberg Terminal, of course. Up next on the programme, Seema Shah of Principal Asset Management, Adam Hoach of Bully Pulpit International, G2 Patel of Cisco, don't miss that on AI, and Greg Peters of PGIM Fixed Income on financial markets worldwide. Live from New York City, the second hour of Bloomberg Surveillance. Up next.
This is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. These are the stories that set your agenda.
Taking you from the U.S. market's close to the overnight session in Asia, we'll walk you through what you need to know to kickstart Europe's trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in to Daybreak Europe, only on Bloomberg Television. Context changes everything.
In 2000, post-Napster, generally everybody wrote off the recorded music industry, including the investment community. And I didn't mind that chapter because then I got left alone. And actually, I think out of that period, we started to create better art because the pressure wasn't on from the technology to be the most powerful chapter. And then iTunes came in, and iTunes, to Apple's credit, did have a boutique taste mentality about the store, which meant that I think they understood. I can tell you from that period that the artists that came through were of a very high quality because it was encouraged to be boutique. Now, ironically, this chapter has made us more money times 5 than the iTunes chapter and the post-Napster chapter. But an algorithm tells you what you want, not what you might like. And there's a difference between what you want, but with streaming, the downside is you have incredible penetration, and we have hundreds of millions of people around the world. And so that has been very lucrative as a business.
From the beating heart of global finance, economics, and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. What do you think the future is for inflation? Is this new normal? Are markets too optimistic? How do you worry about the things that are outside your control? How does the current fighting completely stop? I'm Francine Lacqua, and this is The Pulse, every weekday only on Bloomberg.
Key investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Anand, only on Bloomberg.
Jumpstart your trading day on Bloomberg Open Interest.
2 hours of single stock stories that are driving the opening bell action.
We'll take you to Wall Street, Main Street, the C-suite, and beyond.
These are companies that are growing their market.
The great companies in the U.S. are the companies hitting the cutting edge. That's a different story.
Get the inside track on what's buzzing in markets.
With the players who are shaping the narrative.
If you have bad earnings reports, you're going to get punished.
They're not buying what the industry is selling. Join us on Bloomberg Open Interest. Every trading day, only on Bloomberg.
We're in the midst of a pretty significant set of shocks.
The elements that normally tip bull markets into bear markets are not present. The biggest challenge, though, is how policy unfolds.
I'm not super bearish on risk assets for the next 6 to 12 months. I think it's a slowdown, not a recession.
We're going to be in this environment where it's heightened uncertainty for equity markets. We think hedging is something that investors should be very focused on.
This is a point-in-time moment, and then we're going to go back to business as usual.
This is Bloomberg Surveillance with Jonathan Farrow, Lisa Abramowitz, and Anne-Marie Hordern.
The second hour of Bloomberg Surveillance starts right now with equity futures negative by 0.25% on the S&P 500, hoping to avoid another week of losses on the S&P. We are on a 4-week losing streak coming into this week. On the Nasdaq, we could well make it week 5. The Nasdaq 100 negative by 0.4%. The President of the United States for a second consecutive day making the argument on Truth Social for lower interest rates.
And this comes after the Fed indicated they are on hold, talking about, President Trump was talking about prices of eggs coming down, gasoline coming down, speaking about whether this actually could be disinflation. Look, he's open to his opinions. Go for it. You are an American citizen. Comment on the Fed. Whether it actually affects the Fed, we'll see. Michael Reed of RBC saying we expect the Fed will remain on pause until the hard data forces their hand.
What did the Fed say? Nope. No, they not listening to what the White House is saying, whether or not that has to do with personnel or whether that has to do with where they have the direction of travel according to Fed rates. I'm not surprised we heard from the president yet again when it comes to where he wants to see the direction of travel. Why? Because his administration continues to tell you they want lower mortgage rates. They want to see money going back into the system, especially for middle Americans. And to Lisa's point earlier, a lot of this has to do potentially to what they have coming up in 12 days' time. The big one, Liberation Day. Tariffs.
The Fed chair is not in a rush. He wants clarity on Liberation Day, April 2nd, work out what those tariffs look like, work out what it means for this economy. But we are getting some warning shots from corporate America, and we got a few more in the last 24 hours. Check out FedEx and Nike. FedEx, I think, for the 3rd consecutive quarter, cutting guidance. FedEx this morning is down by close to 8%. Nike is going through its own world of problems, but they've got a list of complaints, and it includes tariffs. That stock is down by 5.8%.
You asked a very good question to start the last hour, which was how much of these are specific stories that are turnaround stories dealing with real competitive pressures, sandbagging us, and also using the convenient excuse of uncertainty. We won't necessarily know. FedEx is facing a lot of competition from Amazon. Nike is facing competition from pretty much everyone because they're trying to rejigger their complete corporate strategy. Nonetheless, when you do have a litany of companies all saying the same thing, it makes people feel insecure, and that, I think, is what you're seeing pretty much across the board.
It shows that the supply chain might be under pressure when it comes to tariffs, and also shows that consumers are under pressure when it comes to what you could see as this price hike. Nike talked about the fact that they are already starting to implement tariffs on imports from China and Mexico. That's where a lot of their goods are made.
If you're just joining us, welcome to the program. We'll talk about some stocks under pressure. IAG, Lufthansa, Air France, slightly softer, weaker, lower, down over in European trading. The news out of Heathrow Really shocking stuff. Closed all day due to a power outage caused by a fire at a nearby electrical substation. Serious disruption for worldwide travel over the next several days, potentially.
Yeah, the biggest disruption that we've seen in more than 20 years for the fourth biggest airport in the world, a major hub for all sorts of different routes. A question of A, when will it get resolved? B, how long will it take it for all the pilots and flight attendants and cargo ships and everything else that needs to get there? How long does it take to get through that? And then what are the ramifications for airlines that already are under pressure with consumers pushing back in a time of uncertainty? 1,400
flights, 200,000 passengers going through that airport every single day. Super messy, and plenty of updates throughout this morning on this program. Coming up through the next 60 minutes, we'll catch up with Seema Shah of Principal Asset Management, with investors very much on edge going into April. Bloomberg's Guy Johnson will be with us from London's Heathrow Airport as that airport comes to a standstill. And the Cisco Chief Product Officer, Jitu Patel, on the company's latest partnership with NVIDIA. We begin this hour with stocks lower, struggling to snap a 4-week losing streak. Seema Shah of Principal Asset Management writing, whether the rally can reassert itself and deliver positive equity returns going forward will likely depend on whether earnings growth can deliver. Seema joins us now for more. Seema, welcome to the program. Can it deliver relative to expectations? So let's talk about expectations. Have they pulled back sufficiently over the last several weeks?
Hi, John. I don't know if it necessarily has. I mean, we've already seen a couple of downgrades to economic growth forecasts. Actually, from an earnings perspective, I don't think it's moved down enough, particularly when you start to think about the 2nd of April and the amount that could happen to global stocks, global earnings. So I think there's a little bit further to go. You know, we need to see a number of other, I guess, boosts coming in the second half of the year. But I think for the next couple of months, it's going to be a really rocky road.
Seema, some of the retailers have come out and said that the next year could be difficult. They've lowered expectations. Delta Airlines, the airlines group, have done a similar thing over the last several weeks as well. Which parts of the market do you think are more vulnerable going into earnings season?
So I think anything, of course, like anyone which has got any kind of international revenue exposure, anything which is linked to consumers, the things that we're really concerned about with the consumer is just what we're seeing with regards to price increases, the pressures that people are having on household income. So actually it's spread across so many sectors because there's so much significant exposure. There are parts of the market which we think are a little bit less vulnerable. Places like financials, which have had a bit of a pullback, it could see some return. But so much really depends on what can we expect to come through from a stimulus perspective, not just from the Fed, but in terms of, what happens to tariffs in the second half of the year? Are some of them going to be lifted? Are we going to expect to see deregulation? If that comes through, then there are parts of the market that stand to gain over the coming months. But as I said, I think the jury is out until we have some further clarity of where this administration is going with a number of their different policies.
And there also needs to be some clarity, Seema, on some of those inflationary pressures that you were referring to, both with respect to households and what that does to their spending capacity, as well as to companies and their ability to pass it along to said consumers. Do you have a sense of whether so far some of these price pressures are actually inflationary, or whether they have the seeds of being disinflationary down the line in tandem with weaker growth?
So actually, I don't think there is any clarity at all. I think we're hearing really contradictory stories. About a year ago, we were talking to a number of our larger clients who had told us that typically you can pass on price increases twice. Consumers can handle it twice. The third time is a complete no-go. And we're almost looking at that third time now. On the other hand, we are hearing some small businesses who are saying that there's so much uncertainty and they cannot be left out of pocket. So they're already starting to increase prices ahead of what could be reciprocation on tariffs on April the 2nd. So actually, it's a very, very varied story, which of course, it doesn't help businesses, companies, investors really plan ahead.
At the end of another week where my mind feels somewhat fried, I wonder if people are just getting sick of all of the uncertainty in the United States and are looking for the certainty of the budget that was just passed in Germany, the certainty of other regions in the world that might be engaging in fiscal stimulus. Do you jump on that train, or do you think that that's sort of haven from uncertainty or just another story, another narrative? Do you think that that's basically played out as people realize, okay, it's going to be more complicated?
So it's funny. I've been in Madrid all of this week speaking to clients, and it was interesting from their perspective. They're a little bit more skeptical than I'm finding the US audience to be. They're looking at this and they're saying, look, this is really great news for Germany without a doubt. But in terms of how it feeds through to Europe, they're still unsure of really what the positive repercussions could be. They don't really think there's going to be major fiscal stimulus from their countries. And even if there was, they're worried about what happened to debt markets there. And on top of that, from their perspective, the real game changer that they're looking for is deregulation in Europe, which unfortunately is not something that they are particularly optimistic about. So I think there is some potential, certainly, that there's good news, at least on one part of the world rather than the other. But how far this can go in the near term, I think is questionable. And certainly we think there could be a near-term pullback for European equities as you start to see some reality set in around what's happening with tariffs and really, how quickly this fiscal stimulus can actually feed through to the German economy, let alone the European economy.
So, Seema, are you challenging this idea that the ball of exceptionalism is shifting over to Europe and China and elsewhere and away from the United States, that's maybe overly simplistic and it's just getting more complicated with a less clear path to which area and which stocks are going to outperform? Is that kind of how you see things?
So I think that the near term is a little bit cloudier than many people have been thinking. I think the near term, there's been so much positivity around the fiscal stimulus news, but there's still, as you said, a lot of things with regards to the tariffs, how quickly the fiscal stimulus can be passed through, that in the near term, some of that optimism around international equities could take a bit of a setback. The other thing that we're thinking is that US exceptionalism shouldn't necessarily be in question. We do think that the US is still going to see superior growth going forward. But is it going to, does that necessarily stop European equities, Chinese equities from doing well? Even a move to benchmark positions for so many investors would be a significant tailwind for equities. So it's just that the world is a bigger place now. There are other opportunities for investors and if you haven't had a chance in the last couple of weeks to get onto that ride, you probably will see an opportunity within the next few months.
Seema, when it comes to the uncertainty in the United States around tariffs, is April 2nd then going to be a clearing event?
Well, on one hand, yes, we hope that there will be some kind of certainty coming through. That is the one thing which is overhanging, particularly for global investors or investors looking at international equities. So I think there'll be some clarity. Does it really clear up everything that we are waiting to hear? I guess I'm fairly pessimistic on that, but at least we're getting to a process that at some point within the next few months, we know some kind of direction where this administration is going, and then businesses can plan. So that's why for the second half of the year, we have a slightly more optimism because we think some of the uncertainty will clear up.
The life of a European-based strategist here, Lisa. Sprinkle of Madrid, a little bit of London, quick trip to Rome. Sounds all right, doesn't it?
Well, I think that we're both really tired.
Plus Germany's spending too, some deficit spending.
Just head over there.
It's all adding up.
Yeah, but as long as you don't fly to Heathrow.
Before, it didn't make sense at all.
Yeah, well, but I will say it's interesting that in Spain, they're not particularly interested in what Germany's doing as being the holy grail, considering that it doesn't necessarily open up the purse strings for them. And frankly, it might make them more in a difficult spot because of what spreads are doing on the periphery.
Seema, appreciate your time as always. Seema Shah there of Principal Asset Management. Let's give you an update on stories elsewhere this morning with your Bloomberg Brief. Here's Yahara Heckers. Hey, Yahara.
Hi, John. London's Heathrow Airport suffering its worst disruption in at least 2 decades. Europe's biggest airport will be closed all day after a fire at a nearby electrical substation led to a major power outage. Heathrow said disruptions will continue for at least the next few days. Meanwhile, President Donald Trump has denied a New York Times report that Elon Musk will be briefed on the American military's contingency planning for a potential war with China. Defense Secretary Pete Hegseth also denying the report, writing on social media that the meeting is about innovation, efficiencies, and smarter production. And day 1 of March Madness was one to remember. 12th seed McNeese State upset number 5 seed Clemson, while Drake pulled off another stunning upset over Missouri, while Creighton dominated Louisville. Elsewhere, Kansas fell to Arkansas and Gonzaga beat Georgia. Day 2 of the tournament tips off at noon Eastern. That's your Bloomberg Brief. John?
Yahara, thank you. Gonzaga getting it done. It's good to see, isn't it?
They're on my bracket. The only time I ever hear Gonzaga.
I say it every year. It's never
every
real
year.
school. Doesn't exist. Never met anyone that's been there.
Yeah, well,
I just come out for basketball once a year and dominate.
And they dominate. So
every time I say this, every year you send me hate mail. I'm just joking. I know it's a real school. Up next on the program, Trump versus the Fed.
Inflation is cooling. The numbers indicate that, and the president strongly believes in low interest rates, and I think the American public do too.
That conversation up next with Adam Hodge of Bully Pulpit International from New York. This is Bloomberg.
Middle East and Africa. Vibrant resources and high-yield investment opportunities abound. Join me on Horizons Middle East and Africa for the stories, newsmakers, and insight from this exciting region. Now weekdays, only on Bloomberg.
Welcome to the world of decentralized finance.
Massive outperformance from Bitcoin.
Bloomberg is covering all things crypto, the people.
The tectonic shift emanating from Washington.
All we're looking for is clear rules and an ability to build in the United States.
Crypto shouldn't be partisan.
The transactions.
Really a record-breaking moment.
Crypto VC is back.
And the technology.
It's really the beginning of a global on-chain economy.
And if America doesn't embrace it, we're going to be left behind.
Bloomberg Crypto, only on Bloomberg.
Asia is at the forefront of some of the world's biggest stories.
And we're here, where the action starts in Sydney.
And in Tokyo, get ahead as the global trading day begins.
The Asia Trade, weekdays only on Bloomberg.
Closing out the week with equities just a little bit softer. We're down by 0.25% on the S&P, softer by 1/3% on the Nasdaq 100. This run of losses on the Nasdaq continues, though, down for 5 consecutive weeks, something we haven't seen going all the way back to 2022. Under surveillance this morning is Trump versus the Fed.
The president has every right to criticize the decision, and he's made it very clear that he believes in lower interest rates are going to help this country boom, and this administration is working on lowering the rate of inflation caused by the previous administration every day. Inflation is cooling. The numbers indicate that, and the president strongly believes in low interest rates, and I think the American public do too.
So here's the latest this morning. President Trump ramping up the pressure on the Federal Reserve, posting for the second time in 2 days that the central bank should do the right thing and cut interest rates. Joining us now is Bloomberg's Tyler Kendall from Washington. Tyler, is this the new normal for Washington now?
Well, John, President Trump has long floated that he should have some sort of influence over FOMC decisions, even as his senior advisors contend that they do respect the Fed's independence. But of course, at the crux of this is that Jerome Powell this week said that tariff policy is already starting to impact the economy and economic projections, and we don't even know the full scope of the White House's plans yet. Now, I went through President Trump's Truth Social posts between now and the beginning of the year so that you don't have to. And the last time that he urged Fed officials to lower their interest rates, it was on February 12th. That is nowhere near an FOMC decision, but it was one day before President Trump instructed the USTR and Commerce to look into his reciprocal tariff plan. And in that post, he said that he felt that lower interest rates would go, quote, hand in hand with his tariff policy. Of course, this tracks with what Dan Clifton told you on this program last hour, which is that it appears President Trump is trying to pursue tighter fiscal policy with looser monetary policy. Now, just quickly for some additional context out of Washington to all this messaging around this, there are heightened concerns about the future independence of federal regulators after this week the Trump administration moved to fire 2 FTC commissioners who were supposed to be shielded by legal precedent from political firings. Of course, Chair Powell deferred on that question when he was asked this week, pointing us to his previous answers that he doesn't believe President Trump has the legal authority to fire him. John, we should note that President Trump has previously said at least that he intends to let Powell serve out the remainder of his term. Tyler, thank you for going through the truths for all of us. And this is a point Lisa has been making all morning. When it comes to April 2nd, the Liberation Day, as the president's talking about it, what can you tell us about what we should expect? Well, at this point, so the reciprocal tariffs, still a lot of questions about implementation and also the timeline. I said yesterday that I'd spoken to Kevin Hassett, who said that the goal is to have those tariffs in effect immediately, but we have gotten those suggestions that it could be more of a rolling process. He also told me, do not expect any carve-outs. At the moment, we know that the administration is negotiating. Some countries might see higher tariffs, some countries might see lower tariffs, depending on how those negotiations go. We're, of course, tracking some key countries here and keeping in mind that those reciprocal tariffs will include those non-tariff barriers like regulations, lax IP protections, and importantly, of course, the value-added tax, the VAT tax, which could really hit the European Union countries particularly hard.
Tyler, appreciate the update. Thank you. Tyler Kendall there. Anne-Marie, I imagine it's pretty difficult to lobby this administration to do anything and change their mind on a variety of issues. There was a great piece in Politico just yesterday. If you missed this was the headline. K Street crashes into a nearly unlobbyable Elon Musk. Lots of people are trying to change policy down in Washington, D.C. This White House isn't blinking.
They're not blinking, and also, who do you call to change that policy. Individuals like Elon Musk is not going to be taking calls really from lobbyists. I don't think he cares as much. So I think your best bet is if you were a corporate executive to try to get on the phone with Susie Wiles or the president himself, if you're trying to lobby for something, which we did see the auto companies do, and they were successful.
I want to see Mike Wirth. What's his secret? Because he seems to be getting some traction down there, and that I think is interesting.
Yes, I agree with you. He's on this program. We brought up the issue of Venezuela with him. You could tell that things were going to get moving on that front.
You know, he has a way, but you know, there are people who are getting through, but there is often a reason that goes to some sort of geopolitical strategy, less than, say, it's going to hurt my business.
Let's get back to that tension between the Federal Reserve and the sitting president. Adam Hodge of Bully Pulpit International writing, attacking Powell and raising more doubts about the Fed's independence are a recipe for more uncertainty and market turmoil. Adam joins us now for more. Adam, welcome to the program. We asked Tyler just moments ago whether this was just the new normal. We see Senator Warren periodically send a letter to Chairman Powell asking for lower interest rates. The president's been very vocal about it as well. Is this the new normal in Washington?
Well, I think we have to take a step back and remember in the first Trump administration, as Kendall was pointing to, you know, we saw President Trump's attacks on the Fed's independence. And, you know, largely, though, Jay Powell stayed in place throughout the rest of his term. But what we've seen in the first 60 days of the Trump administration is a trampling on a lot of those norms that we thought held up in the first administration. So I think there's a lot of questions about the Fed's independence and whether that will be durable throughout the president's first term. And I think that uncertainty is important. Just look at what's going on in Turkey. You all have been talking about it all morning. You know, for the several years, President Erdogan put a lot of pressure on the central bank to take action to lower interest rates, and that plunged the Turkish lira and the economy into turmoil. That's something that we don't want to recreate here.
Hold on, Adam, are you comparing the United States of America to Turkey?
No, but I think you get down this road of injecting political pressure on the independence of the central bank. That makes investors nervous. That makes investors worry about whether you can predict the actual reliability of the central bank policy. That's the uncertainty that I think people are worried about.
Does it give you at least some confidence that the Treasury Secretary has talked about the fact that he's going to leave the Fed to itself? What we're seeing from Donald Trump is basically what we've seen from him throughout his entire course of his political career, which is he's going to share his opinion.
Well, look, I have a quick flashback to my days in the U.S. Treasury Department, where the Treasury and the Fed very much kept their lines of separation, and the Fed's Treasury Secretary did not talk about monetary policy, and conversely, the Fed never talked about the U.S. dollar. That was something that was, almost a golden rule. So I think that, it's the importance for the Fed is important for the Treasury Secretary to speak to, but getting into what the Fed should or shouldn't do, I think, is a red line that shouldn't be crossed.
Let's put aside just the truths that are having to do with the Fed. It raises a question of what President Trump is trying to get in front of on April 2nd, when we do get a list of tariffs that hopefully will give us a bigger picture of what the actual landscape looks like. Adam, is there anything in the potential proposals put out there in the different buckets of tariffs and trade reorganization that you, with all of your experience at USTR, et cetera, the Treasury Department, that you agree with, that you think is the proper way to go about doing things?
Look, I think so you can think about it this way. You almost want to make like a March Madness bracket of potential options that the president could unfold, right? You have a potential 301 investigation, which would be of the normal process. You'd get a lot of feedback from different players in different countries, and it would take some time, but you would have a very clear, orderly process. And importantly, it would protect the USTR and the administration from any legal challenges to any of the tariffs that were put in place. I think you get into the other parts of the bracket, IEPA or some of the Section 338, some of the other potential authorities, it gets a little bit trickier to figure out whether you actually have the president has the authority. And I think if there's a real bite in the bottom line from companies, you're going to see much more likelihood that they will challenge the process and the way that those tariffs were put in place. So my advice to the Trump administration, to the extent they're listening to me, is to go through a more structured, normal process. And that will also give the market, I think, a little bit more certainty that they can trust that this process is above board and that they know what's going to happen.
There's a sense that some of the playing field was not fair from a very long time with many different trade partners, and thinking about China and the U.S. in particular, but also other trading partners. I'm just wondering, when you look at the strategy of messaging from both the Republicans and the Democrats, do you think that the Democrats ought to embrace some aspects of what President Trump is doing, since those stuck actually under President Biden, and there does seem to be a sense that maybe some rejiggering makes sense?
I think what you saw from the first Biden administration was a clear embrace of some form of tariffs to help rebalance the trade relationships with some key partners and allies. But it was also coupled with key investments in our supply chains. Like, that is the missing link that I think you've seen so far, is how are you going to encourage domestic production, encourage a lot of the key investments that we need to have a robust global economy that can compete on multiple playing fields. So that is, I think, the key that has been missing so far. Democrats can embrace and should find the strategic reason for tariffs to rebalance certain sectors and certain parts of the economy. But wholesale reciprocal tariffs across the board just creates a whole lot of uncertainty. It's unclear whether the Treasury and Commerce and USTR can actually get that done in the amount of time that they have left. So that's, I think, where the uncertainty, coupled with the lack of investments, is really what I'm looking at.
Adam, appreciate your time. As always, thank you, sir. Adam Hodge there of Bully Pulpit International. Finish on the Democrats there. The numbers are just ugly for them. Over a quarter of registered voters, 27%, have a positive view of that party. These are some of the worst numbers we've seen going back to the 1990s.
And it comes as the Democratic Party is looking to try to coalesce around a message, but we haven't really heard it yet. And Chuck Schumer under a lot of pressure as a Senate Minority Leader after allowing the continuing resolution to go through. A question of who's going to take the helm in the next election cycle at a time when this is a very split party trying to figure out its way.
You see the senator talking about taxes on The View?
I did.
In the last week? Yeah. How not to connect with voters?
Well,
101.
There needs to be some remedying.
Just totally out of touch. A career in politics. No idea what it's actually like to go out into the world and earn some money.
They got a couple of years.
It just doesn't work. Up next on the program, the Cisco Chief Product Officer, Jitu Patel. Do not miss this conversation. Up next.
From our studios in New York and San Francisco, our expert hosts have the data and analysis from the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action. Live every weekday, only on Bloomberg Television. Context changes everything. From the world of politics to the world of business, Joe Matthew and Kaylee Lines deliver news, insight, and analysis live 2 times a day, every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg. Bloomberg loves earnings.
I know it's like your Super Bowl, right?
I can't wait. It's like opening presents in the morning.
All right, it will be exciting.
Nobody covers earnings like Bloomberg.
Listen carefully. Can you hear the rhythm in the markets? Not just in the syncopations triggered by inflation, but in the preludes leading to global elections, in the dissonance that moves the Nikkei, and the rising course conducted by AI. There's music in the markets, and if you want to learn to listen for it, we'll show you how.
Let's check out the market. Equity futures right now in the S&P, negative by 0.2%, looking to avoid 5 straight weeks of losses on the S&P 500, already on a 4-week losing streak, which is the longest going back to August of last year. For the Nasdaq, we are on course for a 5th, which would make it the longest losing streak going back to 2022. The Nasdaq this morning down by 1/3%. Let's get you some morning movers. Let's cross over to Yahara Hackers. Hey, Yahara.
Hi, John. We start with shares of Nike down more than 6% after the company gave a forecast far worse than what analysts were expecting. They said sales will decline in the current quarter, and they expect gross margin to fall sharply. It's owing the weakness to tariffs, the consumer, and simply the impacts of a new CEO trying to turn the company around by clearing inventory to make way for new product. But it's just a tough environment to be doing that. Next up, we have shares of FedEx also falling 7.4% after cutting its full-year outlook for the 3rd straight quarter. They're calling this a very challenging operating environment due to the usual suspects, tariffs, the consumer, but it also says inflation is going to hit the bottom line. So just the latest U.S. corporate warning us about the economy. And last up, I managed to find a riser for you, and that is Lockheed Martin. It's up more than 2% on this news that it's in the running to win a government contract to build the next generation U.S. fighter jet. That announcement by Trump and Secretary Hegseth is expected to come today, and according to our reporting, they will choose either Lockheed or Boeing. The market thinks it's Lockheed. John?
Yahara, thank you. That speaks to the moment we're in, doesn't it?
That the one stock that's
the one you can find.
A defense one that has to do with fighter jets. Welcome to 2025.
Seen a similar story over in Europe as well. On our radar this morning, let's get you some top stories. President Donald Trump denying a report that Elon Musk would be briefed about U.S. contingency plans for a war with China. The New York Times reporting Musk would be briefed by Defense Secretary Pete Hegseth and other top officials. Elsewhere, President Trump invoking emergency wartime powers to boost U.S. production of critical minerals. Trump signing an executive order directing the Defense Department to provide financial and investment support for mineral production projects. And finally, a top story worldwide. London's Heathrow Airport coming to a standstill after a nearby fire caused a major power outage. The travel hub now closed for the day, with more disruptions expected through the weekend. Joining us now on the ground at London Heathrow, Bloomberg's Guy Johnson. Guy, we had this conversation now for several hours. Have we got some more clarity, any details whatsoever as to how this happened?
Absolutely none, John. There was a fire. It happened just after midnight. The fire brigade were called. They put it out at just after 6:30. The airport's going to be closed all day. It is absolute chaos. We've got normally kind of 1,300 flights coming in and out of here on a daily basis. You've also got a lot of incoming flights that were inbound. They've been diverted. There's no indication as to when this is going to reopen. We're being told it's going to be midnight is the kind of the next deadline. But basically, the power could be restored before then. But even then, the airport probably won't close. John, it just speaks to the problem that the UK has right now with just a lack of investment into critical infrastructure. This is a key piece of kit for the UK. It is unbelievable that we find ourselves in a situation that it cannot operate because a substation, an electrical substation a couple of miles north has taken the power out the entire region. It's absolutely amazing that we find ourselves in this situation. At the moment, the government is saying there's no indication of foul play. So that means basically just a piece of kit has failed here, which is unbelievably embarrassing, you could argue, for the UK and the state of its infrastructure.
And I'm sure people will be talking about that for a long time, Guy, going through this and trying to figure out how to prevent it from happening again. In the meantime, there are a lot of people just wondering, can I fly to London? Can I fly to New York? Where am I going to go? Where are the planes right now getting diverted? Is there some sort of effort to divert that traffic, or are they just getting canceled?
Lisa, most of them are just getting cancelled, to be honest. You can't get into the terminals. There's 5 terminals here. You can't get into any of them. Terminal 5, the kind of the BA terminal, operates on a different power grid. The lights are kind of on there at least, but you can't get into any of the terminals. The police will not allow you access into this area, so nobody can even get to the airport. That's kind of the early indications as to where we are right now. The flights that were inbound, they've been diverted all over the place. Some of them have come into the UK, some of them have gone to Gatwick, some of them have gone to other airports in the UK, some of them have gone to Shannon in Ireland. So Ryanair, for instance, is putting on extra flights out of Ireland into the UK, so people that are landing in Shannon can probably get in to the UK. But yeah, most people, I think, to be honest, people are being told not to come here. To be honest, I don't think you're going to see Heathrow's full service being restored probably until early on next week. There are going to be cancellations over the next few days. It is going to continue for a while. Crews are out of position, aircraft are out of position, passengers are out of position. This is the busiest airport in Europe that's got a 24-hour outage. The ripple effect of that is going to be absolutely massive. So yeah, no, you can't travel from Heathrow. Getting in and out of the UK today is really difficult.
4th busiest on the planet. Guy, appreciate the update. Guy Johnson on the ground at London Heathrow. I'm not a Gatwick kind of guy. Not a fan of that airport at all. You've lived there, you know it.
No,
yeah,
I'm not a fan of Gatwick either, that's why I laughed. Or Stansted, but city airports, very convenient.
Very convenient.
I'm sorry, but beggars can't be choosers
right now. Right now I'm just trying to get it.
I mean, go for it.
I'm with you.
You got Gatwick, hallelujah, congratulations.
It's a schlep. It is so far to get to. There's not as many nice stores. I mean, Heathrow is cream of the crop.
First world problems. Okay, let's turn to tech. NVIDIA and Cisco announcing plans this week to extend their partnership, creating their most advanced AI architecture package that will provide secure enterprise AI networking. I'm very pleased to say the Cisco Chief Product Officer and Executive Vice President Jitu Patel joins us now for more. Jitu, it's good to see you, sir.
John, it's great to see you. Thank you for having me.
Thank you for being here. I've wanted to do this for a while with you. We all have. Let's just take a giant step back before we get into this partnership. You know what I worry about? I worry that AI will do to services what manufacturing was done to by globalization. What is the risk of that happening over the next several decades?
Look, at any replatforming that happens, you'll always have some level of displacement of jobs, and we need to make sure that we make it as painless for society to make that transition happen. But I worry less about AI taking my job. I worry more about someone who uses AI really well taking my job. But if you take a step back, it's actually really exciting to see what the possibilities are with AI, because what people, even despite all the hype, what people grossly underestimate is the original insights that AI is going to be able to go derive that don't exist in the human corpus of knowledge that allow us to solve problems that we have not been able to solve until now. And so, you know, whether it be in healthcare or financial services or transportation or whatever industry you pick, you will actually have a reimagination of the ways in which we can solve problems that have not existed up until now. And that's exciting, frankly, because you'll have this, you know, population of 8 billion people that'll feel like it's got the throughput capacity of 80 billion.
Are we seeing that happen right now? Is that a dream for the future or something that's being realized in this very moment?
You're going to start seeing it happen in 2025. For example, there'll be, you know, a meaningful amount of code that'll actually start getting autonomously written. And so you'll actually start to see so many more, the capacity of engineers will actually 10x during the course of 2025. It's exciting to see.
This, as you know, is the societal issue that I'd be slightly concerned about. So there are a bunch of graduates who are graduating over the next couple of years or so, and they went to learn to code because they were told, this is what you need to go and learn to do. And they're coming out into a workforce where maybe they feel like they're no longer needed. What's the advice you'd give to them as they graduate?
Here's the thing that I feel like people, you might overestimate the capabilities on that front, because AI is still not going to have the human instinct and the judgment that you're going to need to have. You're still going to need to do oversight. There's a human in the loop, but now that developer is going to have a companion that can actually do the stuff that they didn't really care to do or they weren't as good at doing. So this is a net positive in my mind, and you're going to see a lot of progress in society because of it, rather than a regression that happens.
Not to build on negativity, because I actually am a very big believer on the positivity, and I'm excited for it. But there is this question of who's going to lose their jobs in the meantime? And John alluded to this idea that it's more of a white-collar issue than a blue-collar issue. And I'm thinking of things that we've heard about, like at banks, where there have been fat fingers that cause transfers or whatever else, and that some of those efforts are being shifted to AI. How significant do you think that transition is going to be?
You will always have some degree of jobs that'll get displaced, and then there'll be new jobs that actually get created. And the thing that we have to keep in mind is there's a lot of jobs that right now people don't have enough labor to get done, that we just don't have the resources to do, that actually don't happen right now. And so what AI will allow us to do is not just go do things that humans don't do as well, not just do things that replace humans, but actually do things that humans don't have the time to get done.
Which industries do you think are being the most aggressive about adapting to different AI tools and bringing them into their infrastructure?
I think across the board you're seeing it right now. In fact, I'd say, 2 years ago when ChatGPT came out, almost every company in every industry went on noticing what's our AI strategy going to look like. And we've now had a couple of years to go bake that. And in 2025, you're going to see this really exciting move from just chatbots to agents, where you'll actually have workflows get automated in every industry, in every sector, in every segment of the market, in every geography. So I feel like there's only going to be two kinds of companies in the world, those that are going to be really dexterous with the use of AI and others that are going to really struggle for relevance.
Before we talk about facilitating that for corporate America, G2, can we talk about how things are changing inside Cisco? Yeah. What's different about how Cisco's operating with these advancements that you're talking about?
We are lucky in the sense that we've actually got a front row seat on what's happening. And everything from the way in which we're building out infrastructure to the way in which we're getting our security and safety parameters in the right way, and then making sure that the workflows get automated. So, how are we using AI in engineering? How are we using AI in our contact center so that when customers call because they've got a problem, we're using AI to make sure that we can help them solve the problems faster? What are we doing in legal? What are we doing in marketing? What are we doing in sales? Each one of these areas is getting rethought and reimagined. It's actually exciting to see.
The whole world's got to do this.
Yes,
every company's got to do the same thing.
Every company, every government.
That introduces this partnership with NVIDIA. Talk to us about that and what's going to change over the next several years with that partnership in mind.
So we're excited. Jensen, the CEO of NVIDIA, put it best. He said Cisco and NVIDIA are putting together the blueprint for securing AI. And look, John, I go talk to a lot of customers all the time, and when you go ask customers how enthusiastic they are about AI, virtually every CEO, we had a study we recently did, 97% of the CEOs said they were excited about AI, but only 1.7% felt prepared. Right? And so there's this kind of dissonance between the preparedness and the level of enthusiasm that's there. And then you ask in the next level question, why do you not feel prepared? There's two reasons that come up. The first one is they don't feel like they've got the right infrastructure in place to make sure that they'll be able to harness the full potential of AI. And the second one is safety and security actually holds them back because they feel like it also is going to have a negative effect on adoption, because if you don't trust the system, you're not going to use it, right? And so those are two areas where Cisco helps customers out. And what we've done with NVIDIA is we just announced a partnership for this thing called the Secure AI Factory. Now, what is an AI factory? An AI factory essentially is a data center that's meticulously built for AI workloads. And what it allows you to do is make sure that you can create these data centers in the enterprise that can allow organizations to fully harness the potential of AI. And so we're jointly partnering over there. It'll be our networking, our security, their technologies. Look, Cisco is one of the greatest networking companies in the world. NVIDIA is a pioneer on the chips and actually created, to some degree, the movement in AI and the combination of the two companies together. And I think you're going to see more and more of this, where companies are going to partner with each other in this ecosystem to really go serve needs of customers and work backwards, even if there might be a slight competitive element.
This is fascinating to me because what it signifies is there's a growing number of companies that don't want to rely on the hyperscalers, that don't want to rely on the cloud systems to provide the artificial intelligence for their businesses. And it raises a question about the model that everyone has bought into in the market, which is that they will be the big beneficiaries. How much is that changing with companies not wanting to necessarily develop their artificial intelligence in the cloud for security reasons and want to have it in secure locations that keeps their data encapsulated?
I think you're going to have both. I think there's going to be probably the fastest growth that hyperscalers experience that they've ever experienced with AI, and they'll be the fastest growth that enterprises have because there will be some data centers that they'll want to repatriate back within the enterprise so that they can make sure that, and especially in areas like inference, you'll actually see a lot more of that. There's two big areas. There's training infrastructure that's needed to train the models, and then there's inferencing, which is what happens when you use the models. And on the inferencing side, you're seeing a fair amount of repatriation of data centers back in enterprise, and I think you're going to see a little bit of both. And we want to make sure that whether you're a hyperscaler, you're a service provider, you're an enterprise, Cisco wants to serve each one of them in a way that they can actually have infrastructure be plug and play. And it's massively simplified. It's still too complicated.
What's the role of government in this? There's tremendous competition around the world. Obviously, I'm thinking of Washington and Beijing. Do you like what you're hearing out of the administration?
I'm actually very optimistic about the kind of things that you're seeing across the board with the enthusiasm on AI. If we weren't talking about AI, I would be concerned. But right now, the governments are talking about it. They're talking about how automation happens within the government, how automation is happening in the private sector, how they're going to make sure that they can accelerate the innovation on those areas. So I think it's net positive.
Are we going to be replaced? That's all we care about.
No, John, you'll still be here, and 5 years from now, I'm still going to come and talk to you at this show, and it's not going to be an AI humanoid. It's going to be John.
That's all I wanted to know. That's all I care about.
How do you know I haven't already been replaced?
That would be incredibly worrying.
Sorry, carry
We had a guest recently who was remote, and I worried it might be AI. Just didn't have a clue. You never know. You never know. You never know. GT,
I'm going to make you an optimist someday. This is going to be a fun world that we live in.
You're slowly converting me. I'm looking forward to being on this journey with you. GT, you're one of the best. Appreciate it. Thanks for being here, sir. Thank you. GT Patel there, the Cisco Chief Product Officer and Executive Vice President. Let's get you an update on stories elsewhere this morning with your Bloomberg Brief. Here's Yahara Hackers. Hey, Yahara.
Hi, John. Defense Secretary Pete Hegseth said he's canceling more than $580 million in Pentagon grants and contracts deemed wasteful spending. In a memo, Hegseth said the programs don't align with President Donald Trump's priorities. Meanwhile, AstraZeneca is investing $2.5 billion in a new research center in Beijing that will include an artificial intelligence lab. The expansion comes as Chinese authorities are investigating current and former AstraZeneca employees. The drug maker's China president was detained last year as part of the probe. Shares are lower 1%. Meanwhile, shares of Micron are lower, down 3.4% after the largest U.S. maker of computer memory chips gave a soft margin outlook. That's seeming to offset what was a strong sales forecast for the current quarter, bolstered by demand for artificial intelligence products. Micron shares are up more than 22% so far this year. That's your Bloomberg Brief. John?
Yahara, thank you. Up next on the program, rising growth fears.
This just makes the growth backdrop all the more critical because the Fed is telling you that inflation will not allow them to be responsive. You have to be invested for a wide range of growth, inflation, and policy outcomes.
That conversation just around the corner with Greg Peters of PGIM Fixed Income. He joins us next, live from New York. This is Bloomberg.
But what about the diagnosis? If the diagnosis at the end is worries about growth rates,
yeah.
How do you get from point A to point B? Why do you worry so much about that end goal of better growth?
Because if we can't grow, you're going to have a much more inflated debt to GDP and federal deficit. and that's not good for the economy. Growth is really critical, and I think what's underappreciated is what the inputs are to get to the growth number. And so we talked a little bit about productivity. I hope that we can continue to produce at 2% indefinitely on productivity. I think that would be great. But you got to make sure you have the other levers in place, I think, to buoy that. So if you look back over the last several years, we've had 8 million immigrants come into this country in the last 4 years. And that's helped growth. And by the way, that's deflationary.
Morning, this is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. These are the stories that set your agenda.
Taking you from the U.S. market's close to the overnight session in Asia, we'll walk you through what you need to know to kickstart Europe's trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in to Daybreak Europe, only on Bloomberg Television. Context changes everything. Bloomberg has the Fed decision under surveillance, with the fastest coverage and exclusive analysis, including Powell's press conference. Nobody covers the Fed like Bloomberg. It's a multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. ETF IQ, only on Bloomberg.
Equities are a little bit softer here. We're down by 0.25% on the S&P. On the Nasdaq 100, down by a third. Isn't G2 Vitalis Cisco great?
Oh, that was so much
Just
fun.
Fantastic.
You're all Debbie Downer. I love this.
He's slowly converting me.
Good, I'm glad.
Slowly converting me.
I mean, scary. I'm optimistic. I think that it'll be great when we can have a more efficient life. And frankly, that's the reason why I am now a bot and I'm not actually real.
Some people might believe that, Lisa. At the Savannahs this morning. I'm joking. Rising growth fears.
This just makes the growth backdrop all the more critical because the Fed is telling you that inflation will not allow them to be responsive. The question is, how much of a growth deterioration needs to occur before the Fed can react? And it seems to be that the bar is pretty high. You have to be invested for a wide range of growth, inflation, and policy outcomes.
So here's the latest this morning. The Fed cutting U.S. economic growth expectations amid rising uncertainty. FedEx and Nike joining corporates issuing new warnings. Greg Peters of PGIM Fixed Income writing, our base case is still broadly constructive, but our view of the balance of risk is more bearish than the market. U.S. spreads are starting to price in higher recession risk. Greg joins us now for more. Greg, welcome to the program, sir. I just want to sort of back up and go back a few months because it's been a while since we really got some detail about where you were seeing things going and what you expected. Did you expect this repricing that we have seen over the past month?
Yes and no is the answer. We were pretty constructive going into the year, felt growth was in a very good place. We were talking about and worrying about what we called this sequencing problem from a market standpoint, where all the bad policies are up front from immigration and tariffs, and then the better policies are down the road. And so we felt we'd be in this vacuum period in the first quarter or first half, and that's what we're getting. What we didn't anticipate nearly enough was a disruption in the process. And the question on the table is how much of that disruption will hurt growth in ways that we didn't, initially forecast.
Greg, you've been bullish, though, on bonds, in even long-term bonds for quite a while. The other aspect that we didn't anticipate was the German fiscal package that could amount to some trillion euros over the next 10 years. How much does that change your outlook for longer-term benchmark yields globally, but also in the United States?
It does change it on the margin, absolutely. There is a natural bias. Domestics want to invest in their, home country, so to speak. If you look at the flows, the flow from Europe into the U.S. bond market has been pretty pronounced. I expect that to slow. That's why the bond market did react to the kind of the QT tapering or slowdown, from Tuesday or Wednesday. But yeah, I mean, what we're seeing is that there's less and less buyers of U.S. Treasuries, right? There's a tremendous reliance on kind of this hedge basis trade, and foreign investors have, stepped away in a pretty meaningful way. So it's something to watch out for, and all else equal, Lisa, it puts pressure on bond yield and steepens out the curve.
This creates a real question and conundrum, frankly, for a lot of credit investors who came into the year. Some people argued price to perfection with this belief that we would have a fantastic economic backdrop with growth, with also disinflation as an ongoing backdrop. How much has that shifted? The idea that on one hand, disinflation has its limits, along with the fiscal impulse elsewhere, plus the idea that maybe the economy isn't going to be as good.
Well, we are credit investors, and at the end of the day, being so-so is exactly where we want to be. So the question is, do we avert a recession? I think we do, but the risks have definitely increased, and that's a very good backdrop for credit. So credit investors want this, plodding along where businesses are maybe a little more concerned. They're not spending, the way that equity investors would ordinarily like. And so we're potentially here in a very good place for credit, but the risks are just so high, the uncertainty so high, it really makes it a challenge. But go back to your original statement, Lisa. Risk reward entering this year was absolutely horrific. We were in the top decile of valuations, and so it just really wasn't a good environment from that standpoint. So it's not about the macro so much from the credit side, it's about the valuations. And valuations are still pretty stretched in my view.
Yeah, Greg, I can't think of a single time, in recent memory at least, where sentiment seems to have collapsed as much as it has, yet the price of assets haven't. If you look at the index on the S&P, we had a 10% correction, but if you listen to the way people talked about it, it felt like we were down 20, 25% on the S&P. Similar story with credit. The way people talked about the economy, you'd think credit spreads were 200 basis points wider in just a couple of months, and that's certainly not the case at all. Greg, how do you reconcile those two issues?
Because I think broadly the macro's in a pretty good spot, and that's what investors are focused on. It has been a surprise. The delta from an expectation standpoint has, I think, been the big change. But at the end of the day, the fundamentals are actually reasonably pretty good. And so it makes sense to me that you didn't see this massive repricing. Marginal repricing, because what's changed are the tails, right? The tail risk has increased. The modal outcome might be, virtually unchanged, but the tail risk, and that has to manifest itself in the pricing. That's not a wholesale resetting of pricing. That is a marginal reset of pricing.
Greg, appreciate the framework to think about this. Thank you, sir. As always, Greg Peters there of PGIM Fixed Income. We've had a meltdown in sentiment, not in the market. At some stock level, I know some single names have had a really tough time, but at the index level, not much of one at all.
I love Greg's point that credit investors like it when people aren't too happy, because that means that they're going to be a little more conservative, which means you'll probably get paid back.
Moody bond investors.
I mean,
seems to be a thing. I know.
I get it.
It resonates.
It totally does.
I know. Kate Moore of City Wealth joins us in just a moment. Patrick Moorhead of More Insights and Strategy. David Miracle of Goldman Sachs. And Vishy Tripatur of Morgan Stanley. This is Bloomberg.
Joe Walk is helping steer J&J into a new phase of its history, expanding the frontiers of healthcare by discovering drugs and advancing medical technology.
Developing digital robotic capabilities where it's not just the robot doing a surgical procedure, it's garnering information from that procedure for your specific demographic or the patient's demographic, and then informing the next procedure down the road. Right? It's getting smarter. I would say it's starting to morph into personalized medicine, which we know will lead to the best outcomes.
Innovative medicine and medtech are run as separate business divisions, but in the culture of research at J&J, they interact.
If you look at some of the spaces that we're in today, specifically oncology, there is a lot of dialogue going back and forth. I think it's something that will position us extremely well as we talk about not only a continuum of care, but also a continuum of knowledge.
The convergence of technology and medicine is driving innovation in both sectors, with scientific and commercial possibilities just beginning to come into focus.
I'd like to actually see some partnerships down the road happen between healthcare companies and technology companies. I think we'd get to better outcomes faster if we did that. Right now, technology companies don't have the healthcare knowledge. Healthcare companies probably don't have the breadth of knowledge they need for technology. If we can figure that out together with great minds from both sides, I think that leads to a much better place.
From the beating heart of global finance, economics, and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. What do you think the future is for inflation? Is this new normal? Are markets too optimistic? How do you worry about the things that are outside your control? How does the current fighting completely stop? I'm Francine Lacroix, and this is The Pulse, every weekday only on Bloomberg.
What about artificial intelligence? Is artificial intelligence going to enable you and others to say, we have enough information to know exactly what something is going to be worth in terms of insuring it or not?
Artificial intelligence is finding its way into our business in a variety of different factors. I think the first piece is getting much better insight into data, which allows us to make better decisions on underwriting. It's also a great opportunity to service business better in terms of like call centers and different ways of what's using robotics and other AI will be very helpful. But it is an emerging practice within the industry and one that is evolving very quickly. So it's also going to present risks that other companies, how they use it and how they use large language models and making sure the decision making is very sound. So it's complicated, but it definitely is benefiting the business today.
Jumpstart your trading day on Bloomberg Open Interest.
2 hours of single stock stories that are driving the opening bell action.
We'll take you to Wall Street, Main Street, the C-suite, and beyond.
These are companies that are growing their market.
The great companies in the U.S. are the companies hitting the cutting edge. That's a different story.
Get the inside track on what's buzzing in markets.
With the players who are shaping the narrative.
If you have bad earnings reports, you're going to get punished.
They're not buying what the industry is selling. Join us on Bloomberg Open Interest every trading day, only on Bloomberg.
Bringing you up-to-the-minute geopolitical news whenever and wherever it happens. I'm Stephen Engel at the Forbidden City in Beijing, and this is Bloomberg.
Everyone has a view about what the Fed should do.
You're going to need to see some weakening of the hard data beyond what we've seen so far to get the Fed really moving.
Policymakers have to pin down a forecast and think about what the future might look like.
I do think that the economic data will justify a cut by May. As long as they're talking about it at the May meeting, that should ease financial conditions.
What actually is quite clear is they just don't know, and none of us actually know exactly what's going to happen. They're in a really tough spot at the moment.
This is Bloomberg Surveillance with Jonathan Farrow, Lisa Abramowitz, and Anne-Marie Hordern.
The opening bell, 90 minutes away. The third hour of Bloomberg Surveillance starts right now, with equity futures negative by about a third of 1% on the S&P 500 through Thursday. Just about positive on the week so far, following 4 weeks of losses. On the Nasdaq, though, we are poised for a fifth consecutive week of losses on the Nasdaq 100, and we add to them this morning. We're down by 0.4%. A couple of single names to look for this morning. Nike's one, FedEx is the other. FedEx. It is so difficult for this company to have any visibility whatsoever. They just keep cutting guidance, and they've done it for 3 consecutive quarters.
And one of the fundamental reasons why is the business-to-business aspect of FedEx is really a big question mark right now. Not only is the international picture with tariffs, et cetera, but the capacity for companies to be able to spend in some sort of substantial way is just not clear. They're sort of the epicenter, the example of the lack of clarity around the corporate sphere around the world right now.
They're also lifeblood of the economy when it comes to logistics. When you think of things like tariffs, like de minimis, and potentially the provisions around that, and if that might end up sapping some of the demand for some of these smaller packages, it's very difficult right now. What we continuously see from company and company, a litany of them talking about they just cannot plan for the future.
We're getting so many conflicting reports from the economic data, soft versus hard from corporate America. Chairman Powell sees it this way. We do understand that sentiment has fallen off pretty sharply, but economic activity hasn't yet. Goes on to say, I would tell people the economy seems to be pretty healthy. That's where Chairman Powell is at. That's the Fed chair. This is where the president's at. The president's in a very different place. He believes they should just start cutting interest rates, and he keeps pushing this point day after day.
He's a real estate developer. What do you expect him to say? I mean, essentially, that is just the bottom line. It is a little bit of a different tone, just because initially we were thinking that this administration was more focused on the 10-year yields, and Scott Bessent certainly is. A large question of whether this is trying to get ahead of what they're about to announce on April 2nd, given the fact that it could potentially be something of a shock, along with a lot of people talking about price pressures ongoing.
If you're going to have higher prices, even if it's a one-time price hike, potentially where can you offer some relief elsewhere? The president's saying that because gasoline is down, which is going to be fickle, and because eggs are down, which they're only down wholesale, not what consumers are seeing at the grocery store, that is reason enough for the Fed to cut rates. Jay Powell doesn't see it that way.
So that's the latest on the Federal Reserve. We'll have plenty of chat on that through the hour. I imagine some of you are joining us this morning to get an update on what's happening over at London Heathrow. We'll catch up with Guy Johnson later on this hour. London Heathrow is closed all day due to a power outage caused by a fire at a nearby electrical substation. What caused that fire, we don't know. The Met Police putting out some headlines this morning saying there's currently no indication of foul play in the fire. They're working with the London Fire Brigade to establish the cause of it. But ultimately, we haven't got any details on how this happened.
Let alone when it's going to be resolved and when we're going to have a reopening of Heathrow. Guy Johnson just on less than an hour ago saying that it's likely not going to be fully operational until at least early next week. That is a lot of flights for the fourth busiest airport in the world.
This is what the airport had to say this morning. Passengers should not travel to the airport under any circumstances. What a mess this is going to be.
Yeah, the lights aren't even on in certain places. This is a problem right now for such a busy airport, and it raises questions about disruptions. It also raises questions for the airlines that already have flagged concerns about consumer demand at a time where there is this level of uncertainty. How do you deal with a week of canceled flights, given the fact that this is one of the busiest corridors that we have?
As Guy said, it's just not a good look for the public relations team over at the United Kingdom, is it?
It's not a good look is an understatement.
London Heathrow's like jewel in the crown kind of stuff. It's not a good look at all.
Especially if you think about their need to rebuild infrastructure and their lack of borrowing capacity, given some of the constraint on the budget.
It's a major hub, 200,000 people, 1,400 flights, and the fact that they can't actually give you guidance on when they may reopen, I think that's going to be the biggest problem.
Brutal, and brutal for many of you, I know. We'll try and get you some updates through the hour right here on Bloomberg TV. Equity futures on the S&P, negative by 0.2%. The opening bell just around the corner. Coming up on the programme, Kate Moore of City Wealth on why it's too soon to add risk. Patrick Moorhead of More Insights and Strategy on a wild week for the Mag 7. And Vishy Tirupattur of Morgan Stanley on why he lowered his growth forecast. We begin this hour with stocks lower. Kate Moore of City Wealth writing sentiment has weakened but not fully collapsed. And absent full capitulation and with persistently high uncertainty around tariffs, growth and policy, we believe it is too soon to step in. Kate joins us now for more. Kate, good morning. Good to see you.
Yeah, thanks, John.
Congratulations on the new seat as well.
Thank
you. It's the first
you.
time we've seen you since you moved over.
Yeah, I had a nice break, and I've been getting ramped up at Citi. You know, it sort of pains me to have to write what I just wrote and what you read. You know me, I like risk. I've always liked to look at opportunities. I like to see when there are dislocations and say this is a nice time to step in. And right now, to the conversation you guys were just having around uncertainty, not just in terms of the macro forecast, but also in earnings, it's almost impossible for me to say, we've seen the bottom, we can break out of this trading range, and it's time for us to add.
There's always a price. Have we reset price low enough? How much more do we need to do that? Have we reset expectations sufficiently? What would you look for that would change your mind, that a risk reward would become more compelling?
Well, one of the things that I keep getting my head stuck on is everyone's focus on PEs, right? On multiples and valuation. And they keep on saying over and over again, you know, we've derated a little bit. It's now looking a little bit more attractive. And I say, that's great. We have no faith and confidence in the denominator. And against that backdrop, if you don't know what you're measuring yourself against, like, are we cheap? I don't think so. Look, there are super high quality companies in the US. I know we've had some rotation away from those companies over the last couple of weeks of trading. But you know, that doesn't mean we need to step in and kind of back up the truck and add back to those companies right now. And I hate, as I said, sitting on my hands a little bit because, like everyone else in this business, I have a bias to action.
How inconsistent are some of the projections that we're getting right now out of Wall Street?
Oh my gosh.
Well, on one hand, you've got, I know, it's a big question. You want to just start there?
Yeah, no, this is, I mean, it's a terrible time to have to put out forecasts. I'm fortunate enough to not have to put a target on the S&P or say, here's my technical buying level or here's my earnings expectation at the moment, because it is going to be a losing game at this moment. We could get to April 2nd and have some clarity. I would put a much higher probability that we don't have clarity after April 2nd. And so people are going to have to make these constant revisions. And especially as we were talking about before, corporates don't know what's going to happen. One of the things I'm worried about and / watching as we go into this next earnings season is not just whether or not companies take down their guidance, but whether or not they pull guidance altogether. If they say we don't have enough information to even reaffirm or adjust or even take down what we've given you before, we're going to step back. That tells us that kind of all bets are off, and kind of continuing to sit on the sidelines makes some sense. Now, to be fair, for like Citi Wealth clients who have multi-asset portfolios, we're not saying sell. But, there are a lot of folks that have big cash balances, and we want to be convicted when we say put that cash to work.
That was what I was just going to ask. What does sitting on your hands actually mean in financial terms? Does it just mean sitting on cash? Does it mean sitting on gold, going to London?
It means not making big asset allocation decisions right now. Let's wait for more information. And whether that's, tweaking our equity allocations or looking for more opportunities across the fixed income or alternative space, like, we don't need to do that right now. Let's wait for, hopefully, what will be a little bit more clarity.
Do you think you're going to have the conviction after April 2nd to make some of those decisions?
I think April 2nd is an arbitrary date. I mean, it is a point at which we will have some information on tariffs, but we won't have a significant outlook for the entire policy program in the U.S. And until we have that, it's pretty hard to say, what the growth forecast should look like. This is what I would also say. We have a pattern of behavior from this administration over the last couple weeks or a couple months that suggests there's, a constant revisiting of their own targets and what pain they're willing to take, even as they stay focused on what they believe their big goals are. And the communication has not always been consistent to the corporate sector and to the investment community. And I don't know that that changes just because we get to April 3rd.
One thing is consistent. The president this morning, just minutes ago, saying April 2nd is Liberation Day in America. But to your point, to a lot of people's point, they're not expecting April 2nd to be the end all, the be all. If uncertainty is a feature, not a bug, how do you do this for 4 years?
I think you're going to have to stay really focused on the areas where you do have certainty. I always have a bit of a laugh when everyone says we want to own quality companies. No kidding. There's no point in the cycle where you don't want to own a quality company. And like any fund manager or investor says, like, I don't care about quality, I mean, I think you should probably head for the door. But what we're looking for, I think, in an environment where there is a lot of uncertainty is earnings sustainability and earnings stability, basically, in general. We want companies that can earn through all parts of the economic cycle, that have strong products and business models and really outstanding management teams that we can have faith in. When it comes to fixed income, we're going to have to see what happens to the inflation and growth side. So I can't say for sure what that kind of uncertainty will mean for that allocation.
The new policies are confusing. The administration, they seem to change every day, and they can change again very soon. And they will do on April 2nd, and maybe again multiple times after that as well. That's hard enough. Understanding how the rest of the world responds to it is equally as complex. How much has Europe's response to this complicated how we allocate assets in the United States?
Look, I know people have gotten really excited about, closing their underweights. I'm not going to say going explicitly long Europe, closing their underweights to Europe. And they've said, look, there's some of these pockets of fiscal stimulus, something we haven't gotten in a long time, and they've gotten really excited. I don't think that we can say we're going to make a wholesale regional equity change based on a few policy announcements. And unfortunately, and I hate saying this, but I'm going to say it anyway, when the U.S. sneezes, the rest of the world catches a cold. If there's a significant slowdown in demand and activity on both consumers and businesses in the U.S., it's really hard for me to imagine that all these global multinationals domiciled in all these other markets won't feel it and that consumption patterns won't change.
So you don't buy into the erosion of U.S. exceptionalism?
I think the U.S. has some really exceptional parts of our economy and our corporate sector, but we are at a more challenging part of the cycle. The other thing I would say is, even going into this policy uncertainty, you guys know this very well, some of the macro data was slowing a little bit before any of this uncertainty was introduced. There were some pockets of retail and consumer. We were talking about that a year ago, remember? As we were going through first quarter earnings for 2024. Everyone was saying, is the consumer cracking? It didn't fully crack, but as we got into the beginning part of this year, some of those fractures look more pronounced. So that happened before the policy uncertainty, and I think we have to keep a very close eye on that.
This speaks to the wait-and-see moment that so many people are in right now, not just businesses, but investors too.
I just want to know what's going to end that, right? If it's not April 2nd, if it's not necessarily guidance that companies can't give, what's going to give anyone a sense of conviction at a time of endless uncertainty?
Yeah, I wish I knew right now. And if I had the roadmap and my crystal ball was crystal clear, that would make me sleep a little bit better at night at this moment. But I will say, here we are on a Friday morning, and we know a lot of investors, both fast money and real money, don't really want to go into the close today or into a weekend, super long risk, you know, because of the uncertainty factor. I want to see a change in that overall behavior. Once we start to really neutralize some of the big overweights and sometimes underweights that people have had in their portfolios over the last couple of years, and people feel confident that what they're owning and what they're adding to can, you know, perform in a sustained way over multiple quarters, like, I'll sleep a lot better. I just don't think we're there yet.
Kate, it's good to see you.
Yeah, thanks for having me.
Happy to catch up. It's been too long.
Yes.
Hopefully we can do this more often. Kate Moore there of City Wealth. Kate, thank you. Let's get you an update on stories elsewhere this morning with your Bloomberg brief. Here is Yahara Hacker. So, Yahara.
Hi, John. London's Metropolitan Police says it sees no current indication of foul play in the fire that shut down Heathrow Airport. It says it's working with the London Fire Brigade to establish the cause of the fire, which happened at a nearby electrical substation. The closure brought travel to a standstill for hundreds of thousands of people. Meanwhile, a Maryland federal judge has temporarily blocked Elon Musk's Doge team from accessing Social Security records. For now, it stops Doge from seeing the personal information of potentially hundreds of millions of Americans who receive Social Security retirement pay and other benefits. Musk has called the program a Ponzi scheme. And investors are dismissing the risks a full-on trade war would pose to stocks. That's according to Bank of America's Michael Hartnett. In a new note, he cites, quote, monster flows of capital that keep pouring into global equity markets despite all of the recent tariff announcements. That's your Bloomberg Brief. John?
Yahara, thank you. More from Yahara later on this hour. Up next on the programme, the morning calls, plus Patrick Moorhead on a wild week for big tech. That conversation just around the corner. Live from New York City this morning. Good morning.
Influencing global markets.
Technology is driving business across Europe.
Companies in Asia are betting on tech.
Welcome to the world of decentralized finance.
Massive outperformance from Bitcoin.
Bloomberg is covering all things crypto, the people.
The tectonic shift emanating from Washington.
All we're looking for is clear rules and an ability to build in the United States.
Crypto shouldn't be partisan.
The transactions.
Really a record-breaking moment.
Crypto VC is back.
And the technology.
It's really the beginning of a global on-chain economy.
And if America doesn't embrace it, we're going to be left behind.
Bloomberg Crypto, only on Bloomberg.
Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade.
This is Bloomberg Technology.
This is the Asia Trade.
This is Wall Street Week. Welcome to Balance of Power.
This is Bloomberg Television.
When were you two this excited for a weekend? What's going on here?
Trump world.
I mean, come on. Are you? You're not?
No, I love doing this.
Okay, but
I do.
Look, we all love doing this.
Every single minute. This means so much to me.
I understand that.
Wish it away, Bramo. You know, it's got to get through the rest of the hour.
Really?
Yeah, it's important stuff.
Thanks for throwing me
Equities down a whole quarter of 1% on the S&P. On the Nasdaq 100 down by a third. The opening bell 1 hour and 13 minutes away. Let's get you some morning calls. First up, JP Morgan cutting its price target on FedEx to 280, highlighting its weak outlook. That stock is getting hammered in the pre-market. It's down by 9%. Your second call from UBS, lowering its price target on Nike to 66, expecting the trade war to continue, weighing on profitability. That stock is lower by more than 7%. And finally, Morgan Stanley trimming its price target on Tesla to 410, pointing to weak auto deliveries and negative investor sentiment. You can say that again. What an ugly month for that stock.
And it's gotten so ugly that Elon Musk is even responding to it with talking to some of the people in the company and saying, guys, it looks really bad, but believe me, we can get through this.
It's gotten so ugly that the Commerce Secretary, who used to run Cantor Fitzgerald, went on Fox News and said you should buy this stock, which I have to say is raising a lot of concern in Washington about whether or not that is not just appropriate, but legal.
Yeah, that's new. Something we haven't seen before, isn't it?
Well, you know,
cabinet officials.
Old habits die hard, you know. Look, it's not just cabinet officials. This has been sort of increasingly by government officials being made into rally around the stock. There's nothing wrong with it, which only makes it more political. I mean, it really raises this issue for Tesla that shows the sort of liability of how closely they're associated with this administration.
Got to get a price target next time. Let's get to Mag 7. The stocks are down nearly 15% so far this year, led by double-digit declines from Tesla, Apple, and Alphabet. NVIDIA's AI conference failing to give the group an extra boost. Patrick Moorhead of More Insights joins us now for more. Patrick, welcome to the program, sir. The Mag 7, just in terms of a concept, a term, just how useful is that anymore?
Well, I think it's useful as a barometer for the biggest in tech. And remember, it varies, it changes, right? We used to have FANG, and now we have the Mag 7. I think it could change if some companies nosedive, new growing companies come in there. I think we'll find another acronym for that. But I think overall, it's a pretty good bellwether for how big tech is doing.
Why is big tech doing so badly? And I ask this because they haven't posted terrible returns. There still is AI adoption. We were just talking to Jeetu Patel of Cisco about how this still is the holy grail for companies and is rapidly in expansionary territory. I don't understand if this is a valuation thing, if this is an American exceptionalism story, or if there are some other issues here under the hood.
Yeah, so there's 2 or 3 things going on. So at macro, I think Kate did a good job in your previous segment talking about risk, right? How do you play this? Recession, consumer confidence, interest rates, tariffs. And if you listen to the forecast for the earnings calls of some of these tech companies, there was a lot of uncertainty. I think that's bleeding over. And then you have this general fear, which is related to consumption, which is, hey, all this CapEx investment, somebody has to consume that at the end. Companies that serve consumers and companies that serve businesses have to make incremental profit dollars off of that. And I think that risk, that discussion is showing its ugly head here with the Mag 7 that, quite frankly, are being driven by really, good earnings, good cash flow. But in the end, it's this promise of mega growth delivered by the AI trade.
Well, it goes to the question that John really asked to start off the conversation, which is how much can you really talk about Magnificent Seven when there are a lot of distinct buckets and companies within that are dealing with different aspects of that. I think of Apple as being very much susceptible to some of the consumer pushback and some of the smartphone cycles. I think of Tesla as having a whole bunch of issues around that. With the likes of the cloud, with Google, with Amazon, with Microsoft, how much can they be more insulated from some of that volatility, since their issue is that they think people can't invest enough? And we're hearing that from a lot of companies themselves.
Well, those companies just listed off, they essentially make the foundation for AI. If you're going to do something useful downstream, if you're a consumer company or you're an enterprise SaaS company, they're investing the hundreds and billions of dollars in CapEx to be able to deliver that. I think the focus right now should be on those consumers of AI. The Consumer plays, Apple was a great example. HP is another great example. How about Salesforce, right? We've seen ServiceNow racking up double-digit growth, but that's not necessarily all on the back of AI. How about SAP? Once we see those downstream companies being able to better leverage and monetize AI, I think a part of the risk scenario here, not the macro point, but this consumption conversation will be put to bed.
Patrick, how long before we get to that moment? You mentioned Apple. So Apple's had a difficult time of it, down by double digits for the year, and for that matter, for the month so far in March. What's going wrong for Apple, and how quickly can they turn this story around?
Yeah, the challenge with Apple is twofold. So first of all, they really do not have any core competency in the cloud. And when it comes to the delivery of many of these experiences, it requires cloud competency, and Apple doesn't have it. The most sophisticated thing Apple does in the cloud is backup and streaming some video. And secondly, what I think is becoming a reality right now is that Apple didn't put enough resources on the smartphone to help them create relevant on-device AI experiences that keep your data private. And without getting too technical, they didn't put enough memory in there to run these workloads. And I think they're running into that. I think thirdly and finally, Apple knows that their future business is based on not messing up as opposed to innovating, and they're going to be super risk averse when it comes to any type of AI type of implementation. And as we've seen, right, we've played around with ChatGPT, Grok, et cetera. You can get results that might not be savory for the Apple brand, but we know it as consumers that AI isn't perfect. In fact, it's perfect in its perfection. Don't quite know what type of result you're going to get. And I think it's going to be a very tough road for Apple in the future because of these core competency issues in the cloud and under-speccing their devices.
The stock is down again this morning. It's down by about 1%. Patrick, appreciate your time, sir. Patrick Moorhead there of More Insights and Strategy. The latest reporting from Mark Gurman, just speaking to some of the confusion and the lack of progress on big issues over at Apple. This, according to people familiar with the situation, that Apple is undergoing a rare shakeup of its executive ranks, aiming to get its artificial intelligence efforts back on track after months of delays and stumbles.
This has been a huge issue for Apple and just speaks to maybe an ongoing delay as they try to ramp up new leadership in the unit. They have fallen behind on this. They've not gotten certain key deliveries. It's been beyond just simply conceptual, and it raises this issue of how do they get back on the front foot when they've got some real competition, particularly in China?
Stock is down on the session, down on the month, and down on the year so far. Up next on the program, we'll talk about the U.S. economy, a recent downgrade to the outlook from Goldman Sachs. David Merrick was going to join us shortly, and then we'll get the bond market view from Vishy Tirapatur from Morgan Stanley, from New York City this morning. Good morning to you all. You're watching Bloomberg TV.
From our studios in New York and San Francisco, our expert hosts have the data and analysis from the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action. Live every weekday, only on Bloomberg Television. Context changes everything. Bloomberg brings you breaking news 24 hours a day. Powered by more than 3,000 journalists and analysts in more than 100 bureaus across the globe. Bloomberg Television. Context changes everything.
Bringing you up-to-the-minute geopolitical news whenever and wherever it happens. I'm David Gura in Rio de Janeiro, Brazil, and this is Bloomberg.
Listen carefully. Can you hear the rhythm in the markets? Not just in the syncopations triggered by inflation, but in the preludes leading to global elections, in the dissonance that moves the Nikkei, and the rising course conducted by AI. There's music in the markets, and if you want to learn to listen for it, we'll show you how.
Shots fired at baseball just moments ago. Should we go there?
I mean, it's just like, really? On a Friday?
Cheap imitation of cricket.
That's just unacceptable.
That did not come from me.
I know, but you really seem to empathize with it.
No, it made me laugh.
I want to
smile.
put it up. Okay, John, why do you feel that way?
Made me smile.
Why do you feel that it's a cheap imitation?
I grew up with cricket.
Yeah.
I don't understand the rules of baseball.
Okay, but it's the understanding issue.
I appreciate baseball.
Oh, good.
Don't understand the rules of baseball.
Like the Mets.
I appreciate some of the athleticism in baseball.
Okay.
Aaron Judge.
Yeah.
When you see Aaron Judge in real life, it's like this giant, absolute beast.
The power to get the balls to go that fast really is amazing. And
I respect that.
I don't know that cricket has that.
Well,
no, just kidding.
Our next guest might leave the studio.
All right, please say.
All right. Equities at the moment on the S&P down by 1/3 on the S&P 500. Softer, the opening about 60 minutes away. On the Nasdaq 100, we're down by 0.4%. President Trump pressing the Fed to cut interest rates, posting on Truth Social again last night that egg prices are way down. Groceries and gasoline are down. Now, if the Fed would do the right thing and lower interest rates, that would be great. David Merrickle of Goldman Sachs writing, Powell reiterated the FOMC is well positioned to wait for further clarity. We have left unchanged our forecast for 2 cuts this year in June and December. David joins us now for more. David, welcome back to the program. Since we last spoke, there was a downgraded cut to your GDP outlook. So let's build on that. What led you and the team to reduce your GDP forecast for the United States?
So we're 2 months into the administration, and we think that we've learned that the tariffs are likely to be larger than we had expected, say, between Election Day and Inauguration Day. We've bumped up our forecast for the eventual increase in the effective tariff rate from a 3 percentage point increase as of Inauguration Day to a 10 percentage point increase. There are a few signals that we've gotten from the administration, some of them subtle. For example, with the China tariffs, there's been none of the differentiation between consumer and non-consumer goods. The move ahead on at least small tariffs on Canada and Mexico, and a lot of signals pointing to an eventual critical imports tariff and a reciprocal tariff. And we think all of that's going to eventually add up to a larger increase. That means higher prices, and we think lower GDP growth this year, because the higher prices will function as a bigger hit to real disposable income and to consumer spending. The impact on financial conditions has been pretty tame so far, although if we do get larger tariffs, that could worsen. And we think that the uncertainty effects are much worse this time than they were in 2019, because far more American businesses are likely to be affected by tariffs that would really affect the whole world rather than just the U.S.-China bilateral trade relationship.
The uncertainty effects is exactly where I wanted to go, David. How much of your forecast and the downgrade to growth is coming from the tariffs themselves, and how much is coming from a prolonged period of uncertainty that's preventing certain companies from making any decisions at all, let alone investments?
I think the uncertainty effects do go beyond trade. The downgrade that we made to our forecast was really centered on the changes to our tariff assumptions. On other areas of policy, I would say there have been smaller surprises. We did also bring down our immigration assumption a little bit because we've seen a very sharp drop-off there. Fewer people means fewer workers, and that means slightly lower GDP growth. But really, it's been concentrated on tariffs. I think what is different this time, at least if we do wind up getting the tariffs that we expect, is that last time this was mostly just between the U.S. and China. U.S. industry and Chinese industry don't overlap that much. U.S. manufacturers don't use that many Chinese inputs. They generally don't compete as much in the same output markets. And China's retaliation last time was pretty confined to agriculture. In contrast, if the administration goes ahead with a critical imports tariff and a reciprocal tariff, I think many American companies will find themselves affected on the input side, the output side, or from foreign retaliation from any of many countries. So the uncertainty effects, I think, have a broader impact on American business. I do think it extends beyond trade, for example, with some of the spending cuts. Even if the spending cuts don't wind up amounting to a huge amount, for the last couple of years, healthcare, education, and government have really dominated hiring in the U.S. And those areas of the economy, directly or indirectly, many healthcare providers, many state and local government agencies, many schools and universities depend at least a little bit on federal payments. And if all of a sudden they're worried about losing access to some of their funding and having to engage in cost cutting, I do worry a little bit that they'll hold back on hiring, not wanting to be in a position where they'd have to lay off even more people. So I would say the uncertainty effects are mostly, but not entirely, about trade.
When it comes to trade, though, how do you incorporate the retaliation we could see by other countries? And to your point, it's not just the U.S. and China. There's a bigger scope this time around.
Yeah, that's right. We generally assume pretty full retaliation from most other countries. That's what you see in past trade disputes. The U.S. and Canada, the U.S. and Europe have been involved in trade disputes for many, many decades. The standard procedure, even between friends, these trade conflicts, get pretty rough pretty quickly. Other countries will typically look to inflict political pain on the party that's imposing the tariffs. So they'll figure out what electoral districts are very close, what do those districts produce, and then they'll hit items produced in those districts with tariffs. I think maybe other countries will pause for a couple of weeks this time just to see how serious the White House is about the tariffs. We've seen some tariffs go on and then come off. But if they do stay in place for an extended period of time, I would expect, as has been the case historically, that other countries will retaliate pretty aggressively with retaliatory tariffs.
David, do you believe what the Fed put out there in terms of inflation maybe ticking up this year, but actually falling back down the following year and the years after that, even with some of the different trade regimes, given the fact that there's expected to be slower growth?
Yeah, we actually made very similar forecasts. I think the Fed basically went through the same thought process as we did this week, asking themselves, what has changed since they last did these projections in December? Well, I'm sure relative to their expectations, as relative to ours, the big change is that it now looks like larger tariffs are coming. And so like us, they lowered their GDP growth forecast somewhat, and they increased their inflation forecast somewhat. We're now expecting core PCE inflation to peak at about 3% this year. They're now expecting it to peak at 2.8% this year. Like them, we also expect that these will probably be one-time price level effects. One thing that I think we've learned that would not have been obvious to me on Inauguration Day is that the public is extremely alert to tariff news and to price news, and you've seen that reflected in both business and consumer surveys with the large jump in particular in Michigan inflation expectations, but you've seen it a little bit more broadly than that. I would have thought a couple of months ago that if the effect of tariffs is to push inflation up to 3%, well, we were at 2.8 a couple of months ago. That doesn't seem like a huge deal. And I think what we've learned is that's not the full story. In much the same way that gasoline prices have outsized salience for household inflation expectations, so we're finding that people are paying a huge amount of attention to the tariffs. And if there are tariff-driven price increases, people are going to notice. It would still be my base case that this does not become contagious, that it is a one-time price level effect, but I think that's more of an open question than I would have thought 2 months ago.
David, do you think rising anxiety around unemployment, which we've seen in the survey data, do you think that will dampen the potential of second-round effects?
I think that's right. I think one key difference with 2022, the last time we all worried about high inflation expectations becoming contagious, 5 becoming the new 2, is that back then people really were experiencing very high, very broad-based inflation. And back then we had the tightest labor market in history, and households had a lot more money to spend than usual because of the fiscal transfers, less to spend it on than usual because of the pandemic. And so when companies started experimenting with raising prices, they found that they took a smaller hit on volumes than they might have expected. I don't think any of that is going to be true this time around. Today, we have a labor market that is back in a better balance, and I think companies would worry a lot more that if they try to opportunistically raise prices on the thought that other people are doing it, why shouldn't I, that they will take a bigger hit in terms of volumes. That's part of the reason that I don't expect that the inflation effects of the tariffs would meaningfully last beyond this year. The other reason is we think the tariffs would weaken the economy, and a weaker economy should, if anything, generate lower rather than high inflation. I think that's basically how the Fed thought about it back in 2019, if you look at the transcripts from their meetings back then. Yep. And that is basically what the market is pricing too.
Seems to be the base case right now. We've all got to stay open-minded, but that's certainly the consensus view. David, appreciate your time, sir. As always, David Miracle there of Goldman Sachs. How much feedback are you getting about cricket?
Okay, so I'm actually asking ChatGPT, which is better, cricket or baseball. I'm getting quite a bit of feedback.
Wow, what did ChatGPT say?
Well, it's struggling. I will say that the initial take, I tried asking a different way, was that there is no better between cricket and baseball, that it is subjective, etc. Nice punch, ChatGPT. Nice punch.
Vishy, you started this. Vishy Tirupattur of Morgan Stanley's with us. Vishy, someone wrote in and said it's difficult to get people to appreciate a game that can last 5 days and still end in a tie.
True.
That just shows that there's no one form of cricket, John. As you know, there's a 5-day version, there's a 1-day version.
What's your preference? I'm a fan of Test cricket. Still, that's my preference.
And some of the best cricket games have been actually drawn without a result. There have been some of the best cricket games ever played. So that shows both strategy, technique, enormous physical prowess.
Enormous.
I feel like this was directed at
hold on a second.
I like how you turn.
I actually just have to say, I did look up what physical attributes are necessary, and it has to do with speed, agility, eyeball coordination.
Same like baseball.
Mental agility.
Brett Lee, if you watch Brett Lee, back in the day for Australia.
A ball coming at you at 150 kilometers per hour, and you're fielding, you're not wearing gloves. You're fielding barehanded.
This kind of feels like the moment we're in the market.
Oh, nice.
Nice. I appreciate that.
Feels like Brett Lee's pitching, right?
Exactly.
Yeah, as if you know what that means.
Exactly.
But please
I have no clue what you're talking about, but I'll nod and agree anyway. There is a sense that we're kind of standing here trying to catch 150 miles per hour balls or wickets or whatever, snitches. What are they called?
Snitches? Not Hogwarts.
What do you think this is, Quidditch?
Let's start again. Where are we? What do you agree with? How are you dealing with the uncertainty at a time when markets really are dealing with just a lack of understanding of what the parameters are, whether we actually are in an inflationary or disinflationary moment?
I think we are at an unprecedented level of uncertainty. There is enormous policy uncertainty. I think one of your guests earlier was saying something about whether this amount of uncertainty is not the bug of this where we are in the cycle. It is the feature of the cycle, and we just have to learn to live with it. So for example, a lot of consternation about what happens on April 2nd. Indeed, April 2nd is going to be a very important day. We'll know a lot, but we also will not know a lot. It's a start. It's not the end of the resolution. It's not the end of the uncertainty resolution related to tariffs. We will know something, and some things on which we will know that it's going to be no negotiation. And just because something has happened on that day doesn't mean the issue has been put to rest.
We've been talking with analyst after analyst who says the uncertainty and the likelihood of increased tariffs has reduced their growth expectations for this year. We see that pretty much across the board. We talk to analysts who say they do expect an equity downgrading with respect to expectations going forward. Why have we seen such calm in credit markets that don't seem to be pricing in the likelihood of any material slowdown?
So a few things have happened. I think there are. First is if you've seen a lot of damage in the equity markets, much of it has come from the technology stocks, right? The Mag 7. if you look at the composition of the credit markets, credit indices, and compare that to the composition of the technology in credit indices versus equity indices, credit has much less technology. That's one thing. The second, I think, important thing is that there is the emergence of private credit has definitely had a play in. There's an effect of there's a lot of money that's raised or dry powder that still needs to be deployed. There is a bit of that, and probably one thing that a lot of people don't appreciate is that the marginal buyer in credit in the last few years has been the insurance buyer, the life insurance buyer. This is very sticky money. So this sticky money, when you have a drawdown, in equity markets, in the past episodes, there will be a drawdown in credit markets because of redemptions. With sticky money, that is very unlikely.
Just want to ask what a lot of people have been saying, which is this idea that the reason why you can get bullish on stocks is that you haven't seen any disruption in credit that usually is a leading indicator for equity markets. Has the credit world lost its ability, the public credit world, to be a forward-looking indicator of risk for equities?
I'm not an equity strategist, but I would say I don't think it is a matter of signals from credit markets being different. I think we have to understand that the people that have bought credit, especially in the last 2 years, bought it because of level of yields. So there is a certain yield-based buyer bid. If level of yields drop meaningfully, let's say 10-year Treasury drops to below 350, that incremental yield buyer bid would be much softer. So that is what is actually keeping credit spreads relatively more resilient. Doesn't mean that if the weakness in soft data turns to weakness in hard data, it will remain resilient. But I would expect that credit spreads to widen if hard data begins to crack. But we have not seen that yet. But my only point I'm trying to make is even if hard data does, hard data do, I want to be looking at John, hard data do deteriorate, it's probably less likely that credit will widen as much as it would have in the past because of this yield buyer bid.
When we look at the soft data, I just want to go back to policy for a moment. You said that this uncertainty is going to live with us for the next 4 years. Morgan Stanley, for the first time in years, decided to downgrade their growth. When you look at tariffs, do you think it's more of a hit on inflation or to the growth side?
We think it's the effect on inflation. It's probably one time, and maybe in this year it might be a bit sticky, but the effect on growth is actually longer lasting, and I think more consequential is the effect of growth. So, the stickiness has to do with how if the tariffs are going to be evolving. But it's really each tariff is a one-time hit to a price level. It's a price shock. But the effect on growth is probably much more long-lasting and significantly more consequential.
This is the theory, and it all works intuitively in my mind and everyone who's listening to this. In practice, it's going to be harder to look through this. And that's the point that your colleague Mike Gapen at Morgan Stanley is making, that for the Federal Reserve to actually look through this in practice and cut interest rates with above target inflation and maybe inflation that's creeping higher, it's going to be very difficult to actually do. Austin Goolsbee, the Chicago Fed president, is speaking to the American press this morning and making the point that we need to be careful when you say transitory. And going on to say this about interest rates, it's not realistic to know the rate path right now. So as an investor, what degree of support are you expecting from the chairman of the Federal Reserve, the FOMC, if economic data does worsen? Because the thing that I keep hearing is that the Federal Reserve still has an asymmetric reaction function. It's pretty simple. They stay on hold. If things get worse, they cut. It's the second piece of it that I think we've got to keep asking questions about. How much pain would they be willing to tolerate when they have above target inflation?
I think I totally agree with my colleague Michael Gapen. I think the ability of the Fed to look through the inflationary, sticky, higher, firmer inflation, we think is limited. So our expectation is one cut in 2025. And as a bond person, looking at that, what that means to me is that as the weakness in hard data begins to manifest, the market will start to expect that there will be a lot more cuts needed in the year ahead. So market will begin to price in more cuts. So we think in that our expectation, Michael Gapen's expectation, is a lot more cuts to come in 2026, where inflation would be coming down, partly because growth will be much weaker.
So you have to backload them.
You have to backload them, which means duration. This is one of our major rationale for being long duration, is that if we are expecting more cuts to come ahead, and I'm not expecting much of fiscal expansion, much fiscal stimulus, we think that just really means it's a good time to be long duration, and I think will be pretty rewarding. So, for example, our year-end expectation for 10-year Treasury, my colleague Matt Hornbach's, is 4%. 10-year Treasury. And if things, this tariff pressure builds up, we actually think that that number can go below 4%.
Vishy, thoughtful stuff. Thanks for the conversation on cricket as well. A clinic as always. Vishy Tripatura of Morgan Stanley, and a little sprinkle of Quidditch in there as well. Heard you mention Hogwarts.
All right, okay, all right. I actually wanted to comment on Goolsby.
Oh, Bravo from Gryffindor, please.
Oh, you put me in Gryffindor. That's very sweet of you. Okay, so Goolsby talking about kind of the comment that you made, the longer you wait, stop laughing at me, that rate cuts will be backloaded. And that goes exactly to Vishy's point. He actually said that part out loud, which is what they're predicting. If you wait long enough, you're going to end up with greater weakness in the economy, and you're going to have to eventually cut that much more down the road.
As we get those comments, yields are lower by 3 basis points. The equity market near session lows. We're down about 0.7%. With an update on stories elsewhere, with your Bloomberg brief, here's Yahara Hacker. Say, Yahara.
Hi, John. President Trump is moving full steam ahead to his April 2nd tariff deadline. Trump posted moments ago on Truth Social, the day will mark Liberation Day in America, writing that it's time for the nation to get back money and respect. Meanwhile, JP Morgan is changing the E in DEI. According to Reuters, the bank is swapping out equity with opportunity and renaming its programs Diversity, Opportunity, and Inclusion. The company also plans to reduce training on diversity topics, according to the report, and move away from central management of the programs. And the Boston Celtics have been sold in the largest sports takeover in history. Private equity mogul Bill Chisholm led the group, including tech and real estate investors, that is buying the team for $6.1 billion. Chisholm outbid at least 2 other groups, including one led by Celtics minority partner Steve Pagliuca. And that's your Bloomberg Brief. John?
What a run Steve's had with that franchise. Unbelievable. Yahara, thank you. Have a good weekend. Up next on the programme, for those of you who want to know the latest over at London Heathrow, we'll touch base with Guy Johnson in just a moment.
Behind the bright lights and adrenaline of pro sports is an equally exciting world of negotiations and deal making.
That's what we cover each week on our podcast, The Deal.
I love the fact that you have, we say the cojones, can I say that in Bloomberg?
Maybe moxie?
Yeah, moxie. I'm Alex Rodriguez, former baseball player turned business executive.
And I'm Jason Kelly, a journalist at Bloomberg. Over the next couple months, we'll hear from all-stars like Billie Jean King.
Well, what should I learn? What should I do? I said, learn the business.
Jay Williams.
You're an asset, but how do you become the principal?
Paul Rabel.
We're going to be the league of digital, and that's why you're going to invest.
Adina Friedman.
I definitely am competitive.
David Rubenstein.
People don't come up to me on the street and say, let's talk about this private equity deal you did recently. No, nobody does that. They say, let's talk about the team.
And so many more.
You need a clap?
No, I think we're ready.
Ready? Go.
Morning, this is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. These are the stories that set your agenda.
Taking you from the U.S. market's close to the overnight session in Asia, we'll walk you through what you need to know to kickstart Europe's trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in to Daybreak Europe, only on Bloomberg Television. Context changes everything.
Key investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Onen, only on Bloomberg.
U.S. jobs numbers are released. Bloomberg has the report under surveillance with crucial data and expert analysis at terminal speed. Nobody covers Jobs Day like Bloomberg.
Stocks are rolling over here. Session lows were down by 0.75% on the S&P. On the Nasdaq, we're down by 0.9%. The opening bell, of course, is just around the corner. Neil Dutcher of Renmac writes in, Trump on monetary policy is the best version of Trump. He should say what he means more.
Well, I think that he agrees with him and thinks that the Fed should lower rates, so there you go.
The equity market might think the same. We're down by 1 full percentage point on the Russell. I promised you an update from London Heathrow, so let's cross over to Guy Johnson for more. Guy, what's the latest?
The latest is the airport is still closed, John. All 5 terminals are closed. Nobody's coming in, nobody's going out. All flights have been cancelled at this point. The earlier flights that were inbound have been diverted. So it looks like we're probably in for a few days of chaos as a result of this. Thousands of passengers, aircraft crew, all out of position. That's the narrative that I think a lot of people are going to have to deal with. Clearly, there are concerns in the UK about how such a major piece of infrastructure could fail, how a single point of failure at a substation a couple of miles north of here could cause such chaos to such a big and important piece of infrastructure. That's the longer term conversation. But in the near term, John, passengers are stranded. Nobody is going anywhere. The airport is completely closed. Even if we were to see power restored over the next few hours, it is unlikely the airport will reopen until tonight. And then the long and tedious task of repositioning everything to get everything back up and running will begin. But we haven't even got to that point yet. So, yeah, not much of an update at the moment, not much information. It's kind of where we were, and it's where we are.
Guy, looking forward to your coverage throughout today. Guy Johnson on the ground at London Heathrow. From New York City, that does it for us. Equities near session lows. We're down by 0.7%. Equities are lower going into the weekend. On Monday, we'll pick things up with Keith Lerner of Truist, Sharon Miller of Bank of America. We'll speak to Dana Telsey and Troy Gajewski from New York City. Thank you for choosing Bloomberg TV. This was Bloomberg Surveillance.
Welcome back to another special Miami Open update for Bloomberg TV and radio from Tennis Channel. Coco Gauff raced into the third round with a perfect performance against fellow major champion Sofia Kenin. The 2023 US Open winner didn't drop a game in her opening victory, which took just 47 minutes. And don't forget, you can watch all the action live daily on Tennis Channel.
From the beating heart of global finance, economics, and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. What do you think the future is for inflation? Is this a new normal? Are markets too optimistic? How do you worry about the things that are outside your control? How does the current fighting completely stop? I'm Francine Lacqua, and this is The Pulse, every weekday only on Bloomberg.
What legacy I would love to leave is to make sure that in my village I have infrastructure. So long when I'm gone, things are still working. Then I have done my job. And if some people get inspired through my work and then try to engage themselves for their community and create something that is inspiring for everyone, I will be happy.
What's the best piece of advice you would give to someone young who wants to make a difference actually in this world? In architecture or with something else?
Wow, I'm not the right one to just do that.
I think you are.
Yeah, but with the pressure you have, and then you try to be the good one, the fancy guy, the intellectual one, I have no advice than to believe in yourself and really work hard. You know, when I started, no one would have imagined that I will be able to see my name connected with Aga Khan or Pritzker or sitting at Bloomberg to talk about sustainability, about future of sales. No, myself 5 years ago, if you told me that, I will say no. I will never imagine. So I will encourage everyone to believe in what you're doing and not try to run after the newest of the newest. Just be consistent. Just work on things that matters for you. Really, at the long term, it pays.
What makes it India's time?
It's us women who are going to transform India. I truly feel that the time for Indian women has come. They're not only breaking glass ceilings, but they are redefining, you know, whether it is in sport, whether it's in medicine, whether it's in creative arts. They are everywhere. And I have so much positive energy that comes back to me when I'm talking to Indian women. And I just think at all these little girls and boys, I don't want to discriminate, who are now in school-going age, imagine once education, sports, we empower them. What a difference they would make not only to India, but to the planet and the world. And the world needs it now than ever before.
Bringing you up-to-the-minute tech news whenever and wherever it happens. I'm Ed Ludlow in Las Vegas, and this is Bloomberg.
All right, we could end the week in the green, but right now it looks like we're not going to do that. Futures are lower, 30 minutes to the start of cash trading. I'm Matt Miller.
And I'm Shonali Bassett. Katie Greifeld is off today, and Bloomberg Open Interest starts right now.
Coming up, global bellwethers sounding the alarm. FedEx slashing its outlook to reflect continuing weakness and uncertainty in the U.S. economy. Plus, Nike expects further declines in revenue and profitability as the trade war starts eating into margins already hurt by reinvestment. And electric therapy, Elon Musk trying to reassure Tesla employees, telling them not to sell their stock after it plunged just 50% in 3 months. Let's take a look at where markets are trading. As I said, 30 minutes until the start of the cash trade. Right now, S&P futures are indicating a loss of almost 1% here. If we lose more than 24 points today, we will be at a loss again for a 5th week in a row. But if we lose less than that, it will be green, as Shonali Bassett tells me. NASDAQ futures down more than 1% already, so it does not look good from a tech perspective. And we're hovering back around 420, which is appropriate for a Friday, on the 10-year yield, down 10 basis points from the level we saw for the last couple of weeks. In terms of the stocks that we're watching, FedEx expects 2025 revenue to be down versus last year. They're going to have lower revenue in 2025 versus 2024, cutting full-year guidance because of inflation, higher than expected inflation, they said, and also tariffs weighing on their packaging business. The shares are getting literally decimated in the pre-market.
Yeah, I guess in that way, FedEx and the Federal Reserve, they're all on the same page here. Tariff pressures, inflation pressures. We'll talk more about the bellwether stock in a minute here. I want to talk about Nike as well, down almost 9%. pretty brutal. It expects further declines in revenue and profitability during a comeback bid under the new-ish CEO, Elliott Hill, but another set of unpromising signs right now out of earnings season. And with these downbeat results is adding to concerns about the global economic outlook. And here's how Wall Street is addressing the market.
We could see things start to, probably drop out either now in certain circumstances where stocks have really been hit hard, or it may take until the summer or the fall. But it's going to be remember we had a rolling correction. This is going to be a rolling recovery, is my best guess.
We have likely brought expectations down to the point where they're going to be beatable. I think, though, the question is we're going to be hanging again on what we're going to hear about what the world looks like 6 months from now or 9 months from now.
I think what you're looking at today is it's a little bit of what you said. People are nervous, so people are waiting. The real question is, how long do they wait? Do they wait 3 months, 6 months, a year, 2 years? If you're waiting a long time, then you've got a real recession.
All right, so a lot of talk about recession, concerns about the economy, really because we see these bellwether companies coming out and saying revenue is going to be hurt this year versus last year. Tariffs are really putting a dent in our business. And by the way, bellwether, I looked up the word. I thought maybe it had something to do with the weather, but actually that was what they called the sheep leading the pack. In Old English, wether is a castrated male sheep, and bell is just, what it wears around its neck. So that's
FedEx leading the pack here in terms of negative sentiment on consumers, on tariffs, a whole bunch of things. And what's crazy about it is they're really the end of this earnings season, right? In just weeks, we really do start a new earnings season. And the banks, do they serve as a new bellwether to what to expect out of this economy? Real quick here, Matt. 4.2% on the 10-year. We are 10 basis points lower than where we started the week. That's also could be perceived as a bearish signal. This idea that growth is slowing here. So the bid in the bond market is back. So that is the tail wagging the dog to the stock market.
Absolutely. I just hope it brings rates down a little bit so I can take out a loan and buy a car. Back to the big mover of the morning. We're focused on FedEx, joined by TD Cowen analyst Jason Seidel. He has a buy rating with a price target of $310. Jason, do you still feel comfortable with that rating? Because, the company is saying it's tough because of tariffs, also inflation. We may not even make as much money on the top line this year as we did last year.
Yeah, I think the key here is in the near term, uncertainty is king, right? At best, it's going to put pressure on FedEx and the rest of the transports, and at worst, it's going to sort of create a lid on everything. But if you look over the long term and you look at what FedEx is doing, whether you're taking a look at their cost savings program, the DRIVE program, $600 million this most recent quarter, on our way to about $2 billion in savings, or their Network 2.0, which to me makes a lot of sense, combining both ground and express into a more shared network, kind of like what UPS already has. That's going to save another $2 billion, but it's probably more of a fiscal year 2027 event. That, I think, is going to be helpful for investors. And ultimately, spinning out their freight division, to me, that's going to create some value because there's a huge gap in what investors pay for an LTL business and what investors are paying for a parcel business these days.
Jason, one thing that the company cited as weaker was industrial customers here. And I'm wondering, to the extent that you could take what's happening at FedEx and kind of extrapolate here to the broader U.S. economy, the weaknesses in these results, what does it say about the weaknesses that are under the surface? What exactly is it that FedEx is encompassing?
So, and I think you've seen it. FedEx called out a weak B2B market. They call that a weak industrial market. We've seen some of the weakness on the industrial side in some of the rail car loadings, if you track them, especially if you just take away international intermodal, which has probably been impacted a little bit by a pull forward in terms of the strength that we've seen over the last couple of weeks. So, yeah, I think it does tell us that the overall market is sluggish right now.
How much does the end of the USPS business have to do with this?
It's got a little bit to do with it, but the USPS is going to be interesting in that there's been a lot of talk at this administration about trying to stem some of the losses out of the post office. They lost, I think, about $9 billion. I think that's going to be unacceptable to the current administration. But, how they try to dig out of that hole, I think, is going to be key. If they're going to just, take away some cost reductions and look at it that way, I think it has very little impact. If they really go to the heart of the matter in that they're pricing well below market rates for some of their services, then I think that's a potential catalyst down the road for FedEx and UPS. It's just extremely hard to predict.
What do you think the catalyst is to turn the negative sentiment around? I know earlier you said uncertainty is king, but is there anything that you could see that could clear up the picture?
It's going to have to come from the macro side, at least here in the near term. I mean, there's some minor catalysts that you could check the box on for somebody like FedEx. Like, for example, if they name a new CEO that people like for their freight division, probably going to be taken from one of the competitors out there in the marketplace. But that's something minor right now. Right now, macro is the king, and we need more certainty from that. And I don't see it coming, at least anytime soon.
What if tariffs were averted? April 2nd, we get the reciprocal announcement, but I guess it's possible that Trump could be negotiating with our major partners, and we could see fewer tariffs around the world. Would that be great news for FedEx?
I think if you clear up that uncertainty on the tariff side, for sure, I think that'll benefit a lot of it. I was at a railroad conference the other day, and there was a car manufacturer talking about how at the beginning of the month, a new car cost him $120,000, and then by the end of the month, the price of the new car was $158,000 with tariffs. But that fluctuated in between that period up to as much as $165,000. So it's all that uncertainty that I think that is providing a cap on the marketplace, particularly on the industrial side.
I'm going to say that was a Porsche Carrera T without actually knowing. Jason, thanks very much for joining us. TD Cowen's Jason Seidel talking to us about FedEx and new car prices on the rise. A check on futures this morning. They are down and looking at the lowest points that we've seen right ahead of the open. Just got about 21 minutes to go. S&P futures off 0.9%. NASDAQ futures off more than 1%. We're also watching Micron, which gave a strong sales forecast. Data center revenue tripled from last year as well, but the shares are moving down this morning. The maker of memory chips losing about 4% of its value.
This is Wall Street raising the bar. They need to see more from all these companies. And also I want to point out Lennar here because the shares are falling quite meaningfully, more than 6.3%. The reason being home orders, their forecast disappointed. Pretty interesting when you saw actually existing home sales rising. So what about the new homes? You were seeing it in the builders. It's a little painful out there, Matt.
Yeah, absolutely. I mean, they want to be conservative. So maybe next quarter we have a beat and raise earnings season. It certainly isn't what we saw in the numbers last night. Coming up, Nike, another one that disappoints. The company's turnaround is being threatened by an inventory reset and obviously these tariffs. This is Bloomberg. Jumpstart your trading day on Bloomberg Open Interest.
2 hours of single stock stories that are driving the opening bell action.
We'll take you to Wall Street, Main Street, the C-suite, and beyond.
These are companies that are growing their market.
The great companies in the U.S. are the companies hitting the cutting edge. That's a different story.
Get the inside track on what's buzzing in markets.
With the players who are shaping the narrative.
If you have bad earnings reports, you're going to get punished.
They're not buying what the industry is selling. Join us on Bloomberg Open Interest every trading day, only on Bloomberg.
What is the issue between the type of information that's being collected by investors and the marking issue that you're describing?
What mark-to-market
assets do is it forces honesty into the situation. We're talking right after the DeepSeek model surprised everybody in its efficiency. It took hundreds of billions off of market caps because it legitimately raised concerns that maybe the future of AI was different. I guarantee you that if you look at other portfolios that aren't marked, they didn't move. If private assets are going to eat the world, as they say, with the equity market halving in the number of names, you come to a world that is increasingly an echo chamber. Imagine you have a firm that has some public assets and some private assets. If you see your public assets in AI going down by 20%, you're going to be thinking very, very deeply about what your private assets are worth differently than someone who just has the latter.
Get your fixed income fix. Watch Bloomberg Real Yield around the world right here on Bloomberg. Context changes everything.
Key investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Onim, only on Bloomberg.
Let's get to high interest to look at what's making headlines around the world. London's Heathrow Airport, the busiest in Europe, suffered its biggest disruption in decades after a nearby fire cut off all power to the hub and brought travel to a standstill for hundreds of thousands of passengers. The incident is being investigated by counterterrorism police. Heathrow is the fourth most active airport in the world and will be closed all day today, possibly into the weekend. We're going to go to a reporter on the ground later on in the program. NVIDIA shares are down more than 2.5% this week, and they're falling further in the pre-market, bringing the total decline from a January peak to more than 20% after the company's week-long GTC conference failed to inject the kind of optimism needed to get the artificial intelligence trade back on track. Now the stock has formed a so-called death cross, with the 50-day moving average falling below the 200-day moving average. The last time that happened in April of 2022, the shares tumbled more than 30% over the next 2 months. And stocks are down around the globe to end the week as a batch of downbeat corporate earnings fanned fresh concerns in a market that's already grappling with the prospect of a damaging trade war. FedEx shares have been decimated in the pre-market after cutting earnings forecasts and saying that 2025 revenue may fall below last year's. And Nike's stock, which has lost 45% of its value in the past 3 years, slid another 8% after saying tariffs and an inventory glut will hurt profitability.
Let's stay on that Nike story because Bloomberg senior reporter on athletes and celebrities, Kim Bassine, joins us now. You know, you really had every moment of this Nike story pinned. And now in the early days of the Elliott Hill tenure, what do you make of this? I mean, Matt knows I love the 90s, so the fact that you can't get rid of the Air Force Ones is a little surprising to me. It looks like it's a little surprising to the investors,
those shoes rule.
I thought so, too.
Yeah. Air Force Ones. So there are 3 real franchises within Nike's portfolio that took off in the last 5 years, to the point where there were too many of them, right? So that's the Air Force One, that's the Dunk, and that's the Air Jordan 1. So those 3 are called, they're considered lifestyle shoes, right? You can't actually perform in them on the court or the field or wherever you want to. You can't run in those Air Force One. I mean, they used to be once upon a time, but now they're considered lifestyle shoes. Nike got away from the performance shoes that really drove its business for so long. That's, running shoes. They lost a lot of the running market to a bunch of upstart brands, and now here we are.
What I wonder, and have been wondering, what morale is like at this company. I mean, the new CEO seems to be firing everybody, at least like top managers are all out, right? And he says that the company has its identity back, but do you think workers feel that way too?
Well, so the previous CEO, when he was out, that day we had a story about people were popping champagne at their Prosecco at their desks and cheering out loud just in the office at Nike headquarters in Oregon when they replaced the CEO. This new guy, he was an intern there, Elliott Hill. He spent decades rising through the ranks. People really do love him within the company. There haven't been layoffs layoffs of line staff. It's all been just the top executive, C-suite management team level. So good. They seem to still be behind him, yes. Nice. It's only been like 6 months, right?
To the point on identity also, I mean, what about consumers? He's trying to fix retail partnerships. He's trying to fix celebrity engagements. Is he succeeding at creating the new Nike as he's doing all this?
Yeah, so he's trying to realign Nike around sports, and that's a weird thing to say when you would think
sports and influencer underwear, apparently.
Yes,
right?
and the deal with Skims, that deal was signed a few years ago under the previous CEO, so he's inherited that, and that's really going to be focused on they're going to try to focus it on fitness and that kind of not fully lifestyle, but
fitness
still some
girdles.
fitness stuff. Yes. So moving forward, we're talking that Super Bowl ad that they had. That was the first in decades that Nike's ran a Super Bowl ad. I also ran into Elliott Hill, the new CEO, around the Super Bowl in New Orleans. He was there in person to meet athletes. He went to the NBA All-Star Weekend to meet athletes as well and promote the new shoes that are coming out. So he's trying to get Nike back into that sports sphere.
So very cool. So basically they have a CEO that the employees are finally happy to see in charge. They're going to focus on sports again, and they're back to Super Bowl advertising. And from what I understand, the way that they sell these shoes is going to revert back to, getting on store shelves. There's going to be all Nike shoes lined up at Foot Locker rather than, you have to wait to find them on StockX and pay $300 for some green fuzzy Grateful Dead dunks.
Right. They cut a ton of retail partners. At one point, it was about half. So they're trying to get back into those stores. When you give up all that shelf space, it gets replaced by other brands. So you walk into a Fleet Feet, that's a running store, and there's no Nikes there. Every single one of Nike's competitors is on the wall. So they're rebuilding these relationships with retailers. The best example is Foot Locker. It's Nike's biggest partner. They pulled back a lot of inventory from Foot Locker in recent years, but now they're partnering with Foot Locker on this whole basketball section that's going to be in a ton of stores, and rebuilding those relationships is going to be really key to this turnaround.
Kim, we thank you so much for joining us. That is Bloomberg's Kim Bassine. Thank you for all of your reporting and keeping an eye on this story. It is still in its early stages. Also, looking at Carnival, just out with the latest results. Shares are briefly positive after being negative all morning. Looks like they're back in the red, though. The company raised the full-year guidance for 2025, and first quarter revenue at $5.8 billion did beat estimates. But of course, we've been saying this, Matt, the bar is quite high for these companies, and there has been a little more negative sentiment around stocks like this with consumer matters.
And there have been a lot of different threads here, right? For example, Howard Lutnick, the Commerce Secretary on Fox TV, was saying, how come all of these ships have Caribbean flags on them? Why aren't they flying the U.S. flag, since they're U.S. businesses for the most part and rely on the U.S. for a lot of their revenue? Maybe they'll be taxed. That was a concern in the last quarter. But also, in general, right, when the prices of everything is going up, when consumers are faced with inflation and uncertainty, does that mean they don't book a trip on Carnival, or is that a reason to book a trip on a Carnival cruise, right? Now I can't go to Aspen and rent a chalet. I instead am going to do an all expenses paid trip with my family around the islands, and maybe that's the case.
And flights are expensive. We have the person to answer that. In fact, we have Carnival CEO Josh Weinstein today at 2:30 p.m. Eastern. You're going to want to check in on that one. And Matt, I know we're checking on futures ahead of the opening bell as well.
Yeah, I'm looking at futures right now. They continue to trade much lower, about 0.9% down, almost 1% down on S&P futures, more than 1% down on the NASDAQ. So it looks like this week is going to be a loss again if we continue to trade this way, right? Anything can happen. We do see a lot of turns throughout the day, but if we don't lose more than 24 points, it could be a good week. Coming up, less than 10 minutes until the opening bell, Paul Christopher of the Wells Fargo Investment Institute joins us to talk about how he makes sense of these global trade war headwinds and what he thinks of the buy the dip mentality. This is Bloomberg.
David Weston. Join me for the next generation of Wall Street Week, telling stories of capitalism from business, markets, economics, tech, and climate. Each week, we'll go on the road for a look at what lies behind the headlines of today and what will likely be the headlines tomorrow.
Above all else, it's a mission.
It's done nothing but grow immensely. To me, that's an extraordinary sign.
We can be the change that we want to see.
Watch the all-new Wall Street Week. More than what you need to know, it's what you need to think about.
Bringing you up-to-the-minute geopolitical news whenever and wherever it happens. I'm Stephen Engel at the Forbidden City in Beijing, and this is Bloomberg.
Bloomberg Surveillance covers the latest in global markets and the political events that influence your world. Join Jonathan Farrell, Lisa Abramowitz, and Anne-Marie Hordern, only on Bloomberg. Context changes everything.
Asia is at the forefront of some of the world's biggest stories. I'm Chevrillon in Tokyo.
And I'm Heidi Stroud-Watts here in Sydney, where the trading day begins. We're here in the center of all the action to get you set up with the numbers, news, and knowledge you need for the day ahead.
The demand is indeed recovering. We've been waiting for this moment.
The opportunity of a century.
Join us on Bloomberg The Asia Trade. Weekdays only on Bloomberg TV. Context changes everything.
From the world of politics to the world of business, Joe Matthew and Kaylee Lines deliver news, insight, and analysis live 2 times a day, every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg.
Quick check on futures. Right now we're looking at a 1% drop on the S&P. NASDAQ futures down about 1.2%. I was talking about the 24 points that we need to lose to go red for the week. If you take a look at the 4-day chart, we'll pull up a 4-day chart of the S&P 500. This is something that Shanali pointed out to me in our morning meeting. You can see that we're only down by 24 points, basically. So this is, if we end this way, we'll be the 5th week in a row of losses, right?
Right.
But if we turn around, and obviously we've seen so many trading days where in the morning we're off 1%, and at the end of the day we're up 1%. If we just gained those 24 points back, we could be in the green.
You know what's crazy to me is a lot of those gains came on the heels of that Fed decision, some relative calm. But as the markets digested, you clearly saw a turn in attitude. And where you see even more negative sentiment is actually in that Magnificent Seven. It's not only down for the 5th straight week, regardless pretty much of where it has to close meaningfully higher. It's also has almost every single member of it in the red. Meta is pretty much flat. So if that turns into the red, you will have every single component of the Magnificent Seven in the red for the year.
Right. So this week we basically saw a Fed that a lot of people thought was dovish, and stocks traded up on the day after Jay Powell's press conference. But for the rest of the week, sentiment has been down. Tech stocks have been real losers. The interesting thing is a story our producer, Will Shaker, sends around a fantastic list of intel in the morning. And Shaker sent this story today about the retail buyers that just continue to pile in, right? So according to JP Morgan, individual traders pumped more than $12 billion into U.S. equities in the week ending March 19th. And this is, I think, demonstrative of a trend that we've seen over the past few years. When institutions sell, retail is still there to buy the dip.
And not to be too technical about this, if you're a big pension fund or even sovereign wealth fund, right now you had an equity portfolio that is in the red, right? And their private equity holdings are pretty much illiquid because they're not selling. So you have a double-edged sword issue and not a lot of money to put to work. Whereas the retail trader, they have some cash on the sidelines.
All right, we have less than 4 minutes to go until the opening bell. When we come back, Paul Christopher of the Wells Fargo Investment Institute joins the show. Just one more thank you to Will Shaker, and thanks to Will's dad for watching. This is Open Interest.
In this facility, which is part of your $2 billion investment in the last 2 years, it's a massive amount.
Yes, because, we focused a lot on automation and upgrading our quality standards so that we can adhere to the US FDA and European standards, because some of our vaccines now are going even to the West, which is a fundamental shift in our strategy, from back in the day when my father started the business, where we were predominantly in India and the developing
India-centric, now you're more global.
Yes.
So you're about 8,000 strong in this facility? All Indian nationals?
Mostly Indian, yes. I would say 99% of talent that we've trained overseas and in India. We have our own internal skill building center where we train on site.
Serum started with just producing vaccine for tetanus, but it's producing a lot more vaccines now. What is the next big thing you think?
A global pandemic flu vaccine is something that we're working on, and I think the world will need that. Not only for the annual flu cases, but God forbid there's a flu pandemic. I think we are very well poised to make 1.5, 2 billion doses and roll it out very quickly to protect the world. And we have, of course, the other vaccines, as we talked about, HPV and malaria, that we've just launched, and we're going to scale that up as well.
Middle East and Africa. Vibrant resources and high-yield investment opportunities abound. Join me on Horizons Middle East and Africa for the stories, newsmakers, and insight from this exciting region. Now weekdays, only on Bloomberg.
It's a multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. ETF IQ, only on Bloomberg.
Moments away from the start of trading, and futures are at session lows on the S&P and the NASDAQ. I've been ignoring the Russell since Katie's out, but I'll mention it right now. Look at the S&P futures. They are down, well, not the 1% that we saw a few moments ago, but still 0.9%. Futures on the NASDAQ down more as the tech stocks really take the brunt of the losses here. And then the small caps down just about the same as the NASDAQ. In terms of the opening bell, you've got Smart Chem ringing the bell down at the NASDAQ market site. And American Water, what an important resource that is for us here in this great country, ringing the bell at the New York Stock Exchange. We're really focused on the problems that we're seeing out of earnings. You've got these big bellwethers coming out and printing bad numbers, and really it's all about tariffs, which is what spooks market participants. You can see the cash trade here. This is no longer futures. We're still down 0.8% on the S&P, 1% and more on the NASDAQ 100. But it's a company like FedEx, an old economy company, really. This is a Dow Jones Industrial Average company that cut its guidance for the full year again. It's the third quarter in a row that FedEx has cut its guidance. That's no bueno. And as a result, the shares are decimated here. The concern is inflation and tariffs. And this should be, well, Mr. Market talking to the White House, really.
It is brutal. There's no other way to cut it. And, also brutal over here. I'm taking a look at Nike. Matt, it is down 7.3%. Remember, the turnaround effort now hitting snags. The company's trying to clear out old inventory while feeling the effects of a growing trade war. So tariffs, they matter here as well, but also a highly watched turnaround story for another iconic brand in the United States.
Yeah, paying very close attention to that as well. Let's talk about all this with Wells Fargo Investment Institute's head of global investment strategy, Paul Christopher. Paul, I wonder, what you think about these tariff issues. The president and Scott Bessent would say, okay, we're going to have a little bit of short-term pain. We're going to go through a detox, but we're going to come out of it on the other side much stronger. We're really going into a golden era for American business. Do you agree?
Well, we'll have to see how the longer term plays out. But our forecast horizon through the end of this year envisions some adjustments by companies. And we need to remember, too, that those reporting earnings may or may not be among companies that could make maybe the most profitable kinds of adjustments to tariffs. For example, you've got companies that do business in China. Chinese companies' factories are weak right now, so you twist their arms and foist more of the tariff burden onto them. Or maybe you've got U.S. companies that have more than one supply chain. Those have been building up since 2018, and they got really going into after 2020 with the diversification of the supply chain. So some industries and some companies are just a lot more flexible than others. So in the short run, we think tariff impacts on the economy will be blunted and diluted by these kinds of adjustments. Look, you put a tax on somebody, they're going to find a way to adjust around it. And the question is, how long does that take? We think the blunting and the diluting of the tariff impacts will incrementalize the tariff impacts so that by the end of this year, we think the economy is still growing. We don't think that tariffs derail the economy, not from a growth standpoint or from an inflation standpoint. So we'd be looking to buy here.
Chanel, I just want to break in for a moment and say that Paul makes a great point about companies. These are very smart people running the biggest companies, right? And they're going to figure out a way to deal with these tariffs. But for smaller companies, for the small businesses of America, it's really different to tailor your supply chain. It's really difficult to figure out a way to deal with these tariffs. And we have a great guest on, Mike Matthews, later in the program to talk to us about those small businesses.
Yeah, I am very concerned about the small business story, especially because that was a big moment of excitement. After the election, people looked at small caps. I actually want to look at the bigger companies still, though, with you, Paul, because if we can take a note from the micro to tell us something about the macro. You heard from FedEx this morning, not only is it a bellwether, what it told you was that there's B2B issues, there's industrial companies facing issues based on what FedEx had said. So did it tell you something, or does it tell you something about where we're seeing weakening in the economy at the moment that should be a bellwether into what other problems what you might see ahead?
Well, again, what we're seeing is extrapolation. So the tariffs are pretty new. They're pretty, in some cases, still fluid, on again, off again, right? Like in the case of Canada and Mexico. And what we're seeing investors doing is extrapolating into the future and saying, well, these are going to be bad, so therefore we're going to sell the stock today. On the other hand, the other piece of it that we're seeing, or we saw in January, was a very cold month. And a month in which we saw some people already pull their expenditures forward into December from January. And so there's extrapolation going on there too, based on that first month of the year, that, oh, well, the rest of the economy is already weak and tariffs are going to throw it into recession. And again, correlation is not causation. So let's see what happens here. But we're seeing some price increases, but not by the amounts of the tariffs. We're seeing some tariffs that are coming on and some tariffs that are going off. So we still have a fluid situation there. And it's probably best not to extrapolate too much. We think that adjustment period will really tell here. And just as we saw in 2018 and 19, and again in 21 and 22, or excuse me, 20 and 21 with tariffs, we think there will be adjustments made. And that's why we think the economy has still plenty of strengths to drive it forward.
And the market, I mean, typically bounces back from these things, right? I mean, I try to be skeptical, Paul, but I look back at the correction that we've had, and I see pretty much the same thing happened in the summer of last year. We were talking earlier about a JP Morgan data set that shows retail investors are still piling in here. Are they going to get burned, or does buying the dip at 5,700 make sense when, you know, the average strategist estimate for the market at year end is still almost 6,500?
Yeah, buying the dips in the middle of a correction, that's always a tricky sort of business. They call it trying to catch a falling knife. But we do see the market trying to stabilize here, the S&P, around 5,550 to 5,600. We've seen some pretty good up days lately. What we really need to see is some up days with really broad-based momentum across the sectors and good volume. And we're already starting to see some of the institutional money come back into the market. So is this the bottom? No, maybe not. We do have triple witching today, so you've got some downside risk there too. But we think fundamentally the economy is still sound. So we would be looking to maybe put a little bit of money to work here and a little bit of money to work back at 5,700, 5,800. You see all the way back up. No sense in risking all the chips if we're still heading down as part of this correction.
We should point out what triple witching is, right? And it's the expiration of contracts on a whole bunch of different futures. I can never remember, but it's like single stock futures, index futures. What is it, Paul? how does triple witching go as opposed to quadruple witching day?
So you've got futures, you've got indexes, and you've got individual stocks, and all of those come due today. And with all of the volatility in the last couple of months, there's been a huge pile of options that have piled up, and today is the expiry day. So if markets are already jittery, you could expect some more jitters before today is out. But we do take some comfort in seeing some early attempts, what we think is it's stabilization in the market.
And to the point you're making, a lot of people have been looking to the options market to reflect their point of view. Now, one other question I have is going back to the small business part of the story, because you do see a Russell 2000 index that's down more than 8% this year. That is worse than the S&P 500. It's worse than the NASDAQ 100. But you do see an S&P 400 mid-cap index actually doing better than the NASDAQ 100 and the Russell 2000. I'm wondering, to the extent that you want to stray away from those really large cap stocks, if there's a place to do it, or if you still have some fears that maybe rates are not going to go down as much as you thought, or growth might impact these companies, or taxes might not be as low as they'd like.
Yeah, you put your finger on the right there with the rates. We went to neutral from underweight on small caps last fall. And by the way, everyone remember the SOM rule? After that labor market report late last summer, everyone was convinced we were going into recession. But not so. It's just a normalization of the economy. But having said that, yes, small businesses still are on the hook here for interest rates that have not come down by as much as they would like. So that's why last week we made a move in our guidance to go overweight mid-caps. If you think about it, mid-caps are like large caps, but they're going to hold up better. They're holding up better here in this pullback. And we think, if you're going to have tariff issues where U.S. large companies can't necessarily tap their Canadian and Mexican suppliers anymore, some of those mid-caps, especially metal benders, might really step up into that breach there and could do well. So we think mid-caps here, an interesting shadow to large caps, and we would look for them to outperform as well over the coming months.
Paul, we thank you so much for your time. That is Wells Fargo Investment Institute's Paul Christopher. And really quickly here on the whole options expiry thing, Matt, it's interesting. If you're reading the M Live blog, what it'll tell you is, yes, today's could be volatile, could be a little scary, especially with the earnings that you're seeing over here. You do have the potential for a further rally in the S&P 500 into month end based on how these options are set up.
No, absolutely. Well, first of all, when we get there next week, you'll see some window dressing at the end of the month.
Exactly.
But yes, also these triple witching or quadruple witching does cause a lot of volatility right around 1 o'clock. I always forget why there's a subtle difference, and that's because if you had single stock futures expiring, it would be quadruple witching as opposed to triple witching, but we don't trade single stock futures on U.S. indexes anymore, so that's like a thing of the past. You're dating yourself if you talk about quadruple witching.
Yeah, well, there's a whole other thing now that we should one day talk about. That is that zero-day expiry situation going on. Anyway, some movers on our radar here. We're looking at Carnival Cruise extending losses, and that's despite raising its guidance for the year. It's now down almost 5%, at least more than 4.7%. But Lockheed Martin is higher. Bloomberg reported that the White House will make it the winner of its contest to build the next generation fighter jet. And Matt, we're also watching Lennar because it's struggling. The home builder does see pressure from consistently high interest rates. We're watching that housing market very closely. It ties into all those other things we're talking about with the U.S. consumer.
All right, I am looking forward to the announcement of who wins the next generation fighter jet contract, and I guess we're going to hear that officially out of the White House, at least in the next couple of days. So we look forward to that, and that'll definitely move either Lockheed Martin or Boeing. Coming up, we're going to talk about Tesla. It is on pace for a 9th straight week of losses as trouble and turmoil continues to escalate for the company. More on the EV maker next. This is Bloomberg.
number of people, I think, from Homeland Security and or the CIA or NSA have gone to Capitol Hill and said that TikTok is a danger to our national security. But the public hasn't been given that much detailed information about what the threat is. How much of a threat to our national security is TikTok?
The People's Republic of China acts adversely to the interests of the United States in different ways. One of those ways is through the dissemination of disinformation, the intentional communication of false statements, and TikTok is an extraordinary avenue through which to disseminate disinformation to millions and millions of people.
The countdown is on. Everything you need to get the edge at the end of the market day.
Big tech earnings kick off later this afternoon.
Gilead is coming out right now.
We have Take-Two numbers. Back to the markets, right? Our bread and butter.
NVIDIA is one of the best stories in the tech space.
That actually matters a whole lot more.
It might shock some of your viewers.
You're watching The Close.
Get ahead of tomorrow's trading with The Close. Weekdays on Bloomberg. Context changes everything. Bloomberg brings you breaking news 24 hours a day. Powered by more than 3,000 journalists and analysts in more than 100 bureaus across the globe. Bloomberg Television. Context changes everything.
Listen carefully. Can you hear the rhythm in the markets? Not just in the syncopations triggered by inflation, but in the preludes leading to global elections, in the dissonance that moves the Nikkei, and the rising course conducted by AI. There's music in the markets, and if you want to learn to listen for it, we'll show you how.
And it's time now for our top calls. Some of the analyst action in focus this morning. First up, we're looking at Adobe, upgraded to sector weight at KeyBank. The analyst is saying that he doesn't see much room for downside for the company, for the software company in the future, but we do see Adobe still down 1.6%. Now, next up, Supermicro is getting an upgrade from JP Morgan to neutral from underweight. The analyst is saying uncertainty about the pending SEC filings may now be behind it. Supermicro now up almost 2%. Finally, JP Morgan is cutting its price target on Micron after the chip maker delivered a disappointing margin outlook. The analyst is saying that the setup for the second half of the year still remains strong. Matt, you are seeing Micron down brutally about 7.6% this morning.
Yeah, there's a lot of brutal going on today. A lot of those big 8, 9, 10% drops. One of the stocks that's not putting up a move like that today is Tesla, although brutal is a great word for what's going on with this company and the stock. It is set for its 9th straight week of losses as backlash against the car maker and its CEO, Elon Musk, escalates. Protesters are vandalizing cars and even throwing Molotov cocktails at Tesla showrooms. And protesters isn't the word that the Attorney General would use. Pam Bondi has said domestic terrorists. For more, we're joined by Vijay Rakesh, Mitsuo Securities Senior Analyst. He has an outperform rating on the stock, a $430 price target. And I mean, without talking about the drama surrounding the terrorism, what do you say, Vijay, about the company's losses? I mean, half of its market cap has been lost in like 3 months.
Yeah, thanks for having me on, Matt. I think definitely it's been brutal in Tesla, to say the least. But I think as you look at the fundamentals of the stock, I think we continue to see calendar 25 shipments flat year on year, which could be a challenge Q1, where sales on shipments have been for the first 2 months of the year thus far. It's underperformed in China and Europe, especially, and also in the U.S. So there's definitely some challenges here. Some of it might be a little bit of a I think some politicization of the trends there. But that said, we think they should still have a pretty good second half. There's obviously some headwinds with EU kind of rolling up all the CO2 emissions that they had, CO2 emission guidelines. So that takes out some of the urgency to be shipping out EVs in Europe as well. But yes, Tesla sales have been pretty soft, to say the least, in China and Europe especially. So
I want to point out,
Vijay,
Vijay, I want to point out what Elon Musk was saying in the all hands to his own staff at Tesla. He said, if you read the news, it feels like Armageddon. According to a broadcast late Thursday, he referred to what's going on as a little bit of stormy weather. What he said was, the point he's making is hang on to your stock. But if you're a Tesla employee, the stock is down 50% from its highs. You're looking at the other Elon Musk enterprises like SpaceX, where the valuation has been soaring, or even X, where the valuation is pretty much where it was when he bought it. It has risen back again. Then wouldn't you be a little frustrated that you're holding Tesla stock and not something else he's made?
Yeah, definitely, Sonali. I think when you look at the volatility in Tesla, it's definitely not for the faint of heart. But I think the point also is, as you look into the back half, you have a Model Y starting to pick up. There is a lower cost Model Y version that should come on in China and the US. And so that should help drive some of the sales in the back half. But, definitely there have been significant challenges, and it's definitely a little bit of a headwind to morale, and that does not help. But again, even when you look at some of the things that they've said on the robotics side, you're now seeing NVIDIA talk about robotics as a 50 trillion industry that, obviously Tesla started talking, and now you have one of the big bellwethers in the tech market, NVIDIA, also talking robotics. So there are some, tailwinds starting to emerge. Obviously, the core EV business has not been good, as I mentioned, in US, Europe, and China. And so we think going to the back half, a portfolio refresh will probably help. So,
well, you have the President of the United States doing an infomercial, which is helpful for your product. And the Commerce Secretary giving investment advice, telling investors to buy the stock. So those two things, that's tough to get, that kind of publicity. Let me ask you about a different company. I want to talk about Micron for a moment. The company came out with better than expected earnings and also gave a decent outlook, and yet the shares are down. Why do you think Micron is doing poorly? Is this just a part of the broader kind of AI malaise?
Yeah, definitely. Some of the sentiment on the AI side has cooled. Some of the investor sentiment has definitely cooled off, as you can see from the valuations and multiples on the leaders in the space, from NVIDIA and down. And so I think some of it is that. But I think if you look at Micron, they have executed very well. On the HBM side for AI, their revenues are growing 100% in the back half and 100% year on year into 2026. So we think they are doing very well on both HBM DRAM that goes into AI servers, but also the NAND side, where they're starting to ship into AI servers with SSDs. There's been a little bit of focus on the margin side, margins being down a little bit here into the next quarter, but a lot of that is driven by some more consumer mix, some underutilization on their fabs, some startup costs. But I think that people might be missing the big picture, which is that their execution on AI servers, on HBM, on NAND has been very solid. So we would actually look to be using this weakness to get, add to position. We obviously are evaluating. We like the name here. We think the roadmap looks pretty solid for them.
Yeah, the margin miss is pretty small, right? They forecast 37.9% for the second quarter, and analysts are looking for 38.4%. So it's only 50 basis points, but I guess you have to beat in this market.
Yeah, absolutely. Certainly getting swept up in the sentiment. Vijay, we thank you. That is Vijay Rakesh of Mizuho. And real quickly, too, I just want to point out here that not only is Micron the worst performer on the NASDAQ 100, just NVIDIA's down another day. It's been a tough week on sentiment. It's down more than 4% this week. It's had worse weeks, but of course, dip buyers certainly waiting for that rebound.
Over the past 5 years, Micron stock has returned 172% That's better than a stick in the eye, but NVIDIA has returned 2,177%.
Yeah, and we'll talk about it later too. There's an IPO in waiting here. CoreWeave is actually backed by NVIDIA. So we'll talk more about that a little later in the show. But coming up, equity funds get their largest weekly inflow of the year. We're going to take a look at that in today's strategy session next. This is Open Interest.
Bringing you the latest in tech and AI news whenever and wherever it happens. I'm Tom McKenzie in Paris, and this is Bloomberg.
Good morning, good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade.
This is Bloomberg Technology.
This is the Asia trade.
This is Wall Street Week. Welcome to Balance of Power.
This is Bloomberg Television.
From the beating heart of global finance, economics, and policy, conversations that allow for deep discussions and important insights. What do you think the future is for inflation? Is this new normal? Are markets too optimistic? How do you worry about the things that are outside your control? How does the current fighting completely stop? I'm Francine Lacqua, and this is The Pulse, every weekday only on Bloomberg.
Bloomberg loves earnings.
I know it's like your Super Bowl, right?
I can't wait. It's like opening presents in the morning.
All right, it will be exciting.
Nobody covers earnings like Bloomberg.
Welcome back to Open Interest. Let me give you a snapshot of what's moving today in these markets. Almost a half hour into the session right now. We're looking at a lot of red here. The S&P 500 down 0.8%. The NASDAQ as well. We have the VIX up, so that's not an up arrow story, but there's an up arrow at almost 21. The Dow Jones Industrial Average, I'm glad we include this for the old guys out there. Micron, we were just talking about the memory chip maker down big. NVIDIA down 2%, which isn't a lot, but NVIDIA itself is so big. And then here's some of the reason. FedEx and Nike out with earnings that really disappointed. Carnival also off after coming out with earnings an hour ago, and Lennar down in earnings as well. The 2-year yield right now holding firmly below 4%, and the 10-year yield at 4.21, so actually down about 2.5 basis points. Shanali, what are you watching?
I am watching this note from Bank of America because they're seeing that global equity funds have had their largest weekly inflows this year, and that's the subject of today's strategy session. Now, if you take a look, equity funds globally have brought in $43.4 billion, with a meager $4.9 billion relatively into bonds. Gold only $3 billion. Crypto had a tiny little baby bid, but you know, really the idea of global is the most important part here. This idea that Germany, China, the two top exporters to the U.S., they believe, according to this Bank of America note, that the reason they've rallied is that investors are skeptical that U.S. tariffs will cause a recession.
Yeah, absolutely. It's important to point out that that is global. Yeah. But here in the U.S., retail investors have poured $12 billion into equities as well. So they're buying as an institution sell. Coming up in the next hour, Ann Berry joins us and Mike Matthews.
offers before to take over Greyhound, but then in the midst of the pandemic 2.5 years ago, we had this fantastic opportunity to buy the brand and the network. When we took on Greyhound onto the Flix tech platform for network management, revenue management, we saw the highest unit economics in more than 100 years of Greyhound history.
My vision is to transform long-distance bus travel in the United States and make it one of the top considerations for anyone planning a long-haul journey.
CEO Kai Boyson imagines even more potential if state and local governments recognize the need to support long-distance bus travel with integrated infrastructure.
We need to think about the infrastructure in the United States holistically and think about the transportation system as one integrated system. And intercity bus needs to be an integral part of that system. One should be able to connect from one mode of transport to another seamlessly, easily. We have great success models in the United States. For example, Los Angeles Union Station, Boston South Station, or New York Port Authority Bus Terminal, or Washington, D.C. Union Stations.
Kai and the team, they are doing a fantastic job. They have really improved the product, they have improved technology, they have really made the production more efficient, that at the moment it's also a profitably growing business.
Bloomberg has the Fed decision under surveillance with the fastest coverage and exclusive analysis, including Powell's press conference. Nobody covers the Fed like Bloomberg. U.S. jobs numbers are released. Bloomberg has the report under surveillance with crucial data and expert analysis at terminal speed. Nobody covers Jobs Day like Bloomberg.
CBS News on the Hour, sponsored by Progressive Insurance.
I'm Stacey Lynn. A closure at one of the busiest airports in Europe is impacting travel around the world. CBS's Ian Lee is in London with the latest on the shutdown at Heathrow.
120 planes already in the air turned around, while others closer to London were diverted to nearby European cities. Airlines have canceled around 500 flights to and from the U.S. Officials are now looking into the cause of the fire and hope they can get flights back off the ground as early as tomorrow.
The airport says it doesn't know when power will be restored and expects disruptions for at least a few days. A Southwest Airlines plane got stopped just before taking off from Orlando because it wasn't on the runway yet.
3278 stop. Stop was 3278 stop. Cancel takeoff clearance. You're on hotel taxiway. Stop was 3278.
That's from liveatc.net. The crew apparently mistook the taxiway for the runway, and air traffic control canceled their clearance. CBS News has obtained a list of the Venezuelan men recently deported to El Salvador. Immigration and politics reporter Camilo Montoyo Galvez.
Some of these men do have criminal records in the U.S. or in other countries, but many, according to the administration, do not. The administration is accusing all of them of being part of this transnational criminal gang known as Tren de Aragua, but that is an accusation that is being disputed by their lawyers and their relatives.
The administration has said it carefully vetted each of them to verify they were connected to the gang. The wife of Mahmoud Khalil recounted the moment federal agents raided their apartment in New Jersey. Noor Abdallah told CBS Sunday Morning.
My husband was taken away from me in the middle of the night. It was one of the most terrifying times of my life. I don't think I've ever experienced anything scarier than that.
They allege he spread Hamas propaganda during anti-Israel protest at Columbia University last year. Israel's top court is ordering a halt to the prime minister's firing of the head of an international security service. CBS's Rami Inocencio tells us Ronan Barr
was leading a high-profile corruption probe into Netanyahu, into influence from Qatar directly into his office. Critics of Netanyahu say he's just trying to save his own skin, firing the chief, and then trying to install someone who will be an ally.
Pittsburgh Pirates pitcher Paul Skeens' rookie card just sold for over $1 million.
7 up, 7 down, all via the strikeout for Skeens.
And he got him
The card contains the MLB debut patch from his uniform and also his autograph. Looks like stocks are doing that wobble baby wobble dance right now, all in the red. The Dow down 436 points. This is CBS News. An early Christmas miracle.
A judge in Los Angeles has tossed out a $20 million copyright lawsuit filed by two songwriters from the South, claiming Mariah Carey copied melodies, lyrics, and other elements of her Christmas classic from their song of the same name. Vince Vance and the Valiants tune was released in 1989. Carey's debuted in 94. A musicologist who conducted an analysis concluded similarities were fragmentary, with different lyrical phrases and arrangements. Deborah Rodriguez, CBS News.
A step closer for Washington Caps Alex Ovechkin on the NHL Network. He is now 7 goals away from breaking Wayne Gretzky's career goal record. Stacey Lynn, CBS News.
This is Bloomberg Intelligence with Alex Steele and Paul Sweeney.
The real outperformance has been in U.S. corporate high yield.
Are the companies lean enough? Have they trimmed all the fat?
The semiconductor business is a really cyclical business.
Breaking market headlines and corporate news from across the globe.
Do investors like the M&A that we've seen?
These are two big-time blue-chip companies.
The window between the peak and cut changing super fast.
Bloomberg Intelligence with Alex Steele and Paul Sweeney on Bloomberg Radio.
All right, good Friday morning from the Bloomberg Interactive Broker Studio in New York City to our worldwide audience. We are streaming live on YouTube, so head over to youtube.com, search Bloomberg Podcast Live, and that's where you'll find us. A lot of news going on out there, a lot of moves in the markets. We'll have it all for you. We're going to lead off with Benedict Camo, Bloomberg Global Aviation Editors. Give us the latest reporting out of Heathrow. The airport closed down, officials were saying, for the day, so the disruptions across Europe, across the world, are just huge in terms of air travel. Get the latest there. Poonam Goyal, a senior U.S. e-commerce analyst for Bloomberg Intelligence, give us the latest coming out on Nike. A little bit disappointing there. Still got to clear out a lot of inventory. Simone Foxman, reporter for Bloomberg News Equality Team, to discuss the future for Weekend Edition, discussing what went wrong for DEI. That is the question. So we'll get the detailed reporting there. So a lot coming up in this hour. We'll kick it off with Mr. John Tucker.
And this Bloomberg Business Flash being brought to you by Interactive Brokers. Trade over 10,000 U.S. stocks and ETFs, U.S. equity index options, U.S. treasuries, and more on your timetable. Learn more at ibkr.com. And right now, the S&P 500, 49 points lower, down 0.9%, 5613 on the index. The Dow Jones Industrial Average is down 466 points. The NASDAQ 100 down 159 points. That is down about 0.8%. So another sell-off in several of the tech mega caps, driving the NASDAQ 100 toward its longest streak of weekly losses since May of 2022. Also, some weak earnings and forecasts weighing on the stocks, and we'll jump into these in detail a little later. But FedEx lowering its full-year guidance for a third consecutive quarter. Adjusted earnings now expected to be in the range of $18 to $18.60 a share. And FedEx, which you could consider to be something of a global bellwether because it operates all over the world, right now down 10.7%. And then that comeback at Nike looks like it just stumbled. The company signaling further declines in revenue and profitability. They're trying to clear out some of the old inventory through heavy discounting as well. And shares at Nike right now down 7.5%. Target cutting bonuses for salaried employees to 87% of their eligible 2024 bonuses, and they're blaming softer consumer spending and decreased sales and profit. Here's a stock for you. You may have not heard of this. IAG, it's actually a British stock, down right now 2.1%. They're the owners of British Airways. And I should tell you, Paul very generously offered his generator to Heathrow.
Yeah.
Did they take it?
Yeah,
I think they got back to us and said it's really not big enough to do the job, Paul, but thanks anyway.
It did the trick in Superstorm Sandy, so that's all I'm saying.
And it's still going strong.
Yeah.
We check the markets for you all day long, right here on Bloomberg Radio. I'm John Tucker. That's your Bloomberg Business Flash. Paul. Hi, Alex.
Hi, good morning. Happy Friday.
Good morning. We made it.
We made it. Those traveling to and from London have not made it. What an amazing array of headlines out of Heathrow. Suffering its worst disruption in at least 2 decades. A nearby fire cut that power, causing hundreds of thousands of passengers to be stranded. There's really not a lot of good news when it comes to these headlines. I wanted to get more on this with Benedict Camel, Bloomberg Global Aviation Editor. Benny, can you just put this into perspective for us? Like, it's bad enough that hundreds of thousands of people are stranded, but getting things up and running after this might also be just as big of a nightmare.
Yeah, you're absolutely right. And I haven't seen a shutdown of an airport on this kind of scale. We've had disruptions at Heathrow and at other airports before. You know, it might be weather related, wind, ice, heavy rain, whatever it might be. There have been strikes, there have been shutdowns because of air traffic control. But something on this scale, I have to say, is unprecedented. We had, you know, foiled terrorist attacks many years ago. Again, that disrupted operations, but not to this degree. For the airport to properly shut down for the duration of the entire day, all flights, I've never seen that before. Guy Johnson from Bloomberg TV is on the ground, an eerie silence in the skies. Normally, you'd have a lot of planes taking off and landing. I mean, we're talking more than 200,000 passengers here that would normally sort of cycle through this airport, and, you know, absolutely nothing going on today, all because of a fire that happened at a substation about 2 miles away.
And Benedict, I think unlike a lot of people, I was shocked to learn there's no redundancy, no backup power system for this airport. What do we know about that?
Well, you know, the aviation industry is sort of built around redundancies, built around the whole concept of safety. If something conks out, something else kicks in. What you do need to remember is that Heathrow isn't just an airport, it's essentially a city. And, you know, it requires the energy consumption of a small city. So to have a backup for that kind of an operation is difficult. So what they do have, obviously, is generators, is some sort of power backup. But that is really used to sort of keep the airport on life support, shall we say, but not really to run it at full capacity. So they've kept the lights on, but they've, you know, and it's sort of useful for emergency procedures. That means getting planes down if you have to, maybe, you know, just sort of the bare bones operations. But for a power station like this to go down, that really has disrupted operations, and they didn't have the backup for that.
When it comes to the airlines, what do they do? Like, for all these passengers that need to be rebooked and rescheduled, like, what's their process for that?
Well, there are sort of different sort of scales of hell here. You know, one is you arrive at the airport and you notice, okay, my flight's not taking off. Super annoying, but you'll survive. You'll go back home and you'll wait for the next day. Then there are those who were already in the air and the plane was so far advanced in its journey that it couldn't turn back. Those are the really unlucky people because some of them landed in Brussels, some of them landed in Frankfurt, some of them landed in Birmingham. The really lucky ones landed at London Gatwick, which is around the corner, but a lot of people landed at airports that were really far-flung. And then there are people who flew in the middle of the night and the plane turned back, and they might not even have noticed. There were sort of stories of people who fell asleep in the middle of the night, you know, Washington to Heathrow. They wake up in the morning thinking, what the heck? You know, here I am, where I started off. So it's been a brutal couple of hours hours for people. The airport has warned, do not show up. If you think you want to travel, don't. Just wait. We have heard from airlines this is going to take another day until things are properly back up. And even then, it's going to take a while for the system to sort of creak back to life, because a lot of planes are out of positions, crew are out of position. So that usually takes a couple of days, maybe even into next week, for things to go back to normal.
All right, Benny Camel, thank you so much. We really appreciate it. Benny Camel joining us, Bloomberg Global Aviation Editor. Let's take a look now at some stocks on the move today. We are joined now by Denitsa Sekova, Bloomberg Cross Asset Reporter. Denitsa, it's hard to talk about these stocks without talking about Nike.
Let's start with Nike. I feel as though we've talked a lot about them in the last few months, and most of it has been positive stuff. This time we're actually seeing their big comeback being threatened. We're seeing a lot of issues in terms of clearing out old inventory, growing trade war, and of course we've constantly talked about weakening consumer. So all of these forces have pushed Nike down 9%. And if you look at the year-to-date loss, we're looking at 13%. So it's a pretty rough start of the year. Of course, this comes after a big turnaround effort. We saw their a new chief executive officer, Elliot Hill, coming out of retirement to work on this. He's a long-time Nike employee. That has a great reputation, and there have been so many new initiatives. We were talking about the Skims partnership. We were talking about the Super Bowl commercial, and all of those things indeed brought optimism and help. But it seems like when it comes to earnings, investors are still not impressed by the company's turnaround and are waiting to see actual number. So, of course, weakening consumer and fallout from the escalating trade war are really complicating this.
And we're going to be speaking just a moment with Poonam Goyal, the retail analyst at Bloomberg Intelligence, maybe to show some more analysis of what was inventory reset and what was just the consumer.
And also a really tough tape at the same time.
Yeah.
All right.